So fine. Very good morning to each and everyone. Let's continue with Group 2 Accounting Standards Revision. And to tell you, we are not going to deal with each and every pinpoint of the standards because limited time. We need to cover almost all the standards, and the coverage also should be in such a way that you should feel satisfied that the whole standard is revised. So it's not something that we are going to check out the nook and corners of the standards, but what part is absolutely important and absolutely needed to the subject were being revised now. So now, as I told you that there are 12 standards in group 2. So we'll start with some easier standards in this session, that is from 9 to 10:30, right? So in this first off, we are going to cover accounting standard number 4, 5 and 24. So let's start with accounting standard number 4. So what is the name of accounting standard number 4? Yeah, it's supposed you to give the response. What is the name of accounting standard number 4? Contingencies and events occurring after balance sheet date. So the name itself is telling that this standard is going to deal with those contingencies and events which occurred after balance sheet date. For your kind information, let us take financial year 2010-11, 2011-12. It's quite common that current year financial statements will be finalized in the next year. Current year financial statements will be finalized in the next year. So say for example, current year is 2010-11, whose financial statements will be finalized in 2011-12. I mean to tell, the year ending of 2010-11 is all about 31/3/2011. These were somewhere finalized on 31/7/2011. This 31/7/2011 purely falls in the financial year 11-12, and this is the year ending 10-11. Now, very important thing is all about, you're going to deal with such kind of contingencies and events occurring after balance sheet date. But point number 1 here that you have to note, if such contingencies and events were occurred after balance sheet date, then it is purely relating to 2011-12. Yes or no? But you have to pick such a contingencies and events which occurs after the balance sheet date but relates to the previous year. That is 2010-11, 2011-12. Balance sheet date is 31/3/2011. Books of accounts finalized date is 31/7/2011. Our standard will deal with all the items which occurred after balance sheet date but before the date of approval of financial statements. What are the two dates, Amma? What are the two dates after the date of balance sheet but before date of approval of financial statements? Within this period, whatever events are there, we are going to deal with all such contingencies and events. But very important thing is all about these contingencies and events should relate to the previous year, that these events should relate to 2010 and 11. So now to tell you, so what is a contingency and what is an event? Because you have to learn with these two things whenever we have gone with this standard. Contingency is something the situation may or may not happen. Event is something that the situation will happen for sure or had happened. May or may not is nothing but contingency. It had taken place is nothing but event. So to tell you, there is another standard called accounting standard number 29. What is the name of AS 29? Contingent liabilities, provisions, contingent liabilities and contingent assets. That is the name of accounting standard number 29. So if you check out the word contingency, this is also dealt by AS 29. So now the biggest controversy, will it be dealt by AS4 or will it be dealt by AS 29? Hope you have got the question. In AS4 also you are having contingencies, and even in AS 29 also you are having provisions, contingent assets and contingent liabilities. So now these contingencies, does it deal by AS4 or AS 29? What is that? Can anybody? Fine, the answer is all about both the standards. But such kind of contingencies which is not dealt by AS 29 shall be dealt by AS 4. or such kind of contingencies which is not dealt by any other standard will be dealt by AS4. To tell you, hope you have remembered accounting standard number 2, valuation of inventories. It has to be valued at cost or NRV, whichever is lower. Correct or wrong? So whenever you are valuing it at cost or NRV, whichever is lower, automatically there is some price where fall is there. Say if the cost is 100 and if the NRV is 80, it has to be valued at rupees. In other words, provision is nothing but rupees 20. Correct or wrong? And also valuation of investment. Investments have to be valued at cost or fair value, whichever is lower. Say the cost is 100 and the fair value is 80. You have to value at rupees. Automatically the difference is rupees 20. This 20 shall be dealt by accounting standard number 13. Getting my point, everybody? Like it is valued at 80. Automatically 20 rupees is fell down, which has to be transferred to P&L account as loss. Response, sir. So there are specific standards like accounting standard number 2, accounting standard number 13, AS 29, several other standards you are having. If those standard does not deal with such kind of contingency, it shall be dealt by accounting standard number 4. Okay, everybody? Fine. So contingency is such a situation where it may or may not happen. AS4 deals with such kind of contingencies which are not dealt with any other standard. To tell you one kind of contingency that we all familiarly known is all about provision for debtors. Likewise, you will be coming across with such a kind of example that as at the closing date, debtor's position is not good. He is about to declare insolvent. Hope you have remembered that example. But after the date of balance sheet, but before the date of approval of financial statement, this debtor had declared insolvency. How this will be treated in the previous year? Which is nothing but a kind of contingency. That is, as on the balance sheet date, you are having doubt on the debtor whether he may pay or he may not pay. His position is not good. Okay. So like that, contingency may or may not happen. But now coming to event. Event is something pakka that it will happen. Event is something that 100% it will happen or it had happened. That we will call it as an event. So now, as per accounting standard number 4, the total there are number 1 contingency, number 2 events. These events are again divided into 2 types. Number 1 adjusting event, number 2 non-adjusting event. So what is an adjusting event and what is a non-adjusting event? Sir, adjusting events are those events which satisfies the following 3 conditions. Number 1, which is very important for entire accounting standard number 4. For entire accounting standard number 4 is all about, listen very carefully, there should be a situation or condition that is existing on the balance sheet date. This is very important. There is either a situation or a condition which is existing on the balance sheet date. Sir, if at all the situation or condition is arising after the balance sheet date, then we will not consider it as accounting standard number 4. Situation or condition existing on the balance sheet date. Just now I told you one example that the debtor's position is not good. Debtor's position is not good, is existing as at the balance sheet date. That is on 31/3/2011. So that is what something like situation or condition existing on the balance sheet date. Debtor's position not good. So it's a situation or it's a condition that is existing as on the balance sheet date. And that situation condition existing on the balance sheet date has to be confirmed with additional evidence after balance sheet date, but before the date of approval of financial statements. Additional event should confirm that his position is not good. And finally, such event or such information should be material. 3 conditions. So what is condition number 1? Situation or condition existing as on the balance sheet date. What is condition number 2? Additional evidence should be occurred after balance sheet date but before the date of approval of financial statements. Last and final one, the event should be material. Of course, amount also should be material. Now let's have an example. During the year 2010-11, you have sold goods to a debtor for rupees 1 lakh. So this person has to pay you. This person has to pay you. This debtor has to pay you actually. Now what happened? As at 31/3/2011, you just have inquired about this debtor and you have come across with such a kind of conclusion that this debtor's premises was accidentally occurred by a fire. The premises of the debtor was accidentally occurred by a fire. Very, very important. He is not insured. His premises was not insured. If his premises is insured, there is no problem at all. It's immaterial. Hope you have got my point. Debtor's premises was caught by fire, say during February 2011. From then he is struggling a lot to reinstate his business. If he had taken insurance policy, it would not have affected the debtor that much. Because whatever the loss occurred shall be compensated by the insurance company and comfortably he will be enjoying the same. But the biggest problem here is all about he is not insured. His premises was not insured. Since his premises was not insured, automatically there will be a huge loss to the debtor, where he is struggling hard to reinstate his business. This was known to our company on 31/3/2011. So whenever it was known to our company, automatically we are doubting the debtor. I've sold to my debtor and some fire was caught in February 2011. So his position is not good. What about my situation if he did not pay in future? If his position is good, absolutely no problem to me. But since his position is not good, I am having doubt on the debtor. So immediately I thought about the situation and I'm thinking to create a provision. I'm thinking to create a provision, not yet created. I got the information that the debtor's position is not good. Now, very, very important. After the balance sheet date, that is after 31/3/2011, but before date of approval, say for example, in our example, 31/7/2011. Between these 2 days, whatever my doubt that I am having on 31/3/2011 that the debtor's position is not good is confirmed. Declared insolvency. Sir, very important question. He declared insolvency in which financial year? After 11. I mean to tell, is he declared insolvency in 10/11 or 11/12? Obviously 11/12. So it had turned out into bad debts. In which year? 11/12. Correct or wrong? But as at 31/3/2011, since his position is not good, it was confirmed with some additional evidence, and that additional information or evidence is absolutely material, and hence since all these 3 conditions are satisfied, I would like to create a provision on 31/3/2011. Clear everybody? So this is what the whole concept. So what are the 3 things? Number 1, condition or condition or situation existing on the balance sheet date, debtor's position is not good. And we have got the additional evidence, declared insolvency, and finally material. That evidence is obviously material. Since all the 3 conditions are satisfied here, we will call that event as adjusting event, and immediately I will be creating a provision. Pakka? So that is the concept of your initial framing of adjusting event. Now what is the meaning, how this adjusting event has to be adjusted? Point number 1. Adjusting events are such events which have to be adjusted in the previous year's financial statements. That is in the year 2010-11. Since these adjusting events are to be adjusted, the balance sheet assets and liabilities, whatever are there, the figures will be changed. Clear? The balance sheet figures will be changed. Okay, that is what all about your adjusting events. And coming to non-adjusting events, those events which are not adjusting events are called as non-adjusting events. Likewise, in our example, 3 things happened. Number 1, debtor's position is not good as on 31/3/2011. Number 2, after 31/3/2011, but before the date of approval, that is 31/7/2011, there is an event occurred that the debtor had declared insolvency. And finally, point number 3, such innovation is obviously material. Now, say for example, debtor's position is not good on 31/3/2011, but he has declared insolvency. He has declared insolvency after 31/3/2011. Hope you have got my question. That is, after the finalization of books of accounts, that debtor has declared insolvency. If it is of such a case, just answer. Will it be called as adjusting event or non-adjusting event? Non-adjusting, because all the 3 conditions should satisfy to become adjusting. Since here second condition itself is not satisfied, it is called as non-adjusting. Pakka? And listen very, very carefully. Sir, in point number 2, he has declared insolvency between this period, but we were fully insured on the debtors. Our company had taken insurance on our debtors, that in the event of their non-repayment, my insurance company will repay me. Material or immaterial? Material or immaterial? Immaterial. Hey, I am telling that we have taken insurance on our debtors. Not like debtor is insured. That concept is already over. My example is all about our company had taken insurance on our debtors. So if my debtor had declared insolvency, automatically I will be getting paid with my insurance company. So now tell me, is the event material or immaterial? Immaterial, and hence no need to adjust, non-adjusting. And very important thing, sir, debtor's position is not good somewhere on 2nd April 2011, caught by fire. Declared insolvency before 31/7, that is previous year financial statements approval date, and it is material. Adjusting or non-adjusting? Non-adjusting. Reason being, there is no condition or situation existing as on the balance sheet date. Pakka? So these are the 2 things. Number 1 is adjusting event. Number 2 is non-adjusting event. Adjusting event to be adjusted or not to be adjusted? To be adjusted. Non-adjusting event not to be adjusted. What are the 3 conditions for adjusting event? Situation or condition existing on the balance sheet date. Additional evidence to confirm. Last and final one, it should be material. If these 3 conditions are satisfied, you have to adjust so that the previous year assets and liabilities will be altered. Non-adjusting in the sense, no need to adjust at all. Very important thing, just disclose in board of directors report. Where you have to disclose that? Board of directors report. So just answer me, is board of directors report a part of financial statements or not a part of financial statements? Not a part of financial statements. As per section 2 of 40, financial statements includes balance sheet, P&L account, cash flow statement, statement of changes in equity, and finally notes to accounts. So board of directors report is not at all a part of financial statements. So adjusting events are to be adjusted in financial statements. Non-adjusting event are just to be disclosed. That too disclosed in financial statements or board of directors report. It has to be disclosed in board of directors report, but not in financial statements. Pakka? So this is the major part of the standard. Now end parts of the standard. Point number 1, non-adjusting events generally not to be adjusted. Exception. Number 1 and number 2. If there is an event occurred, but it is affecting going concern. Now, it's a non-adjusting event itself, but non-adjusting event, such event is affecting the going concern of our business. Then it has to be adjusted. Second one, law. Statutes or provisions of law. If at all the statutes or provisions of law are asking you to adjust those financial statements, even though this event is non-adjusting, it has to be adjusted. If statutes or provisions of law asserted that these are to be adjusted, then even though these are non-adjusting, you have to adjust. Clear, everybody? To tell you an example, say for example, as on 31/3/2011, the position is obviously good, but there is an event occurred on 30th April. And that event is all about our premises. Hey, take care, not the debtor's premises, our premises was caught by fire. Trader's premises was caught by fire. Okay. Not insured. Trader's premises was caught by fire and it was not insured. Answer. Number 1, adjusting or non-adjusting? Is it adjusting or non-adjusting? Obviously non-adjusting. Reason being, there is no situation on 31.3. Who will think that on 31.3 in future my business will be caught by fire? Correct or wrong? It's like a very sarcasm. So nobody will think like that. So after 31.3, somewhere between it was caught by fire, and hence we thought of like it's obviously a non-adjusting. But since our premises was not insured, our existence is questioned. Our existence is questioned. I mean to tell, our going concern will be affected. Whether our business will run in future or not, it is $100 question. And hence, since it is affecting the going concern, so board of directors have concluded, we are very sorry, hands up, we are not having any other option. Since our entire premises were caught by fire, we are about to close our business. It is affecting the going concern. So even though it is non-adjusting event, since it is affecting the going concern, it has to be adjusted. Clear everybody? And one more thing, listen, as at the year ending 31/3/2011, obviously board of directors can estimate that whether there will be profits or not. Correct or wrong? And obviously as at the year ending 31/3/2011, they might have some condition that we may declare the dividend. Yes or no? It is obviously a kind of condition that is on 31/3/2011. But this dividend, whatever is there, will be declared after 31/3/2011. Clear everybody? Whatever the dividend is there, it will be declared only at the end of year 31/3/2011. Reason being, sir, to declare dividend, there should be profits. But whether there are profits or not will be an outcome and shall be known only when the financial statements are prepared. Getting my point, everybody? Financial statements will be prepared only after 31/3/2011. That is, somewhere they were approved on 31/7/2011. And after that, they are going to declare the dividend to the shareholders. And of course, the rest you know that it will be proposed by board of directors. It has to be approved by the shareholder in annual general meeting. Am I correct or wrong? So answer me, is the dividend declared adjusting event or non-adjusting event? Simply, non-adjusting event. Pakka. Reason being, there is no specific condition. Even though there is a condition, it will not turn into a liability. Sir, as at 31/3/2011, they may think that there are profits. They may think that we may declare the dividend. But it can be proposed by board of directors only when there are profits. They will be knowing that the profits will be there only when the financial statements are prepared. Financial statements will be prepared only after the year ending. And hence automatically, even though there is a thought the dividend may be declared at the year ending, it is not to be considered. Why not to be considered? In the sense, there is no written proof for that. It will turn out into an original thing only when the board of directors have declared. Only when the shareholders have approved. Clear everybody? So that is the concept of your dividend declared. To tell you conclusion. Dividend declared is an adjusting event or non-adjusting event? Non-adjusting event. Since it is a non-adjusting event, it is not to be adjusted, but it is to be disclosed. Sir, normally it is to be disclosed in? All the non-adjusting events are to be disclosed in board of directors report, but this has to be disclosed in financial statements itself. Because Companies Act 2013 Schedule 3 is telling the same, that dividend has to be disclosed in Note 2 reserves and surplus while preparing the financial statements. Clear everybody? So would like to conclude the same. Accounting standard number 4. Yeah, almost the standard is over. Contingencies and events occurring after the balance sheet date. So point number 1, contingency may or may not occur. Point number 2, event. Pakka, it will take place or it had taken place, occurred. We will call it as event. Uncertainty, contingency, certainty, event. AS4 deals with such kind of contingencies which are not dealt by any other standard. And coming to events, these are divided into two types. Number one is adjusting event. Number two is non-adjusting event. Adjusting events are those events which are to be adjusted in the previous year financial statements by altering the assets and liabilities of the previous year. And non-adjusting are those events, no need to adjust the previous year financial statements at all, but these are to be disclosed in the board of directors report. Very important thing, 3 conditions for adjusting events. Condition number 1, there should be some condition or situation existing on the balance sheet date. Number 2, additional evidence to confirm such condition or situation. Last and final, such event should be material. Of course, amount should be always material. Otherwise, no standard will be applicable if the amount is immaterial. Accounting standards are not applicable for immaterial items. So, it should be material. Clear, everybody? Coming to non-adjusting event, not to be adjusted, to be disclosed in board of directors report, but exception. Number 1, if such event affects the going concern. Number 2, if at all statutes or provisions of law are telling, even though these are non-adjusting, these are to be adjusted. And for your kind information, special treatment is for dividend declared, because dividend declared, even though it is a non-adjusting event, it is not to be disclosed in board of directors report. Don't confuse that declared dividend. Dividend will be declared as at the year ending. So it is a condition. No, you should not think in that way, because you should have some written proof. To have that return proof, financial statements should be prepared. But financial statements will be prepared only at the end of the year. And hence dividend declared, even though it is a non-adjusting event, it has to be disclosed, but not in board of directors. It has to be disclosed in financial statements, that too in note 2, reserves and surplus. Clear, everybody? And moving on to the next one, contingent liabilities and contingent gains. Last part of this standard. Contingent gains will be always dealt by accounting standard number 29. Gains which are to be accrued to the business may or may not. It will be dealt only by accounting standard number 29. Say for example, our business concern had filed a suit in a court of law that the competitor had infringed our trademark. Mana trademark vaadu vaadeskunnadu. So we have filed a suit on that person. So we are expecting that the court judgment will be in favor of us. If court judgment will be in favor of us, that party has to pay 1 crore for us. If the court's judgment is not in favor of us, no need to pay the same. So obviously whatever is there, this will be treated as contingent gain, because may or may not occur for us. This will be dealt only as per accounting standard number 29, either contingent gain or contingent asset. But coming to contingent liabilities, this will be dealt by AS 29 or any other standard. Whichever things that were not dealt by the other standard shall be dealt here. Sir, for contingent liabilities, may or may not occur. Say for example, somebody had filed a suit on Aznaf. That we have to pay the amount to them since we had infringed their trademark. Verevadu mana meeda case chesadu ippudu. So we have to pay. Correct or wrong? Now listen very, very carefully, everybody. Point number 1. If at all the legal counsel of our company or the board of directors of our company are estimating that yes sir, we have infringed the trademark, at any cost we have to pay the compensation, then obviously more chances of occurring is there, and hence I need to create a provision. Clear? Now the second one. Sir, we did not infringe. It is only his thought. But court's judgment might be either in favor of us or might not be in favor of us. We cannot tell that. And hence, since the loss is reasonable, we need to treat it as a contingent liability. And this has to be disclosed at footnote of balance sheet. Clear? And last and final, legal counsel told that is a bacha case, sir. He wantedly filed a case on us, so no need to worry about that case. And hence, it cannot be considered remote. Loss is remote, very, very less chances. And hence, automatically, we can ignore. Clear, everybody? Contingent gains will be dealt by A's. Coming to contingent liability, you need to create a provision if the loss is more chances or less chances. Loss is having more chances. If the loss is having equally chances, you have to treat it as a contingent liability, may or may not situation. And finally, if there are less chances, you can comfortably ignore. Clear, everybody? Hey, these rules are same for any standard where the provision is needed, whether it is 13 or even AS29 or AS4. For every standard, the rules are same, for which is relating to the provision. Okay, everybody? So that is all about your accounting standard number 4. Clear? So let us have some questions. See, it's highly impossible to deal with each and every question, but some of the concept related questions should be learned. Of course, here and then while the class is going on, we'll be giving you some of the examples, but apart from that, we will also check out with the questions which were there in our material or study material. So, sir, it's not possible to read and explain the question. I'll tell you the overlook of the question so that you can just go through it later. Okay, fine. Check out. While preparing the financial statements, that is at the year ending 31st March 2017, a trade receivable 2 lakh is there. But to him, he was suffered with a heavy loss due to an earthquake. And very, very important thing, the loss was not covered by any insurance company. And in April 2017, that debtor had become bankrupt, declared insolvency. Now, is it an adjusting loss or adjusting event or a non-adjusting event? So check out, as at 31/3/2017, that is as at the year ending, you are having a debtor who has to pay 2 lakhs for us. But during the year, he had suffered with heavy loss due to an earthquake. Clear? So in April 2017, bankrupt. Likewise, I have told you an example of caught by fire. Here it is replaced with earthquake. During the year, earthquake occurred. Debtor is suffered with heavy loss. He has to pay us 2 lakh, but we are not sure of getting the payment. And hence, adjusting provided if he has declared insolvency after the balance sheet date, but before the approval of financial statements. Sir, entire question is same, but given that insured. Adjusting or non-adjusting? Absolutely non-adjusting, since it is immaterial. Pakka, everybody? So that is what question number 1. Take care. Sir, be careful with this question. A Limited closed its books of accounts on 30/6/2020 and the accounts for that period were considered and approved by the board of directors on 20th August 2020. What is the closing year? 30th June. And what is the approval date? 20th August. So between these two dates, whatever the events occur, we will call it as events occurred after balance sheet date. That is after the balance sheet date, but before the date of approval. Company was engaged in laying a pipeline for oil company deep beneath the earth, below to the surface of the earth. Say for example, it is surface of the earth. So they have to dig and they have to lay out the pipelines. That is a work of the company. Now what happened? While doing the boring work on 1st September 2020, they had met with a rocky surface, which was estimated that it would incur an extra cost of rupees 780 lakhs. Clear? So business is all about, this is the surface of the earth. They have to dig the earth surface and they have to lay out the pipelines. So if at all the surface of the earth is fine and deep beneath the earth, whatever is there, nobody knows that. Correct or wrong? But while doing the work, they have met with a rocky surface which is there deep beneath the earth. So they have to clear the rocky surface and then they have to lay out the pipeline. మట్టిగా ఉంటే ఈజీగా వెళ్ళిపోతుంది, బట్ అక్కడ వాళ్ళు రాళ్ళు అవి ఉన్నాయంట. సో అది వాళ్ళు క్లియర్ చేసి వేయాలి. So they have met with some rocky surface. So they have to clear that rocks or whatever the rocky surface is there, and again they have to lay out a pipeline. Clear? Finally, now tell the answer. Will it become an adjusting or non-adjusting? Non-adjusting, reason being occurred somewhere after the financial statements. Clear everybody? But if it is occurred before the financial statement approval, it will be obviously treated as an adjusting event. Reason being, for your kind information, as at 31/3/2011, there is the rocky surface deep beneath the earth. You are having the contract in your hand on 31/3/2011. But you have met with that rocky surface between the date of approval and the date of balance sheet. Clear everybody? So there is a condition existing on the balance sheet date because you are having contract in hand and that rocky surface is already existing in the deep beneath of the earth. And you have come across with that between this period, and hence automatically an additional evidence is confirmed that there is some rocky surface deep beneath the earth, and you have to carry it on with an extra cost of rupees 780 lakhs. In this question it is very easy, since the event is occurred after balance sheet date and after the date of approval of financial statements, it had become non-adjusting event. If it occurred before the date of approval of financial statements, then it will be treated as adjusting event. Clear everybody? Fine. To tell you, yeah, the final question, of course this question is again similar to this question. We'll be telling you the situation, okay? Listen carefully. We are running the business where we are also having some debtors. You have to collect money from debtors. So generally what I will do is all about, there will be some debtors who will repay us directly. With those debtors there is no problem. There are some other debtors to whom we have to go to their premises and we have to collect the money. Okay, we have to go to the debtors premises and we have to collect the money. Now there are two kinds of debtors for us. Style number 1 debtors who will send their checks through couriers. Style number 2 debtors, I will send some agents of my business to the debtors premises. I will send my agents to the debtors premises for collecting the same amount. Clear everybody? Hey, this is my business. I'm having some debtors where some of the debtors will be sending their checks through couriers, and some of the debtors whoever are there to those premises I will be sending my agents for collection of those checks or collection of those amounts. Clear? Sir, to whom premises I have sent the agents, it is pretty comfortable. Reason being, my agents will go there, they will collect the checks or they will collect the amount and they will intimate to my business, and automatically I will be recording the same in my books of accounts. But the biggest problem is all with the checks. Sir, they have sent the checks on 31/3/2011 or before 31/3/2011. But I am receiving the checks. After 31/3/2011. Clear everybody? They might have sent the checks before 31/3, but I don't know that one, that they will repay or they will send the checks. After 31/3, that is after the closing of books of accounts or after the closing date, not closing the books of accounts, after the closing date, after the date of balance sheet, I am receiving some checks in my hand now. Clear? So finally, answer. Will it become an adjusting event or a non-adjusting event? Hope you have got the question. On 31/3 or before 31/3, some of the debtors are sending their checks through the couriers. Nobody knows that. Even our business don't know that whether they will pay, whether they will send something like that. But I have received the checks after 31/3. Are these checks to be adjusted or not to be adjusted? Sir, answer. How many of you tell that it is adjusting event? 1, 2, 3. Non-adjusting? Okay. And the final answer is obviously non-adjusting. As simple as such. Nobody knows that they sent. There is no condition or situation existing on the balance sheet date. That is a difference. Sir, whereas in the previous question, pipeline question, it is totally different. Because I am having contract in hand. I have to perform that. I have to incur some extra cost. But here it is not like that. Courier is an outside agency. Contract is in my hand. There is a rocky surface deep beneath the earth. All these are relating to my business concern and hence adjusting. But debtors are sending the checks through courier. Courier is an outside agency. Clear? So we can trust that courier will be sending, or we are having a conception, or we are having a condition existing on the balance sheet date. That is not there. And hence it will become a non-adjusting event. Clear everybody? So that is all about accounting standard number 4. And just get ready. Within the next 2 minutes, we are going to start accounting standard number 5. And if any doubts in AS4, you can ask. So simply to tell you, there is an event, there is a contingency. Events are again 2 types, adjusting, non-adjusting. If 3 conditions are satisfied, adjusting. These are to be adjusted in the previous year financial statements. Non-adjusting, not to be adjusted, just to be disclosed in the board of directors report. Non-adjusting, generally not to be adjusted. Exception, if FX going concern, if statutes of law or provisions are telling, you have to adjust. That's it. Special element is all about declared dividend. Even though it seems to be adjusting, it is not an adjusting, it is a non-adjusting event. Very important thing, not to be in board of directors report, it has to be disclosed in financial statements. Clear? Now please don't confuse between the rocky surface and debtor sent through the couriers, because there may be students who will be posing something like, sir, rocky surface is there, we don't know that one. You told adjusting event. Debtor sent through courier, we don't know that one, but you told non-adjusting. Why? Hope you have got the relation. Listen, conclusion. Contract in hand belongs to me. Rocky surface also belongs to me because I have to perform the contract. So as at the balance sheet date, there is a condition, but we don't know that condition. Condition is there, but we don't know. But we have come to know that one after the balance sheet date. That is pipeline example. Courier example, debtors belongs to me. Payment has to be done to me, but they have sent through courier, which is an outside agency. I cannot extend my trust on outside agency, and I cannot tell that outside agency related conditions are there on existing the balance sheet date. Hope you have got the difference. So get ready, we are going to start AS5. If you have doubts, you can ask. So fine. Let's start the next standard, accounting standard number 5. Another easy standard. Also, we can complete it a bit faster. AS4 seems to be very easy, but many conditions will be there. But AS5 appears to be easy, of course easy, but many definitions will be there. So, shall we start now? Okay. So, what is AS5, Amma? Net profit or loss for the period, prior period, items and changes in accounting policies. So let us start. In this standard, we have to learn what are period items, what are prior period items, what are changes in accounting policies, and also what are changes in accounting estimates. So shall I start now? First, period items. As simple as such. If they occur in a particular period, we will call those items as period items. Likewise, 2010-11, 2011-12. I asked you one question, if you have remembered. Even though there is a condition existing on the balance sheet date, debtor had declared insolvency somewhere on 30th April. So it is called as, what is it called as? So debtor declared insolvency on 30th April. So he will be called as dash, bad debt. So now question is that, when you have to record the bad debt, 10-11, 11-12. Sir, 10-11, 11-12. 11-12 bad debt. For 10-11 provision. Hey, get the difference. For 10-11 provision. For 11-12, that provision is AS4. This bad debt is AS5. Clear? Period item occurred on 30th April 2011, which is belonging to 2011-12 totally, and hence this has to be treated as bad debt. Pakka everybody? So period items, whatever the items that were occurred in a particular period, we will call all those items as period items. Likewise, sales, purchases, salaries paid, whatever. And also, period items has to be booked in statement of profit and loss account. Sir, I'll ask you one question, just tell me the answer. Salary paid during the year, 1 lakh. But also there is outstanding salary 50,000. How much is to be taken to P&L account? Sir, respond. 1 lakh or 1 lakh 50? Why 1 lakh 50? Because outstanding salary is also relating to that period. Clear everybody? So since outstanding salary is also relating to that period, even it is also to be treated as a period item and it has to be taken to P&L account. Pakka? Now these period items are divided into two types. Number 1, ordinary items. Number 2, extraordinary items. Hope you have remembered your format of schedule 3. No? Likewise, you are having revenue from operations, other income, total income. And coming to expenses, employee benefit expenses, finance costs, depreciation and amortization, purchase of stock in trade, cost of raw materials consumed, whatever. All these items are quite common in business. Likewise, salary payment, depreciations, office expenses, whatever are quite related to due course of business, we will be calling those as ordinary items. Whichever items are relating to due course of business, those items we will call it as ordinary items. Clear everybody? Hey, those items which can be clearly distinguished from the ordinary course of business, we will call it as extraordinary items. To ask you one simple question, salary paid, is it relating to business or not? So it is ordinary item. Purchase of goods, yes, relating to business, ordinary item. Sale of goods, ordinary items. Purchase of asset, even purchase of asset is also relating to your business, and hence which item? Ordinary item. Clear? Earthquake occurred, not related to your business, but your business was affected. It's not related to your business, but your business was affected. And next is all about some fire accident occurred. You did not expect that. It is not at all related to your business, but fire accident occurred in your premises. So which is an extraordinary item. Clear everybody? So that is what all about the concept of ordinary and extraordinary. If it is relating to your business, we will call it as ordinary item. If it is not at all related to your business, you will call it as extraordinary items. Anyways, let me proceed further. Now coming to ordinary items, again divide into two types. Ordinary and general, ordinary and exceptional. Just now, if you check out these examples, salaries paid, quite common, relating to business. Purchase of good, quite common, relating to business. Sale of goods, quite common, relating to business. Purchase of asset relates to business, but not quite common. Every day you will not purchase the asset, or every year you will not purchase the asset. Am I correct or wrong? And hence, my dear children, this purchase of asset, whatever is there, this is relating to our business. So ordinary, but exceptional, because it happens once in a while. Clear everybody? Pakka? So number 1 is period items, ordinary, extraordinary. Relates to your business, ordinary. Not at all related to your business, extraordinary. Coming to ordinary, again, daily activities of the business, general. Occurs only once in a while, exceptional. Clear? Let us do some other different style of examples. Number 1, increase of salary retrospectively. Hope you know what is the meaning of retrospectively. You are increasing the salary of a worker not from today, right from the past year. Ordinary, extraordinary. It is ordinary, but exceptional. Point number 1, Increasing salary retrospectively is quite possible, especially in government organizations. For the workers, it's quite possible. అంటే మనకి తెలియకపోవచ్చు, but it is a normal activity, but it will not occur every time, only once in a while. So it is ordinary but exceptional. Very important. Okay, listen. Abnormal loss of good due to fire accident. Yeah, respond fast. Sir, if you respond fast, I'll proceed fast so that we can cover bulky of the standards. Answer. Yes, perfect. It's an extraordinary item. No. It's extraordinary because fire accident occurred. Now listen carefully. Abnormal loss of good due to theft of stock by the storekeeper. Ordinary but exceptional. Because it's quite possible to storekeeper to manipulate the count of the stock, and he might take some of goods to his home, but it will not happen every time. It's quite possible. Sir, godown దగ్గర ఎవడు ఉంటాడమ్మా? స్టాక్ కీపర్. స్టాక్ బయటకు వెళ్ళాలన్నా లోపలికి రావాలన్నా వాడి చేతిలో ఉంటుంది. He can manipulate the records and he can take away, or he can just take away to his home, or he can eat. So automatically it is ordinary but exceptional. Sir, loss of cash due to some fire accident. Extraordinary. Now loss of cash due to manipulation done by the cashier. Hope you have got the differences. So be careful. And next, litigation settlements. Likewise, we have discussed something like somebody had filed a case in the court of law. So what is this one? Ordinary but exceptional. It's quite common to every business concern to have some case on them. For consumer support or for customer support, you can dial the number. ఏదో చెప్తా ఉంటాడు కదా. Or in consumer case, many cases will be there in consumer court. So it's quite common. Litigation settlement, it's common, but every time it will not happen, and hence it is ordinary but exceptional items. Clear everybody? So these are some of the examples. Be careful. Shall I proceed further? That's the end of period items. Period is over. Now moving on to the next one, prior period items. Listen very, very carefully. Items of expenses or incomes. Items of expenses or incomes occurred in the previous period. Occurred in the previous period, but found in current period, either due to error or omission. Clear everybody? Items of dash or dash, expenses or income occurred in which year? Previous year. Found in which year? Current year. Due to dash or dash, errors or omission. Clear everybody? Items of expenses or income related to previous year but found in current year. Sir, why which are relating to previous year were found in current year, sir? Due to errors or omissions. These are called as prior period items. I'll ask you some examples. Okay with the definition, everybody? Listen very, very carefully. To tell you in simple words, prior period items is nothing but rectification of errors. Listen everybody. Sir, salary paid 1 lakh, forgotten to return in previous year. That was found in current year. Clear? Why? Due to omission. You have forgotten to record that, so it's an omission. You have found it in the current year, and hence you are about to record the same. Very, very important thing. Will it to be recorded in the previous year financial statements? Will it to be recorded in the current year financial statements? If the previous year financial statements were not yet closed, those are to be recorded in the previous year itself. If those were closed, to be recorded in the current year. To tell you, same example, 31/3/2011 year ending, 31/7/2011 date of approval of financial statements. Now salary paid 1 lakh is relating to 2010-11. Whatever that salary paid, was not recorded in 2010-11, and it was found in between this period. Can you record the same in the previous year or not? Yes. Why? Because the books of accounts were not yet finalized. If the books of accounts were once finalized, you cannot record the same in the previous year financial statements. You have to record the same in 2011-12 by treating it as a prior period item. Clear? So conclusion, if prior period item is found before the approval of financial statements, these are to be adjusted in the previous year financial statements. If prior period items are found after the approval of financial statements, since the books of accounts were approved and closed, nobody can do anything. It has to be recorded in the current year financial statements. Pakka everybody? That is point number 1. Now point number 2. Listen very carefully and answer. Salary paid for installation of machinery was recorded in P&L account, which was not found in the previous year, which was only found in the current year. Will it be treated as a prior period item or not? Answer needed. Yes or no? Reason being, salary paid for installation of machinery has to be capitalized for machinery. But you are routing it through P&L account. Since you have recorded in your P&L account, your expense increased and your profit is decreased. But it has to be added to the machinery. And hence the treatment is wrong. It is a prior period item which has to be adjusted. Same. If the books of accounts were closed in the current year, if the books of accounts were not yet approved in the previous year. Clear? Very important. Listen and answer. Very important. Listen and answer. Rama is a debtor. Also Ramu is a debtor. Amount paid by Rama to the business concern, that is amount received by Rama, was recorded in Ramu account. Not found in the previous year, it was found in the current year. Will it be a prior period item or not? Answer. No. Amount is same even though. No, that's not the reason. There's one more reason. Items of expenses or incomes. Hey, what is the definition of prior period item? First word. Items of expenses or incomes. That is very much important. Clear everybody? So items of expenses or incomes. But here there is no expense, there is no income. Ramu is a debtor, Rama is a debtor. They are just giving us cash account debtor to debtor account. So it is not affecting the expense or income. Moreover, what is the name of accounting standard number 5? Net profit or loss. So this transaction is not at all affecting net profit or loss, and hence it will not be under the purview of AS5. My dear children, I am not telling that this is not to be adjusted. This will have to be rectified. But not as per AS5 antunna. Clear everybody? So this is all about your prior period items. Error and omission. Omission in the sense there is reliable information available in the previous year but you did not consider. Salary paid. Yes, it's a reliable information available but you did not consider and hence you did not record. Coming to error. Error is something like due to unaware of accounting policy you may commit an error or calculation mistakes or misrepresentations. Miscalculations, misrepresentations. And due to unaware of accounting policies, wages paid for installation of machinery has to be added to the machinery. But due to unaware of accounting policy, you have routed it through P&L account, which is a prior period item. That is an error. Clear everybody? Conclusion, prior period items. Items of expense or income relates to the previous year, occurred in the current year due to error or omission. What is an omission? Reliable information available in the previous period but not considered. What is an error? Error is something which is committed due to unaware of accounting policies, misrepresentations, miscalculations. Clear? There ends with prior period items. Now, changes in accounting estimates. As simple as such, I'll tell you the difference between changes in accounting policy and changes in accounting estimate. Listen very, very carefully. We are providing a provision at the rate 2%. Would like to increase the provision to 10%. Or providing a provision at 10%, would like to decrease the provision at 4%. What is this? Change in accounting estimate. My estimate is changing. Now listen carefully. I would like to provide a provision at 10%. But decided from the current year, no more provision is required and hence not at all providing a provision. This is policy. Clear everybody? Hey, my policy is that creating a provision till previous year. From current year, my policy is not to provide provision at all. Providing a provision and not providing a provision is a policy. You provide a provision with different percentages is all about estimation. Clear everybody? This is also very, very important where students confuse a lot. And also one more example, as you all people know. Method of depreciation. Straight line method, WDV method, production units method. This is accounting policy. But change from one method to another method is change in accounting estimate. Get the difference? Sir, what is method of depreciation, sir? It is accounting policy, amma. I would like to shift from one method to another method, sir. It is called as change in accounting estimate, amma. Why, sir? Because method of depreciation is an accounting policy as per accounting standard number 1. But which method is to be chosen depends upon the estimation on the pattern of generation of future economic benefits. If my future economic benefits are equal, I will be choosing straight line method. If my future economic benefits decrease, I will be choosing WDV method. So choosing a policy depends upon the estimation. So method of depreciation is an accounting policy, but change in method of depreciation is an accounting estimate. Pakka everybody? So now, who will be estimating, sir? Of course, management will be estimating through professional judgment. Who will be estimating? Through professional judgment. By considering the past circumstances, and also they will be considering the present situation, and then they will be creating 1% of provision. Clear everybody? Very, very important thing. Change in accounting estimate shall not be given a retrospective effect. It has to be given a prospective effect. As simple as such. Last year you have thinking that the provision is 4% enough. But current year, depending upon the current year situation, everything is changing. So you would like to consider a provision of 10%. For this thing, why the last year provision has to be altered? No. Clear everybody? Sir, can you tell at least like this? Last year you did not estimate properly and hence it is a prior period item. I mean to tell, last year how much is your provision? But current year you would like to change it to 10%. Okay, accountant is telling something that it is a prior period item because last year you did not estimate properly and current year your that figure is supposed to be changed. So it's a prior period item. Will you accept or not? That's a trash. That is obviously a trash. Reason being, estimate differs from time to time. If you have thought that it is a prior period item, it shows something you have committed a mistake, committed an error. But it is not an error. Basing on the last year circumstances, 4% is correct. Basing on the current year circumstances, 10% is also correct. Clear everybody? So that is change in accounting estimate. Now, change in accounting policy. So what is change in accounting policy, sir? As simple as such. Policy is nothing but method is getting changed. To tell you, what is this called? Valuation of inventory. It has to be valued at cost or NRV, whichever is. So now there are different methods for the cost price. Likewise, you are having weighted average method, FIFO method. LIFO is not considered as per AS2 kada. No, not revaluation. ఇన్వెంటరీ గురించి మాట్లాడుతున్నాం. అడ్జస్టెడ్ సెల్లింగ్ ప్రైస్ మెథడ్ ఆర్ రీటైల్ ఇన్వెంటరీ మెథడ్, specific identification method, like that many methods will be there. If at all they would like to shift from one policy to another policy or one method to another method, then we have to call it as a change in accounting policy. Biggest confusion where students will be having is all about, sir, AS1 you are having accounting policy, AS5 you are having accounting policy. Where is to be considered what? What is to be considered where? Listen. Consistency is defined as per AS1. Once if you have chosen a method, that method has to be followed consistently. It cannot be changed. Exception, it can be changed, dealt by AS5. Consistency is dealt by AS1. It cannot be changed and chaptundi. Exception, it can be changed. That is dealt as per AS5. Sir, when a policy can be changed, if any of the three conditions are satisfied. Number 1, better presentation of financial statements. Number 2, permitted by accounting standards. Number 3, permitted by law or statutes. Statutes of law or provisions of law. Clear everybody? Law is asking you to change. You have to change. Till now you are not following accounting standard at all, and hence you are following something like LIFO method. But you would like to follow AS2 now. So in AS2 you have come across the things that LIFO method is not there. So you would like to adopt weighted average method. Yes, now you have to change it for sure. And finally, it should have a better presentation of financial statements. Clear everybody? Disclosures are quite common, both as per AS1 as per AS5 also. Take care, huh? Consistency, follow the same method as per AS1. Exception, that can be changed as per AS5. Disclosures are quite common by both the standards. What are those disclosures, sir? Which policy is changed? Like example, valuation of inventory. Why it is changed? Permitted by standard or permitted by law or better presentation of financial statements. Because of the change in accounting policy, what is the effect on financial statements, sir? You have to show the effect on financial statements. Clear everybody? And if you are unable to quantify the effect, at least tell that we are unable to quantify the effect. Sir, what do you mean by effect on financial statement? If you are following the previous method, it would be 1 lakh. But if you have shifted it to the new method, it will become 1.2 lakh. How much is the effect? That has to be quantified. If you are unable to quantify, disclose the fact that we are unable to quantify the effect. And finally, there is no change in the current year due to change in policy, but there is a change in effect on financial statements in future years. In current year, due to change in policy, there is no effect. But in future years, there are effects. Then this has to be disclosed in the current year itself. Say for example, asset, something like, to tell you, following the previous method, you got 10,000. Also, when you shift to the new method, in the current year, you got 10,000. Whether under FIFO basis, you got 10,000 or specific identification method, you got 10,000. But in the next year, you would like to shift the method. Clear? Sir, old method FIFO, new method specific identification. Old method since FIFO, you got 10,000. New method specific identification, you also got 10,000. Even though there is a change in policy, current year there is no effect. But there may be an effect in future years. That has to be disclosed in the current year itself. Clear? Now, last and final. The following two things are not called as changes in accounting policies. Number 1, introduction of new accounting policy. Not at all a change because you are newly introducing that. Number 2, you are supposed to change the policy because the underlying principles are changing. Likewise, say for example, VAT is replaced with GST. So your business might follow some kind of accounting policies when there is VAT. But VAT is replaced with GST. So you have to change your policy at any cost. This is also not called as change in accounting policy. You are changing because the underlying principles are changed. So even this cannot be counted as change in accounting policy. Okay, everybody, there ends with the standard. So take care. Number 1, period items. Number 2, prior period items. Changes in accounting estimates, changes in accounting policies. Period items, items occurred in the period. Ordinary, extraordinary. Ordinary, general, exceptional. Prior period items, items of incomes and expenses relating to previous year found in the current year due to errors or omissions. Accounting estimate, estimation is something like not an exaction. It will be done by the management through professional judgment. Change in accounting estimate will be given a prospective effect but not a retrospective effect. Accounting policy, consistency dealt by accounting standard number 1. When it can be changed, dealt by accounting standard number 5. Permitted by accounting standard, permitted by law, better presentation of financial statements. The following two are not considered as change in accounting policy. Number 1, introduction of new policy. Number 2, change in accounting policy due to change in underlying principles. Clear, everybody? Now, change in accounting policy has to be given a retrospective effect. The effect is not discussed in AS5. Yes, effect is not discussed in AS5. But as per Ind AS, we can tell that there is a retrospective effect. Now, if management is confused, whether is it accounting estimate or accounting policy, they are confused. They don't know how it is to be treated. Then it is recommended to treat it as change in accounting estimate. Clear, everybody? If they are not sure of treating whether it is estimate or policy, it is recommended to consider it as change in accounting estimate. But that kind of situation will not arise for you at all. So this is the whole standard. And finally, this is not to be presented separately. Present separately, exceptional item, extraordinary item, present separately, present separately, present separately, present separately. Clear, everybody? All these items must and should to be present separately in the financial statements. Perfect, everybody? Let's have some of the examples. Sir, I'm not picking the regular examples. The questions or the elements that I'm picking, each and everything is having one different thing. So in first question, okay, yes, check out. It's a very good question. You have sold your land. You have sold your land. What is this item? Sale of land. Exceptional, extraordinary. Huh? Exceptional. Sale of asset, sale of investment, sale of land is an exceptional item. Now listen carefully. Bela Limited is selling the vacant land which it is not having intention to use it further, but it has sold the land to tide over the liquidity problems. Hey, normally sale of land is an exceptional item. Now this company is selling the land because to overcome the liquidity problems. Did you understand? They are having short of money. Money is not there. So to arrange the resources, they have sold the land. Which item is this? Extraordinary items. Normal sale of land is an exceptional items, but here it has happened to tide over the liquidity problems and hence it will become an extraordinary item. Pakka, everybody? So now is it possible to tell me, say for example, sale of land for 10 lakhs and they have got a profit of 8 lakhs. How much profit, Amma? 8 lakhs. And there is loss from another asset. Loss from another asset, 2 lakhs. So totally what is net loss? 6 lakhs is the net loss. Okay. 6 lakhs is the net profit. Now question. Is it required to show separately with profit on sale of asset and loss on sale of asset, or can it show one final figure? Set off or show separately? Set off or show separately? Show separately. Set off is not possible. Why? Because extraordinary items, exceptional items are to be presented separately. At last I told you, hope you have remembered, not needed to be presented separately. Exceptional, extraordinary, prior period, accounting estimate, accounting policies are to be presented separately. So how many policies are changed, or how many things that are to be presented separately, you cannot set off. You have to show separately. Clear, everybody? So that is what your first thing. Check out with this one, okay? Be careful. Fuel surcharge is billed initially at provisional rates. Finally, the final bill is received in October 2011 to September 2017 in February 2018. Period is 2011 to 2017. For this period, bills were done by the electricity department at provisional rates. Clear? At provisional rates. Final actual bill was received in February 2018. But you are accounting the same in 2018-19. Clear? Now answer. What is this item? Question is, that's it. Question is not at all having any other thing. Listen. Initially bills were done at an estimated rate. And you have received the final bill in February 2018. You have recorded the same in 2018-19. This is the question. Now face this question. What is this? Prior period item. Why? For which year it is prior period item? 18-19, 17-18. Perfect. Point here is that in February 2018 you have got a bill that has to be accounted in February 2018. That is the financial year 17-18. Correct or wrong? But you are accounting the same in 2018-19. Even though there is a reliable information available in February 2018, that was ignored and recorded in the next financial year. And hence, it is a prior period item for the year 2018-19. For 2017-18, you cannot tell that it is prior period item. Reason being, it is not our mistake. Fuel electricity bill by the state electricity board is given you at an estimated rate, and it is giving you the final bill in February 2018. So it's not your mistake. It is the estimation done by the electricity board. So you cannot consider it as an prior period item for the financial year 2000. Hope you have understood. Sir, initially it is done at an estimated rate. We are not telling that. State electricity board has done at a provisional rate. So it is not our mistake, it is their mistake, absolutely. And hence we cannot consider it as an estimation. We have received the actual bill in February 2018. So you have to do the same in February 2018. Pakka? Fine. And moving on to the next thing. So, see, you will be provided with different alternatives. I mean to tell, in accounting standard number 4, in accounting standard number 5, he will be asking 1, 2, 3, 4, 5. He'll ask you to classify. Is it adjusting event or non-adjusting event? He will give some examples, simply like. Likewise, I have asked you some of the examples. Loss of stock due to fire accident. Loss of stock due to stock manipulation by the storekeeper. Like that, he'll give some of the points. He will just ask you to give the final conclusion. Explanation is not needed. These kind of problems are frequently tested in the examination. So even though you are not having command on the whole concept, now you are supposed to get the command on the whole concept, because 5 bits, 5 marks. No need to give explanation. Final answer is enough. And also he will ask whether is it extraordinary item or exceptional item or ordinary and general or prior period item like that. He'll simply give you classify the following items as per AS5, classify the following items as per AS4, like that he'll give you. Clear everybody? Sir, one last point would like to tell you, just would like to enlighten you. Negotiations, changes in market conditions are not amount to conditions as per accounting standard number 4. Forgotten? Giving you a clarity. Negotiations does not amount to condition. To tell you, as at 31/3/2011, our company is discussing with the party for purchase of land. I am telling that I will pay 10 lakhs. He is asking to pay 20 lakhs. Some discussions are going on. Clear? Can this be treated as condition? No. Negotiations are not treated as conditions. So negotiations finalized. Negotiations finalized. Finally, we both have agreed that the payment will be at 18 lakhs. Yes, now it will be a condition. Take care. Negotiations does not amount to condition. But negotiations once finalized will be treated as a condition. And next is changes in market conditions. Likewise, I have purchased an investment. As on 31/3, cost is 100, market price is 80. But my books were finalized on 31/7, where the cost is 100, market price is 92. Do I need to consider 80 or 92? Understood with the question? Year ending 100 or 80. Date on approval 100 or 92. I know that cost or market value, whichever is lower. But what is that I have to consider? 80 or 92? 80, not 92. Reason being, you are preparing the financial statements as at the balance sheet date. So you have to consider only the conditions existing on the balance sheet date. Sir, it had become 92 because of future market conditions, but not the condition as on 31/3/2011. ఆ రోజు ఉన్న కండిషన్కి ఆ రోజు ప్రైస్ 80. తర్వాత కండిషన్స్ మారడం వల్ల అది 92కి వచ్చింది. So as it the condition existing on the balance sheet date, it is only 80. But since the future condition is changed, it had come to 92. Clear everybody? So this is the final submissions with respect to AS4 and AS5. Negotiations does not amount to conditions, but once negotiation is finalized, it can be treated as condition. Changes in market conditions are not to be considered as a condition existing on the balance sheet date. Actually, it's good, but we are running behind one standard, that is AS24. Okay. So in the next session, we are going to continue with our standard with the main course, that is AS19. Of course, we are behind one standard. Let us deal with standard at the end point. Clear everybody? Fine. In the next session, we will go with accounting standard number 19. So take care and get ready. After break, we'll meet. So as I told you, let's go with some important standards or the lengthy standards. So let us start with the next standard, that is all about accounting standard number 19. So in this session from 11 to 1, let's try to complete 3 standards. But this time we have to be a bit sure about completing these 3 things. One is like 19, 17 and 18. Okay, so accounting standard number 19, which is nothing but leases. Okay, so as you all people know that there are 2 parties for leases. Number 1 is lessor, number 2 is lessee. Who gives the asset on lease? Who takes it on lease? So lease is a contractual arrangement or contractual agreement between 2 parties called lessor and lessee upon, very very important, transfer of right to use. What is transfer, amma? Right to use. I'm not transferring my asset wholly to him. I'm transferring my asset for right to use upon accepting certain payments. That payment might be either in series or in lump sum. Either totally payment will be at one time or series basis, lease rental basis. That is what all about in a simple concern leases is all about. So lease is a contractual agreement or contractual arrangement between two parties, lessor and lessee, wherein who will transfer the asset? For what the asset is transferred? Right to use. To whom it will be transferred? Lessee. In return, lessor will be expecting some payments, consideration. It might be either in series of payments or lump sum. Clear, everybody? Now, sir, accounting standard number 19 is applicable for both the parties, lessor and lessee. Accounting in the books of lessor and accounting in the books of lessee also. Unlike AS7, AS7 is applicable only for contractor but not for contractee. So unlike AS7, AS19 is applicable for both the parties like lessor and lessee. Clear? So now moving on to the next thing. AS19 is not applicable for lease agreements on land. I'm just highlighting some of the things here. Actually, there are three non-applicabilities. Number one is lease agreements on land is not applicable. Lease agreements for natural resources and what is it called? Renewable resources and non-renewable resources. Likewise, agricultural products, forestry products, or mines, minerals, extraction of mines, extraction of minerals, etc. and etc. AS19 is not applicable for all those things. Clear? If you have taken a mango orchard or mango plantation for a lease, AS19 is not applicable for that. If you have taken a lease for extraction of mines and minerals, AS19 is not applicable for that. Clear, everybody? And also AS19 is not applicable for land. And remember, you might have heard these words: motion picture films, video recordings, manuscripts, etc. and etc. For all these things also AS19 is not applicable. To tell you, there are some specific words like here: motion picture films, which is nothing but cinemas; video recordings, which is nothing but short films, or you might have heard the word documentaries, those things; plays or dramas. Likewise, Gurajad Apparao Kanya Sulkam, it's a playlet, it's a drama, it's applicable only to him. And next is manuscripts, which is nothing but handwritten books. For all these things, accounting standard number 19 is absolutely not applicable. Also, my dear children, for all the intangible assets like patents, copyrights, etc. and etc. If you have taken even this one, satellite rights, OTT rights, now popularly called as OTT. I mean, like something like, say for example, one movie will there in only one OTT platform. Likewise, KGF is there in Amazon Prime. For that, they have to pay some amount. It's a kind of lease, but for which AS19 is not applicable. Clear, everybody? Also, if you know, some of the museums will be having this word which is used by, say for example, Chhatrapati Shivaji. Say for example, that is there in Salarjung Museum. They may take it under lease for 5 years. After 5 years, that word will be in some other museum. They will be purchasing that for another, say, 10 years or 5 years. Even for all these kind of things, AS19 is not applicable. Clear, everybody? So simply AS19 is applicable for all the regularized assets. Clear? So now moving on to the next thing. Whenever we call the term leases, there will be two terms. Number one is cancelable lease. Number two is non-cancelable lease. A lease which can be cancelled during the lease period, we will call it as cancelable lease. A lease which cannot be cancelled during the lease time is called as non-cancelable lease. Lease which can be cancelled, lease, cancelable lease. Lease which cannot be cancelled during the lease term, non-cancelable lease. Exception. Even non-cancelable lease also can be cancelled. Yes, non-cancelable lease can also be cancelled in the following 4 situations. Situation number 1, occurrence of remote contingent events. Say for example, in lessor premises, lessor is in such a premises where the earthquake occurred and hence asset destroyed. There is no asset, where will be lease? Initially, I have given my asset for carrying on the lease, but earthquake occurred in the premises of lessee and asset was destroyed. There is no asset. then where will be the lease? So occurrence of remote contingent events. So initially lessor given to lessee a particular asset for 5 years lease. During the 5 years he can never cancel that lease at any cost. But in the 3rd year, a remote contingent event, remote in the sense very less chances, contingent event in the sense may or may not come. Likewise, fire accident, earthquake, tsunami or something like that. So one contingent event had come due to which that asset was totally destroyed and ultimately the lease was cancelled because there is no asset and hence there is no lease. Which lease is this? Cancelable lease or non-cancelable? Non-cancelable. So we are learning exceptions under non-cancelable lease. We are learning under exceptions under non-cancelable lease. General rule, non-cancelable lease cannot be cancelled, sir. Exception, it can be cancelled, sir. What are the situations? Number 1, remote contingent events. Number 2, with the prior permission of lessor. Hey, who are you and who am I to decide this? Lessee is asking lessor, sir, we have entered into a non-cancelable lease, but now I don't want that. Please cancel. Lessor told, okay. Who are you? Who am I to decide? It is purely their interrelation. So lessor, with the prior permission of lessor, they have cancelled it. And hence it is obviously a non-cancelable lease. Clear everybody? Listen carefully, the 3rd one. Sir, you have entered into a new agreement or you have entered into a renewal of the agreement for the same asset or similar asset. Entered into either a new agreement or the renewal of the agreement for the same asset or similar asset. In the sense, old agreement is cancelled, am I correct or wrong? But you cannot tell that it is a cancelable lease, it is a non-cancelable lease. Say for example, lessee had taken a car for lease. Lessee had taken a car for lease. That car had already come to the board situation. Lessee had identified that and lessee told the same to lessor. Sir, the car is not working properly. Lessor told, it's okay. You just bring back the car. Let's enter into a new agreement for similar kind of another car. Old agreement stands cancelled. Entered into a new agreement for the similar car. Clear? It's not a cancelable lease. It is also a non-cancelable lease. Because old agreement is cancelled, in place of that immediately they have entered into a new agreement. Like novation. Terms and conditions of the agreements are changing, something like that. So take care, new or renewal agreement for the same or similar asset. Last and final condition, take care. At the inception of the contract. Sir, what is inception of the contract? Starting of the contract. Clear? At the inception of the contract, that is at the starting of the contract, lessor and lessee had entering into the terms and conditions that at whatever time lessee wants, he can cancel the lease. Provided upon cancellation of the lease, he has to pay the huge penalties. They have entered into the lease with a term and condition that whenever you want, you can cancel the lease. So whenever you want, you can cancel the lease is which lease? But along with that, one more statement is there. Whenever you want, you can cancel the lease provided you have to pay huge penalties. Clear everybody? Then automatically it will become non-cancelable lease. Pakka? So what is the lease? Lease is a contractual agreement or arrangement between dash is transferred in lease. Asset is transferred along with dash. Right to use, not the ownership. Pakka everybody? So in return, who will be expecting the payments? So the payments might be either in the form of series or in the form of lump sum. Pakka everybody? So lease is divided into 2 types. What is that? Cancelable lease. Lease which can be cancelled is called as. Lease which cannot be cancelled is called as. But non-cancelable lease can be cancelled in following 4 situations. Number 1, occurrence of remote contingent events. Number 2, with prior permission of lessor. Number 3, new or renewal of agreement for the same or similar asset. Last and final, upon inception of the contract itself, they have entered something that it can be cancelled at any time upon payment of huge penalties. Clear? Now, conclusion. For cancelable lease, accounting standard number 19 is not applicable. Only for non-cancelable lease, accounting standard number 19 is applicable. AS 19 is applicable for dash leases. AS 19 is not applicable for dash leases. I'll ask you a question. You tell me whether AS 19 is applicable or not. Listen very carefully. The terms and condition is something like that. Lessee can cancel at any point of time, provided he has to give 3 months prior notice to lessor. Clear, everybody? Lessee can cancel at any point of time, provided he has to give 3 months prior notice to lessor. Some people will tell it is a cancelable lease because lessor can cancel at any point of time. And some people will tell that it is a non-cancelable lease because lessee had taken prior permission from lessor. I don't know, I'm asking you the question. Clear? People who tell cancelable lease, they tell that it's cancelable because he can cancel at any point of time. Who tell non-cancelable, 3 months prior notice is to be given. So now finally tell me, how many cancelable? Can you please raise your hands? Cancelable lease anevallu. Only 4. Non-cancelable 6. Okay. Non-cancelable. All the remaining. And the answer, 200% correct. It's a cancelable lease. I've chosen this example. Reason being, prior permission is different from prior notice. They have written in their agreement, whenever you want, you can cancel the lease. But give me 3 months prior notice, not prior permission. After lessee giving prior notice, no, you cannot cancel the lease, I am not permitting. Who are you to permit? Already written in the agreement. Intimate me 3 months before. That's it. Prior notice is nothing but intimating before. So take care. Prior permission is different from prior notice. Prior notice is cancelable lease. Prior permission is because that is the exception. Clear, everybody? Now, AS 19 is applicable only for which leases? Non-cancelable leases. Very, very important. Listen very carefully. Non-cancelable leases are again divided into 2 types. Number 1, finance lease. Number 2, operating lease. So what is a finance lease and what is an operating lease? Sir, from lessor to lessee, asset is transferred. Will you accept or not? Asset is transferred in the sense possession is obviously transferred. Yes or no? Along with these 2 things, dash is also transferred. This is very important. What is that, Amma? Right to use. My question, is the ownership transferred? No. Ownership is not transferred. My question. Hope you have listened the word risk and rewards. Risk and rewards. So tell me, risk and rewards will be generally transferred along with ownership. Risk and rewards will be generally transferred with. But here, if risk and rewards were transferred along with the right to use, it is called as finance lease. Sir, only these 3 things were transferred. Risk and rewards is not transferred. Then it is operating lease. Clear, everybody? Sir, clear? Okay. So as per IS 19, what is the classification of leases? No. Listen carefully. Leases are classified into cancelable lease, non-cancelable lease. AS 19 is applicable only for non-cancelable lease, not for cancelable lease. So as per AS 19, leases are classified into finance lease and operating lease, not cancelable or non-cancelable. Hope you have got even this difference also, because at this point of time you are here to get the revision of each and everything and to know the peculiar points, not the regularized elements. Anyways, so sir, what is the classification of leases? Cancelable. As per AS 19, what is the types of leases? Finance lease and operating lease. Pakka, everybody? AS 19 is applicable only for whether it is finance lease or operating lease. Shall I proceed further? Sir, what is a finance lease? Dash is transferred in both the leases. Whether it is finance lease or operating lease, dash is transferred. Asset, possession, right to use. Of course, asset transferred in the sense possession is transferred. Along with this, right to use is transferred. Along with these, if dash is transferred, we will call it as finance lease. Whereas risk and rewards are not transferred in operating lease, but risk and rewards are transferred in finance lease. Shall I proceed further? Sir, how can we identify that the risk and rewards are transferred, sir? In the following 5 situations, we can tell that the risk and rewards were transferred. Shall I start now? Listen, very, very important. You may get a theoretical question also. State the conditions when a non-cancelable lease can be cancelled. 4 things. Remote contingent events, prior permission, upon inception of lease, new or same agreement. Now this one. Say the situations when a lease is to be considered as a finance lease. First one. At the end of lease, ownership is transferred to lessee. Hope you have remembered hire purchase. So in hire purchase, he has to pay for each and every installment. Am I correct or wrong? Ownership will be transferred only at the last installment is cleared. So hire purchase is a kind of finance lease. Hire purchase is a kind of finance lease. So at the end of lease term, at the end of lease term, what is transferred? Ownership is transferred to lessee. Pakka. That is first one. And second one, listen carefully. Sir, so decided at the inception of the contract. So decided at the inception. That means starting of the contract. They have decided that if lessee wants, there is an option to purchase. There is an option to purchase at the end of lease term. But in order to have this option to purchase, you should exist with reasonable certainty. There should be a reasonable certainty. So what is reasonable certainty? Maximum chances of purchasing. What is reasonable certainty? Maximum chances of purchasing. So now take care. At the inception of the lease, lessor is giving an option to lessee. Hey Mr. Lessee, if you want, you can buy my asset at the end of lease term. But I should have guarantee whether you will purchase or not. Lessee will obviously ask, how can I give guarantee, sir? Because it is at the end of lease term. As of now, I cannot give the guarantee. Then how to face that situation? As simple as such, you provide a tempting offer to the lessee. At the end of lease term, fair value is 1 lakh. But you just offer him at 30,000. Answer, sir. Will he purchase or not? Happily he will purchase. Even though he is not having, he will borrow and purchase. Correct or wrong? So that is what second point. So decided at the inception of the contract that lessee is having an option to purchase at the end of lease term. But for that there exists a reasonable certainty. Reasonable certainty in the sense maximum chances. For exercising this at a maximum chances, you give a tempting offer to the lessee. Likewise, offer him at a lesser price. Offer him at a lesser price. Pakka everybody? That is with point number 2. Shall I proceed further? Now point number 3. Very, very important. Present value of MLP is almost equal to fair value of leased asset. Present value of MLP is almost equal to fair value of leased asset. Even in this situation also, we will call it as finance lease. Sir, what is this one, sir? First of all, before this one, you have to learn what is MLP. What is MLP in general? Minimum lease payments. It includes the following. Listen carefully. It includes the following. Number 1, lease rentals. Number 2, bargain amount. Getting my point, everybody? Number 3, GRV. Bargain amount or additional amount. And number 3, GRV. Clear? MLP includes lease rentals, additional amount, bargain amount, GRV. 4 things will be included. Now what are the 4 things? Lease rentals, bargain amount, additional amount, GRV. Lease rentals, as you all people know, you have taken my asset on lease and hence for every month you have to pay some amount which is called as lease rental. So what is bargain amount? Did you remember this condition? At the end of lease term, who will pay? Lessee will pay some bargain amount. Am I correct or wrong? lessee will pay. I told you that if fair value is 1 lakh, offer him at 30,000. That 30,000 is nothing but bargain amount. Clear everybody? Additional amount. They have written in their agreement that at the end of each year you have to pay additional lease rent of 1 lakh. Some additional amount. And finally GRV, guaranteed residual value. To know this one, first of all you have to know residual value. What is a residual value, sir? Normally we know that residual value is at the end of economic life period. Say for example, if the lease term is 20 years, if the economic life is 30 years, you will call it as residual value at the end of 30 years. Because economic life of the asset is 30 years. But remember, as per AS 19, residual value is the value accrued to the asset at the end of lease term. What is at the end of lease term? So residual value is the value accrued to the asset at the end of economic life or lease term. Lease term, that is very, very important. Clear everybody? Now this residual value is divided into two types. Number one, GRV. Number two, UGRV. Guaranteed residual value, unguaranteed residual value. Sir, what is guaranteed residual value? Sir, guaranteed residual value is nothing but giving guarantee. Likewise, he has taken an asset which is costing 1 lakh at year 1. At the end of year 20, lessor is telling to lessee that you have to use asset in such a way that at the end of year 20, that asset should fetch an amount of 80,000. Lessor is telling to lessee, take the asset, use the asset. But remember, use the asset in such a way that at the end of 20 years, that asset should fetch a value of 80,000. Now lessee is telling, sir, I am very sorry. I will try to use your asset in such a way, but I can't give guarantee for the entire 80,000. I can give you guarantee only to the extent of 60,000. Guarantee given by lessee. How much is the guarantee given by lessee? 60,000. Now, on behalf of lessee, some other person also can give guarantee. Likewise, lessee company is a subsidiary company and holding company of that company is giving guarantee for another 5,000. Clear everybody? Lessee personally given guarantee for 60,000. On behalf of lessee, another person had given guarantee for 5,000. So what is total GRV now? 65,000. What is the total estimated residual value? Out of 80,000, how much is GRV? 65,000. So how much is UGRV? Remaining 15,000. But lessor is not yet satisfied. This project is a government project. This project is a government project. So government independently giving guarantee for lessor. Hey, this is not at all related to lessee. Government had given guarantee directly to lessor, not on behalf of lessee. Government had directly given guarantee to lessor, independent third party. Who is that called as a? To the extent of another 12,000. Clear? So take care. I have told you the example like, sir, what is the residual value at the end of lease term? How much is expected? Two types are there. Number one, GRV. Number two, UGRV. What is GRV? Guarantee given. UGRV in the sense no guarantee. Guarantee can be either given by or on behalf of lessee. Clear everybody? Sir, guarantee given by lessee on behalf of lessee. So what is GRV? 65,000. For whom, amma? Lessee. Sir, is UGRV connected to lessee? No. Because UGRV in the sense I am not giving guarantee. Why for me? So UGRV is not connected to lessee. But who is not satisfied? Lessor. Till now lessor had got a guarantee of 60,000 plus 5,000. Also guarantee had got to lessor from independent third party to the extent of another 12,000. Clear? So what is the total GRV to lessor now? 77,000. So how much is UGRV? 3,000. Clear everybody? Dash is not connected to lessee. No. First. Dash is not connected to lessee. UGRV. For lessee, what is the guarantee value? But for lessor, what is GRV? So GRV might be differ from lessee and lessor. Reason being independent third party. Pakka everybody. Now coming to MLP back. MLP includes lease rentals, bargain amount, additional amount, GRV. GRV to lessor is separate, GRV to lessee is separate. Clear everybody? These will be included in MLP. The following will be excluded from MLP. Number 1, UGRV. Repairs and maintenance. Reimbursement of taxes. These three things are excluded. What is the first one? UGRV. Repairs and maintenance, taxes. As simple as such, if you remember what are included, remaining are excluded. So what are included? Lease rentals, bargain amount, additional amount, GRV. What are exclusions, amma? UGRV, repairs and maintenance, taxes. Pakka? Okay. So take care. This is the concept only. So now you compute present value of MLP. You compute present value of MLP. It should almost equal to the fair value of leased asset. Say you have computed present value and it comes to 89,000, or say for example it comes to 98,000. Our fair value of leased asset comes to 1 lakh. Is it almost equal or not? Yes, and hence you can consider this as finance lease. Clear everybody? Hope you have remembered that we are learning the conditions for finance lease. And say for example present value of MLP comes to 52,000. Fair value somewhere at 1 lakh. Almost equal, almost half. So it is not at all considered as a finance lease. That is what condition number 3. Clear everybody? Present value of MLP is almost equal to fair value of leased asset. Now condition number 4. Asset is of specialized in nature. Asset is of specialized in nature, where lessor is purchasing the asset only for lessee. Asset is of specialized in nature, where the asset is purchasing by lessor only for the purpose of lessee. Say oil refinery plant is there. For oil refinery plant, you need some special equipment. That equipment, our business concern is there. Business is not ready to purchase that asset. It would like to take it on a lease. So it is having a deal with the outsider that you purchase the asset and you give it me for lease. Clear everybody? Instead of purchasing, it is taking the same asset for lease. So since it is a specialized in nature, automatically it will be treated as finance lease. Pakka everybody? Last and final condition, which is also an important condition, and that is all about, listen carefully, lease term covers major economic life. I told you something like economic life is 30 years. Lease term is like 25 years. Is the lease term covering major economic life or not? Yes, and hence it is considered as which lease? Finance lease. Okay, everybody? So take care. AS19 leases, cancelable lease, non-cancelable lease. AS19 is not applicable for cancelable, applicable for non-cancelable lease. It is divided into two types: finance lease, operating lease. Difference between these two things: risk and rewards is transferred in finance lease, risk and rewards is not transferred in operating lease. Finance lease, when risk and rewards will be transferred in the following 5 situations. Number 1, at the end of lease term, ownership is transferred. At the inception of contract, it was decided by lessor and lessee that there is an option to purchase. But for this, you should have reasonable certainty. So to have reasonable certainty, you have to provide bargain amount at a far lesser than the fair value. Third one, present value of MLP is almost equal to the fair value of leased asset. You can check out the same by considering 90%. Considering 90%. So present value say 80,000, fair value 1 lakh. How much is covered? 80%. So no need to consider it as a finance lease. I mean to tell, present value of MLP is almost equal to అంటున్నాం కదా. How much is that almost equal to? 90%. And next one is all about asset is of specialized in nature. And last and final, major lease term is covered under economic life. For this you can consider 75%. For life period 75%. For values 90%. Pakka everybody? If any of these conditions are satisfied, we will term it as a finance lease. Otherwise we will call it as an operating lease. Understood everybody? Now moving on to the next thing, accounting treatment. Finance lease. As simple as such, you have to assume as if the asset is transferred. Why? Because risk and rewards are transferred. Am I correct or wrong? So in finance lease, you have to assume that the asset is transferred. So what is a journal entry, sir? In the books of lessor and in the books of lessee. In the books of lessor, lessee account debtor to asset account. In the books of lessee, asset account debtor to lessor account. You have to record the same at what price? Listen very, very carefully, everybody. Sir, to tell you, it has to be recorded at, sir, there is some terminology here. So better to learn that terminology. You have to record the same at, ekadamma? Anybody? Net investment in lease. Net investment in lease is nothing but gross investment in lease minus present value of gross investment in lease. Clear? Okay. Inka clear ga cheppayali ante gross investment in lease minus UEFI, unearned finance income. What is unearned finance income, sir? Gross investment in lease minus present value of gross investment in lease. It's actually a typical terminology, but if you learn with common sense, it will become very, very easy. I'll tell you, listen. There is an asset, okay, and the cost price, sorry, cash price, if you would like to purchase the asset at the spot, you have to pay 1 lakh. Clear? Add interest. How much interest, sir? Say 20,000, you have to add whole over the period, and on a whole you have to pay 1,20,000. Hope you have remembered the concept of hire purchase. The same concept. What is cash price? 1 lakh. What is interest? What is the final price? Which is nothing but hire purchase price. Am I correct or wrong? Let us bring this concept into here. So check out very, very carefully, everybody. Sir, to tell you my whole gross investment in lease is nothing but 1,20,000. Will you accept or not? My total payments, gross investment in lease is nothing but like my total payments will be 1,20,000 minus unearned finance income, which is nothing but total interest. What is my total interest? So minus 20,000. Now, how did you get this 20,000, sir? Gross investment in lease minus present value of gross investment in lease. What is gross investment in lease, sir? 1,20,000. What is present value of this one, sir? Sir, present value of this is nothing but if you pay a spot, you have to pay 1 lakh. So difference between these two things is nothing but 20,000. పై నుంచి కిందది మైనస్ చేస్తే ఇది వస్తుంది, మళ్ళీ దాని నుంచి అది మైనస్ చేయమని చెబుతాడు అంతే. ఇఫ్ యూ చెక్అవుట్ హియర్ వాట్ హ్యాపెన్, 1 lakh plus 20,000 is equal to 1,20,000. Am I correct or wrong? Now check out. You have to record the same at net investment in lease. Net investment in lease is nothing but gross investment in lease minus unearned finance income. What is unearned finance income, sir? Gross investment in lease minus present value of gross investment in lease. So what is gross investment in lease? 1,20,000. What is present value of this deal, sir? 1 lakh, which comes to 20,000. So UEFI is equal to 20,000. What is gross investment in lease, sir? 1,20,000. So 1,20,000 minus 20,000 is equal to 1 lakh, which is called as net investment in lease. And if you observe another thing in here, nil is equal to ZIL minus unearned finance income. Unearned finance income is nothing but ZIL minus present value of ZIL. Now check out, it becomes something like gross investment in lease minus gross investment in lease minus present value of gross investment in lease, which is nothing but gross investment in lease minus gross investment in lease plus present value of ZIL. Cancel. So ultimately, yes, net investment in lease is equal to present value of gross investment in lease. Understood? That is the whole concept of your finance lease. Moving on to the next thing. Listen very carefully, everybody. Hope you have remembered the concept of hire purchase. Hire purchase gurtunda. And also you will be getting in FM like amortization table. Amortization tables. Likewise, you have to separate both principal and interest. You have to separate principal and interest, and you have to find present value. Clear? So that is a concept of your finance lease recording. See, I can't pick a whole problem and I can't show you the solving here because we are having lot more standards to complete, and I recommend you to solve this one because if you have remembered the concepts of hire purchase, you will be getting that, and you can take the value and you can solve that. Okay? Because just on this small thing, if you have spent around for 15 to 20 minutes, we might miss other areas of the standard. Anyways, let me proceed for operating lease. Sir, under operating, not operating lease, in the books of lessee, asset account debtor to lessor account. I told you initially like lessee account debtor to asset account. Am I correct or wrong? This one I have to record it at net investment in lease. Finally, net investment in lease is nothing but present value of gross investment in lease. This is absolutely fine. But now coming to here, you have to learn what is gross investment in lease. Very simple. MLP plus UGRV. Dash is not included in MLP. UGRV. But gross investment in lease includes both MLP plus UGRV. So now, asset account debtor to lessor account in the books of lessee has to be recorded at present value of MLP or fair value of leased asset, whichever is lower. In the sense, in lessor books it will be recorded at one price, in lessee books it will be recorded at another price. Reason is being of this UGRV. Present value of ZIL is nothing but present value of MLP plus present value of UGRV kada. But this present value of UGRV is not there for lessee because lessee is nowhere connected with UGRV. So he has to record directly at present value of MLP. But to have a check on prudence concept, you need to compare the same with fair value of leased asset and finally whichever is lower. Understood everybody? That is a concept of lessee. So just to conclude, so tell me the recordings in the books of lessor. Asset account debtor to lessee account, lessor account debtor to asset. Correct or wrong? Quite reverse. అది రివర్సే కదా. వాడు పడుకుంటున్నాడు, వాడికి ఏం అర్థం అవుతుంది నువ్వు బుర్ర ఊపినంత మాత్రాన. So tell me in the books of lessor, lessee account debtor to asset account. In the books of lessee, asset account debtor to, sir, it has to be recorded at net investment in lease, which is nothing but present value of gross investment in lease. GIL is equal to dash plus dash MLP plus UGRV. Coming to the books of lessee, it has to be recorded at present value of MLP or fair value of leased asset, whichever is lower. Pakka? Fine. Moving on to the next thing, quite common. Same things are very simple. Interest due. I have to receive from lessee. So lessee account debtor to interest account, or which is called as finance income account. Lessee has to pay kadandi, which is an expense to him. So interest or finance charge account debtor to lessor account. Finally, collect the lease rentals. Cash or bank account debtor to lessee account, and in the books of lessee, lessor account debtor to cash or bank account. This is purely similar to your hire purchase. Finally, depreciation. Depreciation will be claimed by lessee, lessor, lessee, because risk and rewards are transferred to lessee, and hence depreciation has to be claimed only by lessee. Pakka everybody? That is the end of your finance lease. Sir, I recommend you to solve a question. Only when you have solved a question, you will be getting it in a better understanding mode. Otherwise, you will not get this. Especially ఎవరైతే లీజర్స్ చాయిస్ అన్న కాన్సెప్ట్లో వదిలేసారో ఇప్పటి వరకు చెప్పిందంతా అర్థమవుతుంది, ఈ పార్ట్ మాత్రం అర్థం కాదు. That is 100% true. But if I had an enough time of 1 hour or half an hour only with this exclusive computation, I might have shown you. But that much time is not there, so I can show you the computations due to the limitation. Now, let me go for the next one. Operating lease. As simple as such, coming to operating lease, you just need to treat it as a general rental transaction. But while going with this general rental transaction, you have to consider the method of straight line or any other method which is relating to depreciation. Listen, I'll tell you. Say for example, there is a contract between lessor and lessee for 3 years. Contract is providing for year 1, year 2, year 3. Lessee has to pay 1 lakh, 2 lakhs, 50,000 for 3 years. Okay. Listen very, very carefully, everybody. Who are the two parties you are having? Lessor and lessee. Who is using the asset? Lessee. But who is claiming the depreciation in operating lease? Lessor. Reason being, risk and rewards are with lessor. Clear? Risk and rewards are with lessor. But and hence depreciation is also being claimed by lessor. But asset is used by. And hence, in order to have a proper expense on the asset, you have to amortize these lease rentals in proportion to depreciation. That is the pattern of generation of future economic benefits. If no specific method is there, you can follow straight line method. That is 1 lakh plus 2 lakh plus 50,000 divided by 3 years. Clear everybody? Or let me take it 3 years so that it will become easy. 3 lakhs. So 1 plus 2 plus 3 lakhs divided by 3 years, which comes to 6 lakhs by 3 years, every year 2 lakhs. Payment criteria is same, but amortization is 2 lakhs per annum. Clear? So please try to understand. Year 1, year 2, year 3. The payments are 1 lakh, 2 lakh, 3 lakhs. Since the risk and rewards are with lessor is claiming depreciation. But strictly speaking, lessee is using the asset. But he cannot claim depreciation. So, one and only one expense on that asset to lessee is lease rentals. So, amortize lease rentals in proportionate to depreciation. If no method is there, follow straight line method. 1 lakh plus 2 lakhs plus 3 lakh whole divided by 3 years, which comes to 2 lakhs per annum. I'll show you the journal entries. Check out. Cash or bank account debtor. First year lessor is receiving 2 lakh. First year he is receiving 1 lakh. But take care, to P&L account or to lease rentals account. How much lease rental is to be amortized every year, sir? 2 lakhs. So cash he is getting 1 lakh, but lease rent amortized will be 2 lakhs. Then that balance 1 lakh will be transferred to DLR, deferred lease rentals, or it can also be called as lease equalization. Okay. So now in the books of lessee, lease rent I am paying. How much you are paying? 1 lakh, sir. But amortization 2 lakhs. Difference 1 lakh is to be transferred to DLR account or lease equalization. Thereby lease rent will be closed and transferred to P&L account. That is quite common. Clear? Sir, second year I don't like to write the entry because payment 2 lakhs hai, lease rent 2 lakhs hai. So cash or bank to lease rent 2 lakh, 2 lakh, lease rent to cash or bank 2 lakh, 2 lakh. But take care, for the third year I am getting an amount of 3 lakhs. But what is my lease rent, sir? Only 2 lakhs. So remaining 1 lakh has to be transferred to DLR. Now check out in the books of lessee. What is your lease rent amortization? 2 lakhs. What is your payment? 3 lakhs. What about remaining 1 lakh? DLR. So check out, at the end of lease term, whatever this DLR is there, it will be obviously closed. Credit, debit, debit, credit. Clear everybody? That is the concept of operating lease. Okay. So operating lease is very simple. Same amounts will be the payment, but amortization is different. So you have to follow the depreciation method. If there is no depreciation method, follow straight line method. That's it. Clear everybody? Now moving on to the last and final concepts of lease. That is all about sale and lease back. Would like to discuss sale and lease back with operating lease, because that is very, very important. So listen, sale and lease back with operating lease. So it's all about one party will be selling, another party will be purchasing. Say for example, Mr. A and B. A sold the asset to B. A is called as seller. B is called as buyer. Again the same asset is given back to lease to Mr. A. So B is called as lessor, A is called as lessee. This is for the purpose of financing. So for your kind information, seller, lessee, buyer, lessor. Okay. Seller will become lessee, buyer will become lessor. Now, very important. Sir, to find profit or loss, you need book value and selling price. To find profit or loss, you need book value and selling price. But how this profit or loss will be amortized? You have to compare selling price and fair value. Clear everybody? So these two things to find profit or loss. These two things to how to record that profit or loss. Whether this has to be recorded at once or will it has to be amortized. That is the concept of your sale and lease back with respect to operating lease. Okay. So now there are different cases. To tell you the case number 1. If selling price is equal to fair value. So remember, concept is that up to fair value there is no problem. Up to fair value there is no problem. So point number 1. If selling price is equals to fair value. If selling price is equal to fair value. Very, very simple. Whether it is profit or loss, it has to be recognized immediately. Case 2. If selling price is less than fair value. If selling price is less than fair value, I already told you up to fair value no problem, right? So if selling price is less than fair value, if profit, it has to be immediately recognized. If loss, if lease rent compensates, you have to amortize. If lease rent does not compensate, you have to immediately recognize. Sir, what do you mean by compensation of lease rentals? Very, very simple. Sir, fair value 1 lakh. Fair value how much? 1 lakh. But you are selling only for 60,000. Sir, if my asset fair value is 1 lakh, am I a fool to sell it only for 60,000? No. I am expecting future reduction in lease rentals. Because, see here, A is selling to B. When the market price is 1 lakh, A is selling it only for 60,000. So automatically A is getting a short of 40,000. Correct or wrong? Then obviously A did not get the money as he expected. But he is not a fool. He would get the same as a compensation in lease rentals. Say the market lease rentals are 10,000, but now he will ask that he will pay only 6,000. Since he sold for lesser price, he will be paying the lesser lease rentals. Clear everybody? If this has happened, we will call it as compensation. Otherwise, we will not call it as compensated. Even though the selling price is 60,000, the lease rental will be 10,000. Then lease rent is not compensated. Clear? If selling price is less than fair value, profit immediately recognized. Loss, if lease rent compensates, amortize. If lease rent does not compensate, immediately recognize. Now third one, If selling price is greater than fair value, then up to fair value, immediately recognize. If selling price is up to fair value, immediately recognize. Whatever in excess of fair value is there, it has to be amortized. These are the conditions. Clear, everybody? Above all, before checking out these three conditions, you have to apply one common condition. That is all about compare your book value and fair value. If your book value is greater than fair value, bring down your book value up to fair value. If your book value is 1 lakh, but fair value is only 80,000, then immediately write down this 1 lakh to 80,000 and 20,000 will be immediately charged to P&L account as loss. Hey, reverse is no need to consider. If book value is less than fair value, then that is not needed to consider. Here your concept is applicable only when your book value is greater than fair value. Clear, everybody? So check out, we'll be telling you the conditions. Sir, in accounting standard number 19, you may get 2 theoretical questions. Conditions for non-cancelable lease, when it can be cancelled. Conditions for finance lease. And next is all about amortization table. I told you we are not having enough time, you just practice the same. Gross investment in lease is equal to MLP plus UGRV. Net investment in lease is nothing but present value of gross investment in lease and present value of MLP. Inclusions of MLP, lease rentals, additional amount, bargain amount, GRV. Exclusions, UGRV, repairs and maintenance, taxes. Also there is another concept called contingent rent. That is also excluded. Contingent rent is nothing but rent which may or may not be paid. That is called as contingent rent. Clear, everybody? Fine. Now, next concept. This is the first testing. Theoretical, those 2 things. Next is all about whatever the concept that I taught you till now. Third is all about sale and lease back. On this, we will do an example for sure. So, check out for your kind information, my dear children. Sir, first you have to apply common condition. What is common condition? If book value is greater than fair value, bring down book value to fair value. Loss which has to be immediately recognized. Next, 3 values. Selling price, book value, fair value. Sorry. Yeah, nothing great, but this is the best alternative. Book value and selling price to find profit or loss. These 2 things to recognize profit or loss. Condition number 1. If selling price is equal to fair value, profit or loss, immediately recognize. Condition number 2, selling price less than fair value, profit, immediately recognize. Loss, if lease rent compensate, amortize. If lease rent does not compensate, no need to do the amortization, recognize immediately. Condition number 3, if selling price is greater than fair value, up to fair value, immediately recognize. Greater than fair value, amortize. Clear, everybody? So let's go with ACE 19 questions. Yeah, this one. So check out carefully. WDV. More WDV is nothing but book value. And yes, given each and every situations. Sold for 50 lakhs. Let us analyze each and every situation. Shall I start now? Check out. What is selling price? Is equal to fair value. So, what is common condition? Book value greater than fair value. What is book value? 40 lakhs. What is fair value? 50 lakhs. 40 lakhs. Not greater than. So, no need to apply this condition at all. And given that selling price is equal to fair value. Selling price is equal to 50 lakhs. Fair value is equal to 50 lakhs. So profit or loss, whatever is there, you have to immediately recognize. What is book value, sir? 40 lakhs. What is selling price, sir? 40 lakhs. Sorry, 50 lakhs. Profit or loss? Profit. Because 40 is sold for 50 kada. How much is the profit? Immediately recognize. Clear, everybody? Now let us check out second one. Fair value 60 lakhs, selling price 50 lakhs. Check out. Sir, again same condition. Book value 40 lakhs, fair value 50 lakhs. Sorry, fair value 60 lakhs. Again same. Book value is not greater than fair value. So no need to apply the common condition. Next one, compare dash and dash. Selling price and fair value. How much is selling price? 50 lakhs. How much is fair value? 60 lakhs. So what is the condition, Amma? Selling price is less than fair value. If selling price is less than fair value, profit immediately recognize, loss lease rent compensates, amortize, lease rent does not compensate, immediately recognize. Now check out what is the profit or loss. 40 lakhs is sold for 50 lakhs. Profit or loss? Profit. And hence profit has to be immediately recognized. Clear everybody? Now condition number 3. What is fair value? What is selling price? Okay. So tell me book value, selling price, fair value. Book value. Selling price 38 aega. Okay. Fair value 45 lakhs. Sir, our condition book value greater than fair value. 40 is not greater than 45. No need to apply common condition. Check out profit or loss. 40 is sold for 38. Profit or loss? Loss. How much is the loss, Amma? 2 lakhs. And next one is all about comparison between selling price and fair value. Check out very carefully everybody. Selling price is less than fair value. If selling price is less than fair value, loss 2 lakhs. If it compensates, you have to write like that itself. If the lease rent compensates, immediately if the lease rent compensates, amortize. If the lease rent does not compensate, immediately recognize. Clear everybody? And moving on to the next two things. Let us do these two things. Point number E. Fair value 46, selling price 50. So tell me again book value 40, selling price 50, fair value 46. If you check out again same, 40 is not greater than 46, so no need to apply the common condition. Before doing each and every point, first of all you have to check out the common condition. Now check out these two things. 40 sold for 50, 10 lakhs profit. Now you check out these two conditions. Selling price is greater than fair value. So up to fair value, immediately recognize. In excess of, amortize. So now you check out. So what is selling price? What is fair value? 46 lakhs. In excess of fair value, how much is there? 4 lakhs. Correct or wrong? So this has to be amortized. What is the total profit? 10 lakhs. Out of this 10 lakhs, 4 lakhs has to be amortized. So remaining 6 lakhs has to be immediately recognized. Hope this is clear for you. Total profit 10 lakhs. Condition is selling price is greater than fair value. In excess of fair value is 4 lakhs. That 4 lakhs has to be amortized. Total profit is 10 lakhs. Out of 10 lakhs, 4 lakhs has to be amortized. Balance 6 lakhs has to be immediately recognized. Clear? And next one. Check out. Fair value 35, selling price 39. So book value is equal to 40 lakhs. Selling price is equal to 39 lakhs and fair value is equal to 35 lakhs. Hey, check out now. Book value greater than fair value. So you have to apply common condition. Bring down book value to fair value. How much is that? 5. Yes, 5 lakhs. 40 to 35. 5 lakhs loss which has to be immediately recognized. Clear everybody? Now your revised book value comes to 35 lakhs. Since already you charged this 5 lakhs as loss, you should not consider this one. You have to consider the new book value, that is 35 lakhs. And selling price is equals to 39 lakhs. Fair value is equals to 35 lakhs. Check out profit or loss. Profit. How much is the profit? 4 lakhs. Condition. Selling price is greater than fair value. How much is greater than fair value? 35 to 39. 4 lakhs. And hence this entire profit has to be amortized. So for the last one, two things we got. Number 1, loss 5 lakhs immediately recognized. Profit 4 lakhs amortized. Clear everybody? That is the end of your leases. Thank you for your extended cooperation. Because in the meantime, coming to leases, whoever had left it for choice, they will not understand it at any cost. Likewise, the concepts of accounting treatment, gross investment in lease, net investment in lease, that is actually a bit different one. But this is easy. అంటే ఇప్పుడే నేర్చుకునే వాళ్ళకి కొంచెం కష్టం, బట్ ముందు ఆల్రెడీ మీరు ష్యూర్ అయితే చాలా ఈజీగా రివిజన్ అయిపోతుంది. క్లియర్ ఎవ్రీబడి? సో జస్ట్ గెట్ రెడీ. వీఆర్ గోయింగ్ టు స్టార్ట్ అకౌంటింగ్ స్టాండర్డ్ నెంబర్ 17 విత్ ఇన్ ద నెక్స్ట్ 2 to 3 minutes. ఇన్ ద మీన్ వైల్ దీంతో స్పెసిఫిక్గా ఏమైనా డౌట్స్ ఉంటే యూ కెన్ ఆస్క్. సో షల్ ఐ స్టార్ట్? సో అకౌంటింగ్ స్టాండర్డ్ నెంబర్ 17, segment reporting. So very easy standard. Very easy standard. There will be some definitions and there will be some tests. If you have completed those two things, this standard gets completed. And it is all about segment expenses, segment income, segment revenue, that is nothing but segment income, segment assets, segment liability, segment result. These are the main things. But before that, what is a segment? Segment is nothing but a division of an enterprise. Segment is nothing but division of an enterprise. That division might be of two types. Number 1, business segment. Number 2, geographical segment. Business segment is nothing but your line of business is considered. Business segment is nothing but your line of business is considered. But geographical segment in the sense areas of operations. To tell you in a simple word, business segment either product or service, geographical segments areas of operation. Tata group of companies are having different segments. Likewise, they were into FMCG sector like Tata Salt, okay, etc. and etc. And also they were into financial sector like IndiCash ATM. They are into online sector which is called as Tata Click. Getting my point, everybody? Even Tata is also there in consultancy services, which is a software sector. So all these are nothing but business sectors of Tata, business segments. Now coming to the next one, geographical segment. Tata is operating in India. Tata group of companies are also operating in US. Tata group of companies are also operating in Singapore, which is nothing but areas of operations. Again, coming to these areas of operations, there are two types. Number 1, location of assets. Number 2, location of customers. Likewise, Tata is operating with a branch established in US. Location of assets. Tata is selling their services to Singapore, which is called as location of customers. Be sure with this thing first. Business segment, geographical segment. Business segment is nothing but product or service. Geographical segment is nothing but areas of operation. Location of assets, location of customers. Location of asset in the sense you are having branch there. Location of customers in the sense just you are selling. You are just having customers, no branch there. Clear, everybody? Now biggest question. Can two different segments, geographical segments within the same country? Yes. Sir, what is the hardest thing that you need to classify it as two separate segments? Risk and rewards. So for example, if you take the company of Hindustan Pencils Private Limited, it is selling sharpeners, it is selling scale, it is selling erasers. Can you tell that three things are three different segments? Obviously no. Everything we will call it as stationery. It is one single segment. Clear, everybody? Because risk and reward of pencil is not highly differ from the risk and reward of an eraser. But take care, risk and reward of software is 100% differ from risk and reward of petroleum. And hence, if you are operating in both software sector and petroleum sector, two things has to be classified as two different segments. Clear, everybody? So business segment is all about that one. You have to check out different products and different services, and you have to check out the risk and rewards. You have to check out the risk and rewards. Coming to the next one, geographical segments, areas of operation. Remember, if we are having one branch at Vishakhapatnam and another branch at Guntur, no need to classify these two things as two different segments, because almost the risk and rewards are obviously same. Sir, if you are having one branch at Guntur and having another branch at Bangalore, even though no need to classify it as a different segment, because risk and rewards are almost same. Don't think that the language is same. Language is not same. Political barriers are there, because free entry and free exit is there. Getting my point, everybody? But take care and listen carefully now. You are having one branch here and you are having another branch in agency area. Something like Naxalism area or Maoist area. Then obviously you have to treat these two things as different segment, because here the purchasing capacity is different, there the purchasing capacity is different. Here the public interest is different, there the public interest is different. Getting my point, everybody? Now to tell you another example, something like eastern places of India, like Assam, Mizoram, Nagaland, etc. and having one branch at Tamil Nadu. Yes, two things or two different segments. One branch in Andhra Pradesh, one branch in Tamil Nadu, not different segments. Reason being, Tamil Nadu is comparatively developed, Andhra Pradesh is also comparatively developed, and the political barriers are not much and the legal elements are same. Getting my point, everybody? But if you have taken the eastern part of India, it is less developed. The geographical segment risk and reward is totally different. Risks of Andhra Pradesh and Tamil Nadu are almost same. Rewards from Andhra Pradesh and Tamil Nadu are almost same. But risk and rewards of that eastern parts of India is not same. You might have been observing on some products that 10 rupees for all something like for the states of Karnataka and Mizoram, something he will be writing, and 12 rupees rest of India. Did you ever come across with this situation? On the same product, he will be giving two prices. Yes, two MRPs. Reason being, risk and rewards are totally different. Clear, everybody? So that is a concept of segment on a basic note. So tell me, what is a segment? Division. What are the two kinds of segment? Business segment, geographical segment. Again, dash and dash. Location of assets and location of customers. Business segment is nothing but dash. Product and service. Geographical segment is nothing but areas of operations. If you are having one in India, one at Singapore, one at UK, obviously three different countries, three different risks, three different rewards. So you can take it as different segments. If within the same country also sometimes there is possible to have different segments. Likewise, Naxalism area risk is more, Maoist area risk is more. Here the risk is different, the rewards are different, and hence two different segments. Less developed area risk is different when compared to the developed area. So two different segments. Clear, everybody? Fine. Moving on to the next thing. Sir, what includes in the segment items? Segment items, whether it is segment expense, segment income, segment revenue, segment asset, segment liability, inclusions are as follows. Number one, all the operating items will be included. All the financing and investing items will be excluded. Those assets or those liabilities which are used in due course of business shall be considered. Those assets or liabilities which are not related to due course of business shall not be considered. What is the first inclusion? Operating items. What are exclusions? Financing and investing items. Say for example, sales, operating, included. Interest paid, financing, excluded. Dividend received, investing, excluded. Clear, everybody? Purchases, included. Salaries, operating, included. Income received, if it is operating, include. If it is investing, exclude. Rent received, rent will be received on the investments of land and building. So rent received is an investing item. So include or exclude? Exclude. Clear, everybody? So that is the first one. Next, listen very carefully. You are having an asset. Say for example, you are having a building which is used for office purpose. Building 1 used for office purpose. Building 2, you are using the same for investment purpose. Which building will be counted as segment asset? Building 1, this is segment asset. Whereas building 2 is not a segment asset. Clear everybody? Sir, understood? So take care. There are two buildings. Building 1 which is used for office purpose. Since it is relating to due course of business, you will be calling it a segment asset. Building 2 is used for investing purpose. Since it is used as investing purpose, this is not at all included. Clear everybody? So tell me, what are the first inclusions? Operating items. What are the first exclusions? Financing and investing items. What is another inclusion? Relating to due course of business and not relating to due course of business. Clear everybody? Sir, listen very carefully and answer. You have purchased an asset which is for investing purpose on a credit basis. So is that creditor included in a segment liability? Hope you have got the question. Purchased an asset on credit basis and that asset is for investing purpose. Is that creditor included in segment liability? No. Purchase of goods on a credit basis. Is that creditor included? Yes, because goods is nothing but due course of business. Pakka. Purchase of asset is for due course of business and on a credit basis. Now is that creditor included or not? Yes. Why? Because it is relating to due course of business. Understood everybody? Next one. Listen very, very carefully everybody. So we will be dealing something like direct expense or direct revenue, allocable expense or allocable revenue, inter-segment expense or inter-segment revenue will be included. Direct revenue, I am selling directly to the outside customer. Allocable revenue, head office is allocating the revenue to all the other segments. Inter-segment revenue, one segment is selling to another segment. These three things will be included. What are the three things? Direct, allocable, inter-segment. Hey, what are the three things, Amma? Direct, allocable, inter-segment. And what are the exclusions? Listen, tax assets are excluded. Tax related items. Not only tax assets, tax related items all are excluded. Provision for tax, current tax, advance tax, TDS, deferred tax assets and deferred tax liabilities are also excluded. Tax related items, and remember, extraordinary items are also excluded. What are another items, Amma? Extraordinary items are also excluded. Clear everybody? This is what segment definitions, inclusions and exclusions. So tell me what includes in segment items. Number 1, operating items. Number 2, due course of business. 1, 2, 3, direct, allocable, inter-segment. Likewise, if he is asking expense, direct expense, allocable expense, inter-segment expense. Direct revenue, allocable revenue, inter-segment revenue. Clear everybody? And exclusions, financing and investing items which are not at all relating to due course of business, tax related items, extraordinary items. Clear everybody? These are excluded. Okay. Now moving on to the next one. Very, very important. Tests. This is very important for entire AS17. There are totally 5 tests. If any of the tests are satisfied, that segment has to be separately presented. Otherwise, no need to present separately. Likewise, a particular company is having 10 segments. A particular company is having 10 segments. It is highly difficult to prepare for each and every segment separately. So you have to go with the tests of segments as per accounting standard number 17. If as per accounting standard number 17, any of the following tests are satisfied, then it is recommended for that particular business concern to present the segment separately. Shall I start now? Take care. Test number 1. Segment revenue test. What is test number 1? Segment revenue test. Segment revenue should be greater than or equal to 10% of total segment revenue. Whichever segments are satisfying this condition, this is to be reported. So just check out this example. Segment revenue. Answer me. External sales is nothing but direct sales. Included or excluded? Inter-segment sales. Yes. So totally point number 3 segment revenue they have given. After adding external sales and inter-segment sales, they have given this one. Clear everybody? What is our condition? Segment revenue should be greater than or equal to 10% of total segment revenue. What is the total segment revenue? Into 10%, which comes to 60. So whatever segments revenue is more than 60, all those are to be treated as separate segments, presented separately. Check out 100. Yes, it is more than 60. 315. Yes. Check out 45, 15, 15, 50, 25, 35. Not more than 60. So what are to be reported separately as per segment revenue test, amma? A and B. Pakka everybody? That is what your test number 1. Test number 2. Segment result test. What is test number 2, amma? Segment result test. Listen carefully. Condition is same. Segment result should be greater than or equal to 10% of total segment result. But total segment result is total segment profits or total segment losses, whichever is higher. Clear? So tell me, what is segment revenue test? Segment revenue test. Segment revenue should be greater than or equal to 10% of total segment revenue. Test number 2, segment result test. Segment result should be greater than or equal to 10% of total segment result. Total segment result is equal to total segment profits or total segment losses, whichever is higher. Shall I start now? Check out. Segment result given here. Listen very carefully. 5 minus 90 plus 15 minus 5 plus 8 minus 5 plus 5 plus 7 is wrong. Total segment result ante you should not add the profits and you should not deduct the losses. Find the total segment profits. How much is the total segment profits here? 5 plus 15 plus 8 plus 5 plus 7. 40. And total segment losses. 90 plus 5 plus 5. 100. Whichever is higher. Tell me whichever is higher, amma. 100. So now you have to check only with this 100. So total segment result is equal to 100 multiplied by 10%, which comes to 10. Start checking with 10 finally. 5. No. 90. Yes. Sir, stop checking whether it is profit or loss. You need only number, that is 10. More than 10 or less than 10. That's it. More than 10. More than 10. Not more than 10. No, 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 no. And finally, what are to be disclosed? Sir, from first test you got A and B. From second test you got B and C. So totally till now what are to be reported separately? A, B, C. Clear everybody? Sir, very simple. Segment result test. Segment result should be greater than or equal to 10% of total segment result. Total segment result is equal to total segment profits or total segment losses, whichever is higher. Clear everybody? That's it. Please don't check out whether it is profit or loss. Number is important. More than 10. That's it. Plus 10 now, minus 10 now, those all are not necessary. Next, test number 3. Segment assets test. Segment assets test is nothing but segment asset should be greater than or equal to 10% of total segment assets. So check out your total segment assets now. So total segment assets given 100 into 10% is nothing but 10. More than 10? Yes. C? No. D? Yes. 3, 5, 5, 9. Less than 10. So what are to be reported? A, B, D. Finally, from all the 3 tests, what are to be reported? A, B, C, D. What are not reported till now separately? E, F, G, H. Clear everybody? That is all about test number 3. Now test number 4, management discretion test. That is their wish. If they wish, they will pick any segment to report separately. Likewise, hope you know about ITC, Imperial Tobacco Company. Initially, its business is to do with tobacco, but later on diversified a lot, and now it is going with hotels business on a major concern. Correct or wrong, sir? For your kind information, if at all management of ITC have decided to show their tobacco division separately, even though it is not satisfying any of the tests, they can do so. Management discretion in the sense their wish. If they wish to show separately, they will show separately. That is test number 4. So now listen very, very carefully. Test number 5. Overall revenue test. What is test number 5, Amma? Overall revenue test is applicable only for external revenue. Is applicable only for, listen everybody, hope you have remembered segment items included. What are the 3 things that are included? Direct, allocable, intersegment. Direct, allocable, intersegment. So external revenue in the sense revenue to the outsiders or revenue from the outsiders. But check out this intersegment. Is it revenue from the outsiders? So test number 5 is not applicable for this one. Test number 1 is applicable because test number 1 is segment revenue test. But this is external revenue test. Overall revenue test applicable only for external revenue. So for test number 5, intersegment is not at all applicable. So overall revenue test is equal to applicable only for external revenue. So intersegment is not considered here. So now you have to check out, listen very, very carefully, total external revenue from the reported segments. From the reported segments from test number 1, 2, 3 and 4 should be greater than or equal to 75% of total external revenue. Clear everybody? So what is the last and final test, Amma? Overall revenue test applicable only for which revenue, Amma? External revenue. How to find it, Amma? External revenue from the reported segments from test number 1, 2, 3, 4 should be a minimum of greater than or equal to 75% of total external revenue. Let us check out. As per our example, what are reported segments? And A, B, C, D. You have to check which revenue? External revenue. So A, B, C, D segment revenue, external revenue. Inter-segment not at all considered. So external revenue from the reported segments. Check out how much is that. A, B, C, D. 0 plus 255 plus 15 plus 10. 280. 280. Clear everybody? How much is the overall external revenue, Amma? 400. Minimum how much percent you have to maintain? 75%. So 400 into 75%. How much? 300. So now, how much is to be reported? 300 external revenue must be reported. Now how much is reported? Only 280 is reported. Still how much is shortage? So minimum 20, only 20. Greater than or equal to kada. Sir, you have to report a minimum of 300 external revenue. But till now you have reported only 280 external revenue. Still how much minimum is to be reported? 20. More than 300 also no problem kada. So minimum 20 unnadi check cheskondi. You can report G. You can report H. You can report F. But if you report E, again it is short. Along with E, some other has to be reported. So finally, what is better to choose? Highest revenue is the better option. If you want exact 300, G. But exact 300 is not our cup of tea. What is our intention? Minimum 300 or exact 300? Minimum 300. In the sense, you can choose the highest part. So now finally, conclusion. What are to be reported separately, sir? A, B, C, D and F. Whatever the other segments you are having like E, G and H, no need to report them separately. You can call these 3 segments as other segments and you can just show the same. Clear everybody? Sir, understood. That is the concept of reportable segments. Last and final thing. Disclosures. If it is a primary segment, sir, total segments whatever are there are divided into 2 parts. Primary segment, secondary segment. If it is most important segment, they will be classifying it as primary segment. If it is not most important as per their point of view, management will decide this one. They will treat it as secondary segment. Clear everybody? So what are the two segments you are having? Business segment, geographical segment. These two segments, out of which one will be chosen as primary segment, another will be chosen as secondary segment. If it is a primary segment, they have to report everything. Segment revenue, segment expenses, segment result, segment asset, segment liability. Like that they have to disclose each and everything. But secondary segment, most important item is enough. Most important item. That is, for business segment, what is most important item? Segment revenue and segment assets. Correct or wrong? Next, for location of assets, what is most important item? Segment asset. For location of customers, what is most important item? Segment revenue. So enough of disclosing only these things if it is a secondary segment. Understood? Also, 10% is slab. If satisfied, disclose. Otherwise, no need to disclose. So to tell you on a conclusion note, disclosures. Choose one of your segments as primary segment and choose the other segment as secondary segment. If they choose business segment as primary, location of assets and location of customers will become secondary. If they choose this as primary, these two things will become secondary. If they choose location of customers is secondary, primary, these two will become secondary. Clear? To tell you in a simple note, one is primary segment, other two will become secondary segment. If it is primary segment, disclose each and everything. If it is secondary segment, disclose only most important item. What is most important item? For business segment, segment revenue, segment asset. For geographical segment, location of assets, segment asset. For location of customers, segment revenue. Also disclose these things only when they satisfy 10% slabs. Otherwise, no need to disclose. Clear everybody? Let's check out a question. See, totally a company is there. It has identified three segments: India, USA, UK. Clear everybody? India, USA, UK. And check out. Business segment is their primary segment. Sir, what are the two segments they will be having? Business segment, geographical segment. What is their primary segment, Amma? So geographical segments will become secondary segment. What are the three things that you are having, Amma? India, US, UK. These three are considered as geographical segment. Primary or secondary? Secondary. Need to disclose each and everything a most important item. Most important item. Since this is geographical segment and yes, it sells the products and cheptundi. Sales ante location of assets, location of customers. Location of customers. So what is most important item? Segment revenue is the most important item. Disclose segment revenue only if it crosses the 10% slab. So check out what happened. 70% in India, 25% in USA, balance in UK. Understood? So question is all about primary segment, business segment. They have told that India, USA and UK. So these are geographical segments. Obviously secondary segment. Again you need to identify location of assets or location of customers. They told sales. Sales in the sense location of customers. So what is most important item? So disclose segment revenue only if it crosses the 10% slab. So now tell me, India 70%, USA 25%, balance how much? 5% in UK. So now tell me, is PK Limited as a part of geographical segment required to disclose where the revenue from export sales, where such sales are not significant? Question is all about PK Limited. Is there any need to disclose if the sales are not significant? Not significant and not meeting the 10% slab. Needed or not needed? Not needed. So in this example, what are to be disclosed? Indian sales and USA sales. What are not at all needed? UK sales are not needed. Clear everybody? because it did not cross the 10% slab. And I will tell you last question, one more question. This is done. This you can do. Yeah, might be the question is missing. Just listen here. I'll give you a question. There are three segments. Say X, Y and Z. Total segment assets are 100, 80, 20. But in this segment assets included deferred tax assets 5, 3, 1. Clear everybody? Now tell me what segments are to be reported segments. Hope you have got the question. As per this question, you can solve only one test. What is that test? Segment assets test. Correct or wrong? What is the rule, Amma? Segment assets should be greater than or equal to 10% of total segment assets. How much is total segment assets? 100 plus 80 plus 20 is equal to? Absolutely wrong. Because this segment assets is including deferred tax assets. But we know that deferred tax assets, tax related assets are not to be included. Correct or wrong? So first deduct these things. 100 minus 5, 95. 80 minus 3, 77. 20 minus 1, 19. Now check out. 95 plus 77 plus 19. 191 into 10%, which comes to 19.1. So whatever is crossing this 19.1, it will become a reporting segment. Start telling me X. Yes. Y. Z. No. So reporting segments are only X and Y. Z, no need to report separately. Clear everybody? Like this, tax items also will be included, but be careful while solving the same. Clear? So that is the end of accounting standard number 17. Like inclusions, exclusions, and next tests of reporting segments, and finally disclosure related items. Primary, disclose everything. Secondary, only most important items. Totally 5 tests. If any of the tests are satisfied, you can. And coming to inclusions and exclusions, direct, allocable, intersegment, which should be ordinary items, operating items, due course of business. Extraordinary items, not included. Tax related items, not included. Not related to business, not included. Financing items, not included. Investing items, not included. Clear? So get ready. We are going to start accounting standard number 18. And if anybody of you want to leave, now you can leave. And if any doubts, you can ask. And shall I start with AS18? Fine. So AS18 is all about related party disclosures. Sir, hardly in AS18 you will be having applicability. If you have learned to what AS18 is applicable and to what AS18 is not applicable and exclusions, obviously accounting standard number 18 is completed. So take care. So point number 1, coming to applicability. AS18 is applicable, first of all, related party disclosures. This standard is purely relating to disclosure aspect itself. Likewise, if there is a related party transaction, disclose. If there is no related party transaction, no need to disclose. Now, who are called as related parties is given in applicability mode. So listen, point number 1. So entities which are in common directly or indirectly, control or controlled by or in common control with the reporting entity. Entities which are directly or indirectly controlled by in common control with reporting entity. These are the relation. This is the relation number 1. But anta peddaga akkarledu. Straight away we can consider that as holding and subsidiary relation. Holding and subsidiary are to be treated as related parties. What is the relation between holding and subsidiary, sir? Control. When can you tell that holding company is controlling the subsidiary company? If any of the following 3 conditions are satisfied. Number 1, more than 50% of the voting power. Number 2, controlling the composition of board of directors. Last and final, number 3, please take care, okay? Substantial interest in the voting power. Sir, normally we know only these two things for control, but as per AS 18, control also includes the last one, substantial interest. Sir, what is substantial interest? Yes, more than 20% is considered as substantial interest. Also, there is another concept called significant influence. Even that is also 20%. Then what is the difference between these two things, sir? Substantial interest in the sense having 20% plus power to direct companies operating on financial policies. Significant influence in the sense 20% is fine and you will be having only power to participate, not direct. Just you can participate. You cannot control, you can participate and you can influence if needed. Clear? So what is relation number 1? Dash and dash. Holding and subsidiary. So what is the relation between these two things? Control. So coming to control, tell me. Three things are there. Greater than 50% of the voting power. Controlling the composition of board of directors. Substantial interest. What is substantial interest? More than 20% of the voting power. Plus power to direct companies operating on financial policies. Very, very important thing. Either this you can do directly or indirectly. You can have the same either directly or indirectly. So check out. Say company A is having two subsidiaries B and C. C is having another two subsidiaries D and E. Shall I start now? Sir, who is controlling? Major controlling is like A. A is controlling dash and dash. So A is called as dash company. B is called as, C is called as. Now come to this lot. Who is controlling? Which company? Controlling dash and dash. And hence these two are called as. Clear? Very important thing. Listen carefully and answer. So in this context, I can tell that A and B are related, A and C are related, C and D are related, C and E are related. But my question is all about, are B and C related? Yes or no? Yes, they are related. Who are called as fellow subsidiaries? Whom they are called as? Fellow subsidiaries are nothing but subsidiaries which are in common control with the holding company. Clear? Now answer me. D and E. Next question. B and D. B and D related. Listen. B is controlled by. D is controlled by. C is controlled by. So A can control D indirectly through C. Clear everybody? So now B and E related or not related? B and E related. What is the name of the relation? Fellow subsidiary. Pakka everybody? Sir, is the concept clear? So to tell you, in group companies, if at all you are having both holding and subsidiary, everybody is related to everyone. Because either directly or indirectly, the two words are very, very important. So A is directly controlling dash, B and C. A is indirectly controlling dash, D and E. Clear everybody? So let us write the relations for B. For B, A is holding company, C is fellow subsidiary, D and E fellow subsidiaries. Let me write the relations for C. A, B, subsidiary company, subsidiary, fellow subsidiary, D and E subsidiaries. Pakka everybody? That is what holding and subsidiary relation. Word what is more important, sir? Directly or indirectly. This is very important. Now coming to the second relation, associate and investing party. What is the second relation? Associate and investing party. Relation is nothing but significant influence. What is the relation? Koncham cheppandi. Significant influence. What is significant influence? Greater than or equal to 20% plus power to participate. They should have power to participate or power to influence, but cannot control. Power to participate or influence the company's financial and operating policies. No directly or indirectly, remember. Only direct relations. Shall I start now? Check out. A, B, C. Say 30%, 40%. More than 50 I cannot take. If it is more than 50, it will become subsidiary. So it is more than 20 but less than 50%. Anyways, now answer me, my dear children. A is called as dash. A is investing in B to the extent of 30%. A is investing in C to the extent of 40%. So A is called as investing party. What is B called as? Associate. What is C called as? Associate. Shall I start now? To A, is B relative or not? Yes. C, yes. Now listen, okay? For B, A relative or not? Yes. 200% relative. The relation is investing party. Now listen and answer. For B, is a C relative? No, because there is no indirect. Clear? Only direct concept is there. And also, my dear children, fellow subsidiaries are relations, but fellow associates are not related. These are also called as co-associates. Co-associates are not related parties. Clear, everybody? So to see who is the related party, A is called as investing party. To see B is not a relative. Understood, everybody? Pakka? Now listen and answer. A in B, B in C. 60% to 60%. Answer. For A, is a C relative or not? Yes or no? Obviously yes. Why? Because indirectly controlling. Clear? Now listen and answer. A and C relatives or not? How many of you tell no? Okay. How many of you tell yes? Very less. Remaining don't know. Huh? Sorry, the answer is yes. See, if B is influencing C, since A is controlling B, A can indirectly influence C. Clear? Sir, you told indirectly is not there. I told indirectly is not there in influence, but not in control. Listen. I'll give you one more example, then it will be clear for you. A is having 40% in B and B is having 20% in C. Now A and C, relatives or not relatives? Not relatives, because A cannot influence C through B. Logic clear? Here A is controlling B. So whatever B is doing, it is only under the purview of A, because B is controlling A, and hence A can comfortably influence C through B. Clear, everybody? This is not possible. This is obviously possible. Clear? Now another example. A is having 40% in B, B is having 60% in C. Now answer. A and C relatives or not relatives? Not relatives. Because A can influence B but cannot control. B can control C. Clear, everybody? But B cannot take the A's part for C's decision. B is controlling C. So B has decided something. B had decided something. For that A's permission is not needed. Clear, everybody? So A and C are not related here. Hope you have got all the three examples. So this is indirect influence, not relatives. This is also indirect influence through control and hence relatives. Indirect influence, not at all there. Pakka? Fine. So moving on to the next thing. Co-associates relatives or not relatives? Co-associates, not relatives. Now moving on to the next thing, listen carefully. A is a joint venture started by the parties X, Y and Z. X is having 80% share, Z is having 10% share and Y is also having 10% share. Okay. What is this called as? Joint venture. Our next part or our next relation is about joint venture and venturers. What's the next relation? Joint venture and venturers. Now no indirect ventures here, only direct is to be considered. That is point number 1. And also co-venturers are not relatives. Also co-venturers are not relatives. Now answer me. X, Y, Z. Are they relatives among themselves? No, because the three parties are called as co-venturers. For A, who are the relatives? X, Y, Z. Because they are called as venturers. For X, who is the relative? Only A. For Y, only A. For Z, only A. Pakka everybody? This is the concept of joint venture and venturers. What is the power here you are having, sir? Joint control. What is the power, Amma? X cannot plead that since I am having major share in A, I will control A. That is not possible. That is possible only in holding and subsidiary. This is a venture where all the three parties are having equal rights. So it is called as joint control. Pakka. Now, one special element about significant influence. Sir, generally if you have more than 20%, then you will be having power to influence or power to participate. But now one person is telling, sir, I am just having 12% share in wine company, and remember, I am very pretty, I am able to influence that company. Did you get my point? Generally, how much percent you should have? And only then we can tell that there is significant influence. But one shareholder is telling, sir, I am having only 12% and I am having significant influence. Will anybody believe in that? Obviously no. For this thing, how? You have to show the proof. So he told that, sir, all the remaining shareholder are just holding 1% of the share capital. I am the only major shareholder holding 12%. Now answer, can he influence or not? Yes. Next, listen carefully. Having more than 20%, but telling for him significant influence is not there. Will anybody believe? Will anybody believe? No. Because more than 20% you should have significant influence. But you are telling more than 20% and no significant influence. Immediately show me the proof. Sir, there is another person who is holding 60% and controlling other company. Then how can I control, how can I influence that company? That person is controlling. I am unable to influence. Remember, I am not telling that they are not relatives. They are relatives, but influence is not there. Clear everybody? అది చెప్తారు కదా మన పెద్దమ్మకి మనకి మాటలు లేవు కానీ చుట్టాలంటే చుట్టాలే. Same concept. Relatives, but no significant influence. Understood everybody? So till now we have completed three things. What is the first one? Control between dash and dash, holding and subsidiary and also fellow subsidiary. Indirect is quite possible here. What is the next one? Significant influence, investing party and associates. No indirect and co-associates are not relatives. What is the last and final one? Joint control between dash and dash, joint venture and co-associates. Sorry. Yes. Joint venture and venturers. Co-venturers are not relatives. No indirect relation. Up to this clear? Now next one. Listen very, very carefully. KMP. Who are KMP? Key managerial personnel and their relatives are always relatives to the company. For a company, their KMP are relatives. For a company, relatives are always relatives. Who are KMP, sir? Who are having authority and responsibility over planning, directing, controlling. A person who is having authority and responsibility for planning, directing, controlling the company's operating and financial policies, you will call that person as KMP. Like managing director, chief executive officer, chief financial officer, strictly to tell you all the top management people are called as KMP. Those KMP are always relatives to the company. Those KMP are always relatives to the company. KMP relatives are also relatives to the company. Who are KMP relatives, sir? Listen very, very carefully. KMP. KMP spouse and key managerial persons, mothers and fathers, brothers and sisters, sons and daughters. All these people are relatives to key managerial personnel and hence these are also relatives to the company. Clear? Till now, if it is a company, if it is having a subsidiary or holding company, it is a relative. If it is having a associate or investing party, it is a relative. If it is having a joint venture or venturer, relative. Am I correct or wrong? Response, sir. Of course, co-venturers, co-associates are not considered. Now their KMP are also relatives and relatives of KMP are also relatives. Clear everybody? Now a shareholder, individual shareholder who can have control or significant influence, even this person is also a relative. Here we have seen that company, subsidiary or holding. Now individual person. Say if one company is having 60% in another company, this company is relative. If a shareholder is having 60%, then even that shareholder is also relative. Understood? Company is having 60% relative, shareholder is having 60% is also relative. And shareholders' relatives are also relatives. Shareholder's spouse, shareholder's mother, father, shareholder's brother, sister, shareholder's mother and daughter. Sorry, son and daughter. Clear everybody? All those people will be considered as relatives. Understood? Last and final relation. Individuals or KMP are having one business concern and are also having another business concern where they are having significant influence or control. Then these two business concerns are also relatives. Clear? Likewise, there is Mr. A who is having a sole proprietor business. Mr. A is having 70% in A Limited. Clear? Of course, A is relative to the two parties. For these two parties, Mr. A is relative. But in this situation, even sole proprietor and A Limited are also relatives. Understood everybody? Fine. In the same way, Mr. A is also having 25% in K Limited. Yes, both K Limited and A Limited are also relatives. Understood? So the last relation is all about individual or KMP along with their relatives having either control or significant influence in more than one entity, then even those entities are also considered to be relatives. Understood everybody? So these are the 5 relations. Holding and subsidiary, associate and investing party, joint venture and venturers, KMP and their relatives, individual and their relatives, individuals or KMPs business concerns are also relatives. Understood? So now moving on to the next thing, who are not at all considered as related parties, deemed not related parties. Who are deemed not related parties? So two companies having a common director. Say for example, Mr. A is a director in K Limited. Mr. A is also a director in A Limited. Clear? Mr. A is a director in K Limited. Mr. A is also a director in A Limited. Or K and A relatives? No, you cannot tell like that. But remember, if Mr. A is KMP in both the companies. Yes or no? Yes. If in one company he is KMP and in another company he is having 60% share. Relatives. Ante kadamma. If in one company KMP and he is having a 40% share in another company. Relatives. Just I told you like individual or business concerns having control or significant influence over the business entities, then all those business entities are also considered as relatives. So now that concept is this one. But if Mr. A is common director, sir, we told KMP is a relative. But common directors are not relatives, kada? So two companies having a common director doesn't mean that the two parties are related. But take care, if such director is KMP in both the companies, then they are relatives. Now listen, there is a single supplier for our business, or single agent for our business, or single franchisee for our business, or a single supplier for our business, or a single customer for our business. All those single partners are never relatives. You may be asking me, sir, you are having single customer. If that customer is not there, then no business kada sir. Then that single customer should be relative. No. If that customer is not there, find another customer. That particular customer cannot influence you, cannot control you, cannot dictate the policies of your company. Hardly he can influence selling price. Will you accept or not? If there is single customer, hardly he can influence selling price. అది కాకుండా ఇంకేం వాడు ఇన్ఫ్లుయెన్స్ చేయగలడు? Can he dictate us, you don't purchase from that supplier, purchase from another supplier? No. If you are having a single supplier, hardly that supplier will influence you on the cost price. He cannot ask you, don't sell to that customer, don't take loan from this company. That's not possible. So single franchisee, single agent, single distributor, single supplier or single customer are never considered as relatives because they cannot influence the whole company. Providers of finance, that is who have given loans for you. Government departments, public utilities like electricity department, municipal department, local government authorities or trade laborers union cannot influence or cannot control. They are having only limited influence. Sir, hardly providers of finance will be having influence or control only on the interest or the loan amount, but not on any other thing. So they cannot be considered as related parties. Understood, everybody? So take care. These three are not to be considered as related party. Number one, two companies having a common director, or whenever you are having a single persons, they are not considered as relatives, and others like providers of finance, government agencies, government departments, public utilities like municipal departments, electricity department and workers union. These cannot be considered as related parties. Understood, everybody? Last and final. Yes, just bear for another 5 minutes. I'll close AS 18. And the last and final part is all about, even though the following parties are related, no need to disclose. Non-applicability. See, the above three things are not at all related parties. Now, these are related parties, but standard is not applicable. Clear, everybody? Point number one, where consolidated financial statements are getting prepared. If it is standalone financial statements, you can tell that transactions between holding company and subsidiary company are related party transactions and are to be disclosed. But you are preparing consolidated financial statements, which is prepared for all the holding company and subsidiary company as a whole by treating as if it is a single entity. So in CFS, there is no related party transactions for all the holding, subsidiary, associates and joint ventures. Clear, everybody? And the next one, transactions between state controlled enterprises. Transactions between state controlled enterprises. State controlled enterprises are nothing but government companies. So if transactions are there between the government companies, even though they are related, no need to disclose the same. Clear, everybody? Last and final, if there are specific agreements or transactions through specific statutes, if you are having specific agreements or specific statutes, then even those transactions or related party transactions, no need to disclose. To tell you an example, I hope consolidated financial statement is clear. And state controlled enterprises, why is not to be disclosed? Because state controlled enterprise, in the sense government is having their official duties also. All the government officials things are not at all needed for the general public. వాళ్ళు ఏదో అటామిక్ ఎనర్జీ ఎక్కడి నుంచో కొనాలనుకున్నారు అనుకో, అది నీకెందుకు అవసరం అసలు? దట్ ఈస్ దేర్ డెసిషన్, రైట్? So it should not leak to the general public. Many things will be done very confidentially, and hence all the confidential matters will not be disclosed. That is the reason why transactions between state controlled enterprises are to be maintained with some confidentiality. Next, say there is a bank. There is Mr. A, who is the managing director of this bank. Who is the managing director of this bank? Is he relative or not? Response, sir, obviously relative. How much salary you are paying to Mr. A? It's a related party transaction and hence it has to be disclosed for sure. But how much Mr. A's bank deposit is there? Even that is also a related party transaction because Mr. A is depositing the amount with the banker. How much A's bank deposit? That is not to be disclosed because that is purely kept as confidential as per Banking Regulation Act. Clear, everybody? In the same way, say for example, Mr. K is there, who is a managing director of an insurance company. He may take insurance with this company itself. But how much policies documents that you are having, that is not needed for you. Insurance Regulatory Development Authority or Insurance Act is prohibiting these things. Clear everybody? If any statute had prohibited or if any law is prohibiting you not to disclose, then you are not supposed to disclose. Check out in the matters of confidentiality where enterprise is prohibiting the disclosures either through agreements or through specific statutes or regulatory bodies. And with respect to the transactions between holding and subsidiary company at the time of preparing consolidated financial statements, last but not least, transaction between state controlled enterprises. Clear? In all these three cases, no need to disclose. So you need to disclose only when there is a related party transaction. But if it is a control, even though there is no related party transaction, you have to disclose. Sir, did you understand? To tell you, we have learnt with some relations. Likewise, holding subsidiary, associate, investing party, joint venture, co-venturers, individuals, KMP and their business concerns or relatives. Next, learn deemed not related parties. The following are not at all considered as related parties. And then even though related, no need to disclose. Like state controlled enterprises, statutes, in the matters of confidentiality, consolidated financial statements. Now, last and final tagline is all about you have to disclose if there is related party transaction. Otherwise, no need to disclose. Sir, my company is having an associate company. There is no transaction. Is there any need to disclose? Absolutely no, not needed. Even though you are having relatives, if the transaction is not there, no need to disclose. Exception. If it is control, even though the transaction is not there, you have to disclose. Clear with the final tagline? If you are having related parties, no transactions, no need to disclose. Having related parties, no transactions, no need to disclose. Exception, control. Even if transaction is not there, you have to disclose. If there is related party transaction, for everything you have to disclose. If not there, no need to disclose. But control, you have to disclose. Clear everybody? Yes, with an exception of a late of 7 minutes, the target is actually achieved. Reason being limited time, we are having more number of things to discuss. So madhyalo mi koncham boring ga anpinchachu, but and as the session is something like that, around 12 standards to be discussed in 8 hours. That's actually the hardest task. If it is group 1, it is pretty comfortable because less number of standards. Anyways, so let's stop the session here, and in the afternoon session from 3, we are going to start accounting standard number 20 and 22. Yes, koncham padukondi pokandi because afternoon session, but 20 and 22 are a bit okay. So ఇంకా ఇప్పటి వరకు లాకింగ్ లో మనం ఎక్కడ ఉన్నామంటే 24. ఓకే ఫైన్ అమ్మా, థ్యాంక్ యూ అండ్ గెట్ రెడీ ఫర్ ద ఆఫ్టర్నూన్ సెషన్. బాయ్ అమ్మా. సో లెట్స్ కంటిన్యూ విత్ ద నెక్స్ట్ స్టాండర్డ్, అకౌంటింగ్ స్టాండర్డ్ నంబర్ 20. సో AS 20 is EPS. What is EPS amma? Earnings per share. Again, it's one of the easiest standards. So coming to earnings per share, so this standards deals only with the concepts of presentation. Likewise, where EPS will be presented, what kinds of EPS will be there, all these things will be discussed here. And to compute EPS, earnings per share, we need to compute earnings available to equity shareholders divided by weighted average number of equity shares, which is nothing but EPS. EPS is equal to earnings available to equity shareholders divided by weighted average number of equity shares. Now, in this, earnings available to equity shares is nothing but earnings after tax minus preference dividend. Be very, very careful with this area. Earnings after tax minus preference dividend. Earnings after tax is nothing but after deducting provision for tax you need to consider, and coming to preference dividend you have to be with more care. So earnings before tax, earnings after tax is nothing but earnings before tax minus tax expense. So EBT, which is nothing but earnings before tax. This is absolutely dealt as per accounting standard number 5, where we have done in the morning session. Net profit or loss for the period, prior period items and changes in accounting policies. With that standard, we will get how much is the net profit before tax. Minus tax expense is as per accounting standard number 22. If you have deducted that, you will get EAT, earnings after tax. And if you deduct preference dividend, which is nothing but earnings available to equity shareholders. Now preference dividend, listen, this is important. What kinds of preference dividend has to be deducted? If it is cumulative, if it is non-cumulative. If it is cumulative preference dividend, whether or not declared, you have to deduct that. Hey, listen carefully. If it is cumulative preference dividend, whether or not declared, you have to deduct that. But coming to non-cumulative, it has to be deducted only if it is declared. That is rule. Preference dividend, if it is cumulative, deduct whether or not declared. But coming to non-cumulative, you have to deduct only when it is declared. So there is nothing great to speak about the numerator, because as I told you, EPS is equal to dash by dash. Earnings available to equity shareholders divided by weighted average number of equity shares, which is nothing but VANES. Till now our discussion is extended with earnings available to equity shareholders. As easy as such, is equal to dash minus dash amount. EAT minus preference dividend. EAT is equal to dash minus dash. Tax expense. This is as per accounting standard number. This is as per accounting standard number. Coming to preference dividend, deduct cumulative, deduct whether or not declared. Coming to non-cumulative, you have to deduct only when it is declared. That is set, all set with numerator. Nothing great to speak about numerator. So we'll be giving you one example. Just check out and answer. Net profit before tax is equal to 1 lakh minus tax expense is equal to 20,000 minus preference dividend. Minus appropriations. Yes, hope you have remembered appropriations, like transfer to reserves. Transfer to reserves and surplus is equal to 10,000, and finally minus preference dividend 5,000 minus equity dividend 10,000. So final profit that is available is 55,000. Okay, this is the final profit. Now my question is all about how much is EAES? How much is EAES? 65,000. Any other answers? Fine, let us discuss. Check out. EAES is equal to dash minus dash. EAT minus preference dividend. Earnings after taxes before tax minus tax expense. So 1 lakh minus 20,000. 80,000 is earnings after tax minus preference dividend. That is 80,000 minus 5,000. How much it comes to? That is your earnings available to equity shareholders. Forget about all the medium things, whatever are there. Like if any transfer to reserves, etc. and etc. whatever. So whatever you are having, no need to consider at all. You can comfortably take all those things. Clear everybody? That is the end of your numerator. What is numerator? Earnings available to equity shareholders. Clear? And one more example would like to give. Listen very, very carefully. Say earnings available to, earnings after tax this time. Giving you earnings after tax data. Say earnings after tax is 1 lakh. Listen very carefully. Preference dividend. Last year 10,000. Current year 10,000. Okay. This 2 years preference dividend declared in current year itself. Now answer needed. How much is earnings available to equity shareholders? Answer. 80,000. Any other answers? 90,000. Perfect answer is 90,000. Because we told that, sir, point number 1, declared in current year with respect to last year. In the sense it is cumulative or non-cumulative. Preference dividend of last year declared in current year. In the sense, what kind of these shares are? Cumulative or non-cumulative? Cumulative. Because only if it is cumulative, if in the last year it was not declared, it will be carried forward in the current year, it will be declared in the current year. So this is a kind of cumulative preference shares. If it is cumulative dividend, deduct whether or not declared. Deduct whether or not declared. So already last year dividend might have deducted in the last year. Last year dividend might have deducted in the last year. So you need to deduct only current year dividend. So 1 lakh minus 90,000. Understood everybody? So that is the set of earnings available to equity shareholders. Now coming to the denominator. What is the denominator? Vains. Weighted average number of equity shares. So listen, coming to accounting standard number 20, our greater discussion extended only with the denominator, that is weighted average number of equity shares, but not the numerator at all. Because numerator, just now we have seen one part is dealt by AS 5, another part is dealt by AS 22. Apart from that, you just need to deduct preference dividend, then automatically it is over. Now coming to vains, listen carefully. Sir, vains is nothing but number of equity shares multiplied by time weighing factor. What is time weighing factor, sir? Number of months by 12. How many months they are in the business? You will be consider that whole divided by 12 is nothing but weighted average number of equity shares. Sir, how to compute vain sum? Number of equity shares into months by 12. Clear everybody? That is all about your weighted average number of equity shares. So I guess we are having an example for that. Okay. Say for example, the opening is 1 lakh equity shares you are having. Opening. Somewhere on 1/4 you are having 1 lakh equity shares. And on 31/7 of the same financial year, you have issued 20,000 equity shares. And 31st December, buyback 10,000 equity shares. And finally on 28th February, you have issued another 10,000 equity shares. This is the whole question. Now you need to find vains. Vains is nothing but dash into dash by dash. Number of months into, number of shares into months by 12. Find out. Sir, 1 lakh. Sir, you have to find EPS at the end of the year. Am I correct or wrong? What is the end of the year? So 1 lakh into 12 by 12 plus 20,000 into from 31/7 till 31/3. Sir, hope you have understood why I have taken into 12 by 12. Because this is year starting, this is year ending. Obviously 12 months are there in the business concern, so into 12 by 12. Now coming to 31/7. Totally how many months are there? 8 months, remaining months. Okay, 8 months. So multiplied by 20,000 multiplied by 8 by 12. Clear? Buyback. Buyback in the sense number of shares are decreasing. So again you have to do the minus here. If issue plus, if buyback minus. So minus 10,000 equity shares multiplied by how many months are there, Amma? 3 by 12. And finally 28 to issue. So 10,000 equity shares multiplied by 2 by 12. Sorry, 1 by 12. Because 28 2 in the sense Feb ending. So you are having only 1 month, that is March. So if you have done this thing, you are going to get one number of shares, which is nothing but weighted average number of equity shares. Clear everybody? Pakka? There ends with basic discussion. Okay. Now moving on to the next thing. Listen very, very carefully. Different styles of weighted average number of equity shares. You are having 1 lakh equity shares at the rate rupees 10 each. Year starting on 1/4 itself. Also you are having 50,000 equity shares at the rate rupees 5 each. Okay. Now how many vains you are having? Weighted average number of equity shares is equal to question mark. Point is very simple. Same face values or different face values. So you have to convert it into the same value. Clear everybody? That's your choice. If you would like to convert, you can convert on 5 rupees shares every share. Or if you would like to convert, you can convert everything into 10 rupees. Generally, it is considered that we will convert into larger number of equity shares. Why? There's no reason. It's some sort of like tradition. That's it. From the times people are computing like that, we are doing like that. So 1 lakh equity shares 10. Let's convert this into 10. Sir, 50,000 into 5, which comes to 2,50,000 divided by 10. 25,000. So can I tell like this? 50,000 at the rate 5 is equal to 25,000 at the rate 10. Yes or no? So how many weighted average number of equity shares now I am having? 1,25,000. Pakka. Work is not yet over. Work is not yet over. Say for example, earnings available to equity shares is 10 lakhs. Vains we have computed comes to 1,25,000. So EPS is equal to is by vains. That is 10 lakhs by 1,25,000. How much it comes to? 8 rupees. Pakka everybody? Very important. All these 1,25,000 shares are having a face value of 10. So 8 rupees is EPS for face value of 10 rupees shares. But there is a face value of 5 rupees shares also. Then how much will be the EPS? Yes, absolutely cross multiplication, you will get 4. Understood everybody? That is the concept of EPS on a basic note. Now, next example would like to give you the last and final example. Listen carefully and answer, okay? EBT is equal to 1 lakh, or let me take some harder figures, bigger figures, 10 lakhs. Tax expense is equal to 1 lakh. Transfer to reserves and surplus is equal to 2 lakhs. Preference dividend non-cumulative declared is equal to 50,000. Cumulative not declared is equal to 20,000. This is the information about ease. Now giving you the information about vains. Coming to weighted average number of equity shares. You're starting, you're having 1 lakh equity shares at the rate rupees 10 issued during the year. Somewhere let us take an example of February. Okay. Say again 1 lakh equity shares at the rate rupees 5. This is the question. Okay. So now I want EPS for this one. Sir, for your kind information, morning, 1 second, listen. Morning we have done AS4, theoretical part. AS5, theoretical part. AS17, theoretical part. AS18, theoretical part. In the afternoon session, mostly I've seen to have some problematic related things because this is the odd time. And morning we have done with AS19. First day cheppadaniki reason ante a bit bigger standard in entire group 2. There are people who were already taken it as choice. But I don't want you to take it choice for every concept. I mean to tell non-cancelable is conditions. You can remember. And if any theoretical question is there, you can solve the same. Even finance lease conditions, you can remember, you can solve the same. But also this one, sale and lease back, operating lease, that is purely problematic. And you can do the same. Wherever it is possible to you not to leave choice, don't leave that. అంటే మొత్తం స్టాండర్డ్ అంతా చాయిస్లో పెట్టుకోకుండా చేయగలిగే కాన్సెప్ట్స్ ఉంటే చేసేసుకోండి అంటున్నా. వాట్ ఎవర్ యూ ఫీల్ దాట్ యూ కెనాట్ డూ దెన్ యూ లీవ్ ఇట్ ఎట్ లాస్ట్. Anyways, so wherever we are having the intentions of problematics, I'll be explaining you. Likewise, AS17 we are having intentions of problematics, explain. AS18 we are having many examples and I had tried to cover almost every example. So like that, wherever there is possibility, would like to cover the same. And coming to AS20, purely problematic. So you'll be having examples. Yeah, answer for this one now. Can I get how much is, what is it called? Is 8 lakhs? So 8,30,000. Fine, let me check out. 10 lakhs minus 1 lakh, which comes to 9 lakhs. And this is not necessary for us because each minus preference dividend. Coming to preference dividend, non-cumulative, you have to deduct only if declared. Yes. Cumulative, whether or not declared, you have to deduct. Yes. So 9 lakhs minus 70,000, 8,30,000, perfect shot. Now coming to weighted average number of equity shares. How much? 1,50,000. Okay, let me check out. 1,16,667. Okay, let me check out. So 1 lakh into first time weighing factor I would like to take. 1 lakh into, so if nothing is mentioned, financial year will be from April to March. So 1 lakh you are having at year starting. So for whole over the year having the same. So 1 lakh into 12 by 12 plus how many equity shares newly issued, sir? 1 lakh multiplied by time weighing factor. It was issued at February. If nothing is mentioned February, first you have to take. Sir, wantedly I missed some information because in examination you might get even this kind of things also. So if nothing is mentioned, it is February 1st. So automatically you are having how many months? 2 months. So 1 lakh into 2 by 12. Now I have taken time weighing factor. But let us equalize. Let us equalize. So what is this 1 lakh face value? 10. So into 10 by 10. But second slot of 1 lakh is 5. So let us convert into equivalent number by multiplying with 5 by 10. Clear everybody? So automatically how much it comes to? 1,08,333. Pakka everybody? This is what your wins. Clear everybody? Now EPS if asked you in the examination, it is quite simple. 8,30,000 divided by 1,08,333. 7.67. Sir, mostly in examination, your questions will be only up to this part. And దీనికి next level ఇక ఉండదు. Next level అంటే this 7.67 is EPS for rupees 10 share for 12 months. Understood? But you are also having rupees 5 share. How much it comes to? 3.83. This is for 12 months. But the second slot of equity share time weighing factor is only 2 months. So for 2 months, how much? This is what your final answer. But this is all will not be tested in the examination for sure. Your question will be stopped. Your solution will be stopped somewhere at this point. 7.67 is EPS for a 10 rupees share for 12 months. Pakka everybody? This is what the basic concept of EPS. Clear? So let me proceed further. Listen very carefully. So the next part is all about adjusted EPS, or people will be calling this as a revised EPS, or people will be calling this as a restated EPS. Clear everybody? So one more thing, this is hardly nothing but proportion. If anybody of you did not understand, this is hardly nothing but proportion. 5 into 7.67 divided by 10. And even this one also. Something like, this is for 12 months, for 2 months how much? 2 into 3.83 divided by 12 months. Clear? Sir, this is just proportionate. Doing some sort of cross multiplication will fetch you the answer. Okay? Fine. Now listen to the next one. Next concept. Adjusted EPS or revised EPS or restated EPS. People will be calling it any of the styles. First of all, what is the meaning of this one? Sir, in each and every year financial statements, will you prepare only for the current year or also for the previous year? Every year financial statements will be depicting in amount column only for the current year or also for the previous year. Also for the previous year, because users would like to take the comparative figures. So it's not only for the current year but also for the previous year. They will be indicating it like that. Clear everybody? Now the point that you need to understand here is all about last year already they have prepared the last year EPS. Correct or wrong? Already in the last year they have computed last year EPS. If in current year you would like to change the last year EPS, then it is called as restated EPS. Clear everybody? Sir, take care. Say for example, last year EPS is equal to 10. While preparing the financial statements in current year, last year EPS. Say current year EPS is 12. Last year EPS how much is that? 10. He has to put 10 here. Clear? But if they wishes to change this figure, then that figure is called as adjusted EPS or restated EPS or revised EPS. Clear everybody? Now the biggest question, in which situation this can be changed, sir? Because already reported in the last year 10. Why again in the current year it should be changed? Because of the following reasons. There might be some increase or decrease in number of equity shares in the current year, but without changing the resources. Sir, it's quite common. Best example, bonus issue. You are having 1 lakh equity shares in the current year and you have declared 1:1 ratio as bonus. So how many equity shares will come now? 1 lakh. Correct or wrong, sir? So now, sir, last year you are having how many equity shares? 1 lakh. Current year you are having 1 lakh original equity shares, 1 lakh bonus equity shares. On a whole, you got 2 lakh equity shares, amma. Correct or wrong? There is increase in number of shares, but resources are same. No change in resources because bonus shares are issued at free of cost. There is no change in resources. Clear everybody? There is increase or decreasing number of equity shares, but without change in resources. In all these situations, you have to restate the previous year EPS. Otherwise, what happens, I will tell you. Say for example, last year you have got a profit of 10 lakh. Current year you have got a profit of 12 lakhs. If at all you are having only 1 lakh equity shares even in the last year and current year, then EPS of current year and last year. EPS of last year is 10 lakh by 1 lakh. 10 rupees. Correct or wrong? EPS of current year is 12 lakhs divided by 1 lakh. 12 rupees. Correct, hai na? So 12 rupees is the current year EPS. Pakka. Situation number 1. Situation number 2. Current year their profit is 12 lakhs. Last year their profit is 10 lakhs. But last year they are having 1 lakh equity shares. Current year they are having 1 lakh plus 1 lakh equity shares in the form of bonus. Now if you have adopted this one, EPS of last year will become 10 lakhs by 1 lakh, which comes to 10 rupees. EPS of current year will become 12 lakhs divided by 2 lakhs, which comes to 6 rupees. So automatically users will be in such a notion that company is not performing well and hence automatically decreased. But what is the reality here? Even though here 2 lakh shares are there, whatever last year resources, the same resources you are having in current year also. Clear everybody? Last year resources are exactly equal to current year resources. Clear? So now what standard is suggesting you is that in these situations, whenever the resources are there, but the increase and decrease in number of equity shares are there, then it is recommended to you. To consider the bonus shares as if issued at the beginning of the previous period. So current year EPS will be 12 lakhs by 6 lakhs, which comes to 6 rupees. Last year original EPS is 10 rupees, which is reported in last year. But in current year it will become 10 lakhs divided by 1 lakh plus 1 lakh. Clear everybody? So on a whole it comes to an amount of rupees 5. So bonus shares, when they are issued, sir, even though they are issued in the current year, you have to assume that these shares are issued somewhere at the beginning of the previous year. Clear everybody? That is bonus shares concept. But there are here and there one different situations with bonus also will be there. But as far as examination is concerned, this is the high end topic. But just to aware you, I am telling. Just to aware you, listen carefully, because you may get this style of question also. 1 lakh equity shares are there in the last year and also 1 lakh equity shares are there in the current year. Current year you have issued 20,000 equity shares. Current year you have issued 20,000 equity shares. After that declared bonus 1:1, which becomes 1,20,000 equity shares. Clear everybody? Now very important thing, that is all about out of this 1,20,000, You cannot consider entire 1,20,000 were issued at the beginning of the previous year. Previous year, how many shares are there? So these related shares only should be assumed that issued at the beginning of the previous period. Current year, how many shares are there? Newly issued 20,000. These related bonus shares has to be considered only for current year. Hope you have understood. This is advanced, but to tell you, for bonus share, consider the period of original share. Consider the period of original shares. So to tell you, listen, last year vains, while computing last year vains, you can take 1 lakh plus 1 lakh, only 2 lakhs. While computing current year, you need to consider 1,20,000 plus 1,20,000. So your question, sir, bonus year 1,20,000 is there? You told that bonus consider as if it was issued at the beginning of the previous period, then it should become 1,20,000. No, sir. No, amma. Reason being, these 20,000 shares are not there in the previous year. Logic clear? That's it. So simply to tell you, basic rule, bonus issue you have to consider as if it was done at the beginning of the previous period. But provided you also have to consider the period of the original shares. Whatever the original shares period will be there, bonus shares period also will be the same. Clear everybody? So this concept is not only applicable for bonus issue, but also applicable for consolidation of shares, share split, etc. Because number of shares either increases or decreases without change in resources. Now, very important thing of accounting standard number 20, rights issue. Listen, coming to rights issue. Coming to rights issue, there will be two parts. Sir, rights issue is offered at a discounted market price or at a concessional price. Am I correct or wrong? So if market price is 80, we will be offering it 50. Yes or no? So in rights issue, what happened? For some part, you will collect a consideration. For some part, you will give it as free. Rights issue is all about, for some part, it will be free. For some part, you are collecting consideration. For collecting consideration, there is no problem. But whatever this free portion is there, this free portion has to be considered as if it was issued at the beginning of the previous period. To tell you, this is to be assumed as bonus. Clear everybody? So now, rights issue, listen very, very carefully. What is the concept we are learning? Restated or adjusted EPS. It will be considered for increase or decreasing number of equity shares, but without change in resources. Understood everybody? Likewise, example, bonus, consolidation, share split. But different theme is all about rights issue. Because for some part there is consideration, for some part it is free. Whatever that free, we will treat it as bonus. So how to solve this? How to solve this? We are telling you. Listen carefully. Would like to take an example. Existing number of equity shares is equal to 10 lakh equity shares. Yeah, just check out. Here we are actually having an example. Let's take the same example. Net profit for the previous year 30 lakhs. Net profit for the current year 50 lakhs. Total outstanding shares prior to rights issue 20 lakhs. Rights price 20. Last date of exercising the rights is 1st June 2017. Rights issue is 1 for every 5 shares. So how many shares are there? 20 lakhs. So rights issue is nothing but 1 for every 4. So 20 lakhs multiplied by 1 by 4. Oh, I'm sorry. 1 for every 5 shares. So 20 lakhs multiplied by 1 by 5, which becomes 4 lakh new shares. Clear? So now, fair value of one equity share immediately prior to rights issue is 26. He is asking you to compute basic EPS and restated EPS. Shall I start now? Listen. Before starting the problems relating to rights issue, you need to compute two things. Number one, theoretical X rights price. What is the first one, Amma? Theoretical X rights price. Don't mug up it something like a formula. It is as simple as such average price. Check out. Originally, how many equity shares you are having? 20 lakhs. What is the price given prior to rights, Amma? 26. So 20 lakh equity shares are trading at a price of rupees 26. Newly, how many equity shares are released into the market? 4 lakhs. But these 4 lakh equity shares are released at a price of rupees 20. So at a price of rupees 20. So now theoretical exercise price is nothing but average price, which is nothing but original number of equity shares multiplied by cum rights price, that is 26, plus rights shares multiplied by rights price, whole divided by number of shares including the right shares. As simple as such. Multiply, add your weighted average price, which is nothing but your weighted average price. Clear? So if you have done this, how much you have got? 20, 25. Clear, everybody? This is theoretical exercise price. So what is theoretical exercise price? Original shares into cum rights price plus right shares into rights price divided by total number of shares. Or if you want, you can just put like this also. Like number of shares price, number of shares price, and you can obviously getting a figure. Clear, everybody? Now very important, you need to find bonus element or bonus factor or rights factor or adjustment factor. Anni okate peru. You can call it as bonus element, bonus factor, rights factor, adjustment factor, which is nothing but fair value divided by theoretical exercise price. How much is fair value, sir? 26. How much is theoretical exercise price, sir? 25. Remember, my dear children, after computing this rights factor, you will always have to get 1 point something. If you did not get 1 point something, you have done wrong. Appudu reverse cheseyandi. Hope you have got my point. Like always, you have to get 1 point something. In examination, we will confuse. Idi pine estam, idi kinda estam. 25 by 26. Then you will get 0 point something. But that is wrong. Remember, it is always 1 point something. Clear? So now, how much is the rights factor? You have got 1.04. Very, very important. Make it into 2 parts. Sir, I am telling you the simplest form here. I am telling you the simplest form. It is new, but it is simple. 1.04. This 1 separate, this 0.04 separate. So whatever this 0.04 is there, it is nothing but bonus. 0.04 multiplied by original number of shares. How many original number of shares? 20 lakhs. Chese major mistake entante 0.04 into right shares 4 lakhs vesedam, but you have to take the original shares here because rights are issued on original shares. So also you have to find bonus on original shares itself. So 0.04 multiplied by original shares, which comes to 20 lakhs, which comes to an amount of 80,000. So 80,000 are bonus shares and remaining balancing figure. Your total shares are 4 lakhs. Out of 4 lakhs, if 80,000 is bonus shares, 3 lakh 20 are issued for consideration. Now simple, since this is bonus shares, factor will be 12 by 12 as if it is issued at the beginning of the previous period. Remaining 3,20,000 is very, very simple, issued in the current year on the date of 1st June 2017. Understood? So let me tell you on a finality like conclusion. First of all, for rights issue, you have to compute dash. Theoretical exercise price is equal to original shares multiplied by cum rights price plus right shares multiplied by rights price divided by total number of shares. In our example, we got 25. Next, you have to find rights factor. Fair value divided by theoretical exercise price, 26 by 25, 1.04. Now immediately below to that, 4 lakh right shares. Make it into 2 parts. 0.04, this one. 0.04 multiplied by original shares. Don't forget that one, multiplied by original shares. That is 20 lakhs, which comes to 80,000. Automatically balancing figure. 4 lakhs minus 80,000, which comes to 3.2 lakhs. Clear? There are people who tell by even not considering the right factor, but you have to find the right factor because this is an example given in the original standard itself. So take care. Anyways, this 80,000 bonus number of shares, this 3,20,000 is issued on the date of 1st June. July, yeah? 1st July. Clear, everybody? That is the concept. 1st June itself. Now, EPS is very simple. How much is last year thing you are having? 30 lakhs. Last year original shares are 20 lakhs. So, last year EPS is equal to earnings available to equity shares 30 lakhs divided by 20 lakhs, which comes to 1.5. That is relating to last year EPS. Now, current year EPS. Current year earnings are 50 lakhs. 50 lakhs divided by, listen carefully, okay, everybody. Originally, you are having 20 lakh shares multiplied by 12 by 12. Plus 4 lakh right shares are divided into these parts. 80,000 is like bonus. So, 80,000 multiplied by 12 by 12. Plus new shares you have got 3,20,000 on 1/6. 1/6 in the sense April May 2 months gone. So 10 months you will be having. Plus 3,20,000 into 10 by 12. Whatever is the answer, that is your current year EPS. Clear? Last year EPS in the current year. What is that called as? Restated EPS. Last year earnings 30 lakhs divided by 20 lakhs into 12 by 12 plus bonus are there 80,000 into 12 by 12. That's it. Clear everybody? That is right, of course, which is very important for entire accounting standard number 20. Shall I proceed to the next part? The last and final part of accounting standard number 20, diluted EPS. So what is diluted EPS? Point number 1, even diluted EPS, we will compute for increase or decreasing number of shares without change in resources. Sir, then what is the difference between adjusted EPS and diluted EPS? Adjusted EPS is for past, diluted EPS is for future. Hope you have heard the word potential equity share. Potential equity share is nothing but future equity share. What is potential equity share? Future equity share, like convertible bonds, convertible preference shares, convertible debentures, options, ESOPs. Yes or no? Employee stock option scheme, or what is this called? Equity share application money received but due for allotment, share warrants, all these things. Future equity share. Clear everybody? Sir, take care. Only one difference. Adjusted EPS is computed for bonus, rights, whatever. Increase or decrease in number of shares but without change in resources. But diluted EPS is computed for increase or decrease in number of future equity shares but without change in resources. Shall I proceed further? Now, diluted EPS is equal to earnings available to equity shareholders plus potential equity shareholders divided by normal gains plus potential equity shareholder gains. Clear everybody? Not only normal, but also you need to consider for potential equity share related things. I'll tell you, listen. If there are convertible debentures, so you have to prepare the minds of the shareholder that you shareholders get ready. Your basic EPS is equal to earnings available to equity shares divided by weighted average number of equity shares. But remember, you are having diluted EPS in future. To tell you, as of now, you are having convertible debentures, all my dear equity shareholders. These debentures will be converted into equity shares in future. Then, along with your earnings, I will be adding interest after tax. Because if debenture holders are converted into equity shares, no need to pay interest. So whenever there is no need to pay interest, your profit will increase. But your profit is to be considered after tax. Correct or wrong? So earnings available to equity shares plus interest after tax. Because all your equity shareholders' earnings will increase. Remember, divided by not only your weighted average number of equity shares, but also the future potential equity shares will be added. Clear everybody? These debentures will be converted into equity shares. As a result, number of equity shares will increase and also earnings will increase. This is for convertible debentures. So for convertible debentures is by Waynes plus what you will be adding on the numerator, interest after tax, that is into 1 minus t, and for denominator potential weighted average number of equity shares. If it is preference shares, if preference are converted into equity, there will be no preference dividend. So preference dividend will be directly added after tax or before tax. That concept will not arise at all because preference dividend is always after tax. So directly you can add preference dividend plus potential weighted average number of equity shares. Clear everybody? Now last and final, listen carefully, is divided by Waynes. You are having options. Employee stock options are there. Those options will be converted into future into equity shares. Sir, even though the options are converted into equity shares in future, earnings will not increase. But number of shares will increase. But how to consider that increase of number of shares, sir? Sir, for convertible debentures, nothing to be paid. Debentures will be converted into shares. Whereas for convertible preference shares, nothing to be paid. Preference shares will be converted into equity. But coming to options, it is not like that. You have issued 1 lakh equity shares at the rate rupees 75. Clear everybody? Where the fair value in the market is 90. What is the fair value? 90. How much you have paid? I mean, how much you have offered for 75. So you have to consider with resources or without resources. For computing diluted EPS, do you need to consider those shares which give resources or no change in resources? No change in resources. Increase or decrease in future equity shares without change in resources. How much resources you are not getting? 15. Correct or wrong? Also, I'll tell you in another way. 1 lakh into 75 divided by 90. How much you have got? 933. 333. Or else let me take 100. It may fetch you one round figure. Check out. 75,000. So can you tell like this? So 1 lakh equity shares at the rate 75 is equal to 75,000 equity shares at the rate rupees 100. Yes or no? So how many are issued for free? 25,000. Clear? But in the examination you may not have this time. So that is the reason I am telling. Offer price is 75. Fair value in the market is 100. You have to consider with resources or without resources. So how many resources you did not get? 25. Clear everybody? So automatically 1 lakh equity shares multiplied by 25 by 100. You will get 25,000 equity shares. Understood everybody? This is options. So options, increase in earnings or 0. Whereas increase in shares, yes, it will happen to the extent of free portion should be considered. Understood everybody? That is the end of your standard EPS. Wherever possible to the max extent, I have covered even the examples also. But I recommend you to solve the examples relating to diluted EPS. Even covered with rights issue also. But I recommend you to solve diluted EPS. Just to revise you on one stretch. Sir, first of all, you have gone with basic EPS is divided by Waynes. Coming to is EAT, earnings after tax divided by preference dividend. This is earnings before tax minus tax expense. As per AS5, as per AS22. Cumulative only if declared, non-cumulative whether or not declared. Correct? No. Cumulative whether or not declared. Non-cumulative only if declared. And next portion is all about adjusted EPS. We are having problems only on bonus and rights issue. Bonus, you have to consider the time weighing factor as if it is issued at the beginning of the previous year. But remember, if there are shares only in the current year, such related bonus consider only in the current year but not in the previous year. Likewise, given you an example, the 20,000 were issued only in the current year. So related bonus has to be considered only in the current year. Next, coming to rights issue. Sir, Coming to rights issue, take care. First of all, you have to compute theoretical X rights price, which is nothing but weighted average price. After that, you have to compute rights factor, which is nothing but, remember always, higher amount by lower amount. Fair value by theoretical X rights price, where you will be getting always 1 point something. That point not something is nothing but bonus issue. Point not something multiplied by original shares has to be considered. That is bonus into 12 by 12. Balancing figure will be treated as consideration, and whatever the date you are having, take that date. Understood? Last but not least is about diluted EPS. Diluted EPS is nothing but increase or decrease in number of potential equity shares, that is future equity shares. 3 things learnt: convertible bonds or debentures, convertible preference shares, options. For convertible debentures, numerator add interest after tax divided by increased number of shares. For convertible preference shares, numerator add preference dividend, denominator shares will be considered. For options, no numerator will be added, 0. But coming to denominator, consider those shares with resources or without resources. Without resources. Understood, everybody? That's the end of accounting standard number 20. So get ready. We are going to start accounting standard number 22. Accounting for taxes on income. There might be people who have taken even this as choice, but that much is not needed. It is a very simple standard, provided some techniques will be there. If you have understood that technique, it will become very easy standard. But to the extent of needy, like to the extent of solving the problems, how much ever needed, we'll be telling you that one. So accounting standard number 22, that is accounting for taxes on income. Learn some terminology. Number 1, accounting profit or loss. Profit or loss as per accounting records. Taxable profit or loss. Profit or loss as per taxable records. Accounting records in the sense these are computed by following accounting standards and IGAAPs, Indian generally accepted accounting principles. Whereas taxable records in the sense these are considering Income Tax Act, applicable Finance Act and ICDS, Income Computation and Disclosure Standards. But on a simple note, Income Tax Act is considered while computing taxable profit or loss. So point number 1, or accounting profit and taxable profit, same or different? Obviously different. That is the reason PGBP erased. You will be taking the concept of taxable, accounting profit or loss, allowances, disallowances. Finally, you are going to get GTI. From that deductions, and finally you will get NTI. What is that NTI? Net taxable income is there. We will call it as taxable profit or loss. Now, moving on to the next thing. Say for example, accounting profit is 1 lakh as per P&L account. Taxable profit is 1,20,000 as per tax records, that is Income Tax Act. As per accounts, how much tax you have to pay? Say tax rate is 30%. 1 lakh into 30%, which comes to an amount of 30,000. Whereas coming to Income Tax Act, 1,20,000 into 30%, which comes to 36,000. Strictly speaking, how much should be your tax amount? 30,000. But how much you have to pay to Income Tax Department? 36,000. So your P&L account is something like this. Till now we have got a net profit. By net profit brought down, we have got an amount of rupees 1 lakh. If everything is good, to tax, it should become 30,000. But wrong. Because how much you have to pay? So immediately you have to create provision for tax. How much provision is created, Amma? 36,000. Clear, everybody? But how much is the tax as per accounting records that you should have? 30,000. Excess, how much is booked at debit side? 36,000. So immediately take out 6,000 and credit the same, which is nothing but by deferred tax. Clear, everybody? So now let us check out, is it asset or liability? If you write the journal entry for this thing, what is the journal entry that you will get? Deferred tax account debtor to P&L account. Since deferred tax is a debit side, it is nothing but asset. To think it in another way, check out how much I have to pay as per accounting records. But how much I am paying? 36,000. Extra paid. which is nothing but prepaid expense. Prepaid expense is nothing but asset, which is nothing but deferred tax asset. Clear everybody? So deferred tax asset is purely similar to your prepaid expense. Deferred tax liability is similar to your outstanding expense. Clear everybody? Pakka? So now check out whatever we are calling this as provision for tax. From now it will be called as CT, current tax. In accounting standard number 22, we will call it as CT. What is CT, Amma? Current tax. Shall I proceed further? Now, sir, as per our example, what is accounting profit? 1 lakh. What is taxable profit? 1,20,000. What is tax as per accounting records, Amma? 30,000. What is tax as per tax records, Amma? 36,000. This is called as dash. Accounting profit or loss. This is called as taxable profit or loss. Very important. What is this called as? Current tax. What is this called as, Amma? Current tax. Tax as per taxable records is nothing but current tax. Tax as per accounting records is nothing but tax expense. What is it called as, Amma? But if you have checked out your trading P&L account, 36,000 is a debit side, 6,000 is at credit side. Net how much we have got? 30,000. So we will book 30,000 only in your P&L account, but not directly. What is your tax expense? Ultimately in your P&L account you booked only 30,000, but 30,000 is not booked directly. It will be either in the form of CT and DT. Clear everybody? It will be in the form of CT and DT, current tax and deferred tax. So as per our example, here 30,000 is equal to 36,000 minus 6,000. Will you accept or not? What is this 30,000? Tax expense is equal to CT minus DTA. That's deferred tax asset annanga. Clear everybody? If you assume exactly opposite, then tax expense is equal to CT plus DTL. Clear everybody? So tell me, tax expense is equal to CT minus DTA or CT plus DTL. Pakka. So that is AS22 basic portion, basic point. So totally we have learned 5 things. Deferred tax is the difference between CT and TE. Deferred tax is the difference between CT and TE. So deferred, DEFERRED. This is the spelling, and meaning of deferred is nothing but postponement. Deferred tax asset, asset is postponed. Deferred tax liability, liability is postponed. Because I told you deferred tax asset is similar to prepaid expense. So prepaid expense is postponed. Deferred tax liability is similar to outstanding expense. So liability is postponed. Clear? So take care. 5 terms totally. Accounting profit or loss, taxable profit or loss. On accounting profit or loss, you will compute tax, which is called as tax expense. On taxable profit or loss, you will compute tax, which is called as current tax. Difference between these two things is nothing but deferred tax. Finally, tax expense is equal to CT minus DTA or CT plus DTL. Pakka everybody? That is the concept of your tax expense. Clear? Basic part of accounting standard number 22 is completed. Now to tell you another rule. Remember this rule, okay? Sir, if you have checked out 1 lakh, 1,20,000, 30,000, 36,000. We told that DTA. How much is that? 6,000. So accounting income less, taxable income more, accounting tax less, taxable income more, accounting expense more, tax expense less. Instead of remembering these many things, to tell you in a simplest short form, remember in accounting records, if expense is more, you have to create DTA. Just remember this. Almost half of the problem will be solved. In accounting records, if expense is more, you have to create DTA. So now, just we have done one example. 1 lakh, 1,20,000, 30,000, 36,000, analyzed everything, CT 36,000, but you want only 30,000 short booked and hence credit. But this much analyzation is not there now. Straight away check out. These are profits. Am I correct or wrong? respond. Profit is nothing but income అని కూడా చెప్పొచ్చుగా. Similar things కదా. సరే, check out. Sir, this is accounting profit or loss. This is taxable profit or loss. Immediately give the answer whether you need to create DTA or DTL. How to find, sir? Take the difference first. How much is the difference? 20,000 multiplied by, what is the tax rate, sir? 30%. How much you have got? 6,000. Finally, you will get the answer. Now decide whether it is DTA or DTL. What is our rule? Accounts expense is more. Check out. Sir, here in accounting records, income is less. Correct or wrong? If income is less, in the sense expense is more. So you have to create DTA. Pakka? Sure. There ends the matter. So let me give you one more final example. Accounting records 10 lakhs, taxable records 9.2 lakhs, tax rate is equal to 30%. Tell me, DTA or DTL, and how much? First you find the answer, then discuss. 24,000, which is nothing but how much is the difference? 80,000 multiplied by, which comes to, there ends with part 1. Now part 2. Sir, check out, as per our thing, this is income. Correct or wrong? Income in accounting records is more. If income in accounting records is more, expense is less. If expense is more, DTA. If expense is less, there ends the matter. Clear, everybody? Pakka? Now very, very important thing. Next part. You have to check out whether is it creation or reversal. You have to check out whether is it creation or reversal. So till now I am clear. Again, what is this creation and reversal? Listen. Creation of DTA is also similar to reversal of DTL. Creation of DTL is also similar to reversal of DTA. First, what I have told, take the difference. Find the amount by multiplying with tax amount. So hope you are listening. Take the difference. After taking the difference, multiply it with some tax percentage. Then you will be getting some amount. Am I correct or wrong? Then decide whether it is DTA or DTL by applying the shortcut. If in accounting records, expense is more, create DTA. That is your base shortcut. So after that, you analyze whether is it old difference or new difference. Clear, everybody? After the completion of this thing, you have to check out whether is it an old difference or new difference. If it is a new difference, creation. If it is old difference, reversal. What is old, I'll tell you. But as of now, clear? If it is new difference, create. If it is old difference, reverse. Creation of DTA is reversal of DTL. Creation of DTL is reversal of DTA. Now, to tell you an example, listen very, very carefully, everybody. Last year, already booked depreciation. Okay. Last year they have already booked or else let me give you an example so that it will be better for you. As per taxable records, as per accounting records, as per taxable records, as per accounting records, I am giving you an expense. This is an expense. Okay. Say 1 lakh, 2 lakhs, 1.5 lakh, 80,000. 2.5 lakh, and finally how much is the difference you will get? Like 1 plus 2 plus 1.5, 3, 4.5 minus 80 minus 2.5, 1.2 lakh. Tax rate is equal to 30%. Listen very, very carefully with this example. Almost you will get the standard. Just with this example, almost the standard will get completed. Listen carefully. Almost. Or the major part of the standard will be over. Check out. Sir, what is taxable records expense? 1 lakh. Accounting records expense? 80,000. How much is the difference? Multiplied by? How much is that? 6,000. Clear, everybody? Check out. This is expense. Expense in accounting records is less. Sir, if expense in account records is more, DTA. But since it is less, it will become DTL. So create a reversa. So now we are pretty sure with DTL. Create a reversa. It is year 1. New difference or old difference? New difference. And hence it will become creation. Pakka everybody? So in year 1, create DTL to the extent of 6,000. Shall I proceed further? Now year 2. Listen very, very carefully, everybody. Sir, in year 2 what happened? Accounting records 2.5 lakh, taxable records 2 lakhs. What is accounting records? 2.5 lakhs, taxable records 2 lakhs. What is the difference? Multiplied by which comes to 15,000. Am I correct or wrong? Now listen very, very carefully, everybody. Sir, here in accounts, expense is more. If expense is more, DTA, creation. Am I correct or wrong? Creation of DTA is similar to reversal of DTL. Sir, up to this clear kada? That is like 15,000. Next part. Creation of DTA is similar to reversal of DTL. So now you have to check out how much is creation and how much is reversal. Listen. Already last year accounts expense is less. Current year accounts expense is more. Current year accounts in the, sir, in year 2 as per accounting records, expense is more because in the last year expense is less. Logic clear? Last year akkada takku vachindi kabatti year ikkada ekku vachindi. So is it a new difference or an old difference? Old difference. Understood everybody? So very carefully. How much in year 1 you have created? DTL 6,000. Current year how much DT you have got, amma? 15,000. Out of this 15,000, creation of DTA is there. Reversal of DTL is also there. How much is reversal of DTL, sir? Whatever created in the last year will automatically gets reversed. And remaining 9,000 will become creation. Clear everybody? You have to analyze it carefully. So check out for the last and final time I'm telling. Last year 1,80,000. How much is increase? I mean, how much accounting expense is less? 20,000. Now check out in the second year 2 lakh, 2.5 lakh. Second year how much expense is more, amma? 50,000. So now what my point is that this increase, out of this increase 50,000, already last year 20,000 is decreased. Because of that, in the current year 20,000 is increased. Clear? Out of 50,000 is increased, 20,000 is reversal of old. 20,000 is reversal of old. And remaining 30,000 is creation of new. Because as we all people know that accounting income is differing from tax income, accounting expense is differing from tax expense. This is the style of expense that is booked in accounting records. This is the style of expense that is booked in tax records. But if you check 1 lakh plus 2 lakh plus 1.5 lakh, on a whole it comes to 4.5 lakh. 80 plus 2.5 plus 1.2 lakh, on a whole it comes to 4.5 lakhs. Getting my point everybody? So take care. In first year difference 20,000 multiplied by 30%, straight away 6,000. In first year accounts expense is less and hence creation of DTL. Now year 2 difference is 50,000 multiplied by 30%, which comes to 15,000. Now you have to decide what is this 15,000. While deciding that 15,000, you check out. In the first year accounting expense is less. In the second year accounting expense is more. Simple amma, less ki more aina, more ki less aina, reverse ante. Clear everybody? First year less, so create. Second year more, so reverse. Clear? Simple. So how much creation is there? 6 lakh. So reversal of DTL is equal to 6,000. Creation of DTA is equal to 9,000. Understood everybody? This had happened because in the second year accounting expense is more. Now come to the last year. Last year 1.5, 1.2. Again what happened? Accounting expense decreased. Clear? Last year increased, current year decrease. So automatically reverse. Clear? Sir, strictly speaking, how much is the difference? 30,000 multiplied by 30%, which comes to 9,000. First of all, check out. Since accounting expense is less, it is nothing but creation of DTL. But we know the rule that creation of DTL is similar to reversal of DTA. Here what is applicable? Creation of reversal. Reversal. Since it is not a new difference, it is old difference. Clear everybody? So you have to find the answer like, is it a new difference? Is it an old difference? If it is a new difference, create. If it is old difference, reverse. Pakka? Common rule. Accounting expense is more, then you have to create DTA. Okay, now let us do an example so that it will become a bit more clear for you. The following particulars are stated in the balance sheet of Deep Limited as on 31st March 2020. Deferred tax liability, something given. Deferred tax asset, something given. The following transactions were reported during the year. Listen very carefully. Depreciation as per books. Books in the sense books of accounts. As per books 70 lakhs. Tax 42 lakhs. No additions during the year. Shall I start now? Sir, how much is depreciation as per books of accounts? 70 lakhs. As per tax 42. So accounting depreciation 70. Tax depreciation 42. First take the difference. 28 lakhs multiplied by, what is the tax rate given in the question? 40%. Take that into 40%, which comes to 11 point. Let us decide now. If you observe here, accounting depreciation expense is more. If accounting expense is more, creation of DTA or it is similar to reversal of DTL. Now within these two things, either of the one will become the answer. Now what is that? Let's check out. Sir, already you are having 31st March 2020. That is last year. Am I correct or wrong? Already you are having last year and this is relating to current year. So straight question. Is this difference old difference or new difference? Since already last year is there, it is old difference. Clear? If it is old difference, creation will be applicable or reversal. So the answer will become reversal of DTL. Clear everybody? Like that with simple rules you can solve this. Now let us proceed further. Second one. Listen carefully. Expenses disallowed in 1920, allowed in 2021 were 14 lakhs. Expenses disallowed in 1920 are allowed for tax purposes. In the sense, as simple as such. Sir, disallowed in 1920. Last year disallowed. For tax purposes allowed in current year. Tax records. Clear? Accounting records allowed in last year, disallowed in current year. Clear? Sir, understood? So just answer me. As per tax records, 14 lakhs is expense in which year? 1920 or 2021? 2021. But what is the expense of accounting records in the year 2021? Nil. Because it is allowed in the year 1920. So as per accounting records, expense is 0. Clear? So now, very simple. As per accounting records, expense is equal to 0. As per tax records, expense is equal to 14 lakhs. Take the difference. Multiplied by, which comes to 5.6 lakhs. Let us decide now. Accounting expense is less. Since accounting expense is less, it will become either creation of DTL, which is similar to reversal of DTA. Let us check out what is applicable for us. Same question. Old difference or new difference? Old difference. Then what it will be? That is your answer. Okay, everybody. Now moving on to the next thing. Share issue expenses. For the year 2021, 1/10 of 70 lakhs were incurred in 1920. How much is the total amount? 70 lakhs. In which year incurred? 1920. So as per accounting records, total 70 lakhs was written off in the year 2019-20. Clear? Because we know that preliminary expenses, share issue expenses, everything has to be written off in P&L account in the first year. So how much is the expense you are having? 70 lakhs. So those 70 lakhs has to be written off in 1920 itself. Shall I proceed further? Now moving on to the next thing. But as per Income Tax Act section 35 AD, 1/10 of 70 lakh in every year. 1/10 of 70 lakhs in the sense it comes to 7 lakhs. Clear everybody? In the same way, in the year 2021, that is current year, what is accounting expense? 0. Because totally allowed in 1920. Whereas coming to tax expense 7 lakhs. Hey, not 70, 1/10 of 70 kada. Every year 7 lakhs. Take the difference, multiplied by, which comes to, let us start, same. Sir, accounting expense less. So creation of DTL similar to reversal of DTA. Now tell me, new or older? So what is applicable? There ends the answer. Last and final. Repairs to plant and machinery during the year 140 lakhs was spread over for 2 years equally in the books of accounts. However, as per entire expenditure for income tax expenses were written off in the year 2021. Check out. Total how much is the expense? 140 lakhs. As per tax records, expense is 140 lakhs. As per accounting records, expense 2 years anta. That is 140 lakhs divided by 2, 70 lakhs. Clear? Take the difference, multiplied by, which comes to, accounting records expense is less. So creation of DTL similar to reversal of DTA. Answer, what is applicable? Creation or reversal? You have to find out that very, very carefully. Check out what had happened. One highlight point that you missed. This point is only in the current year. Repairs were only during the year. In the sense, old difference or new difference? New difference. Since it is new difference, what is applicable? There ends the answer. Clear everybody? So that is what your final answer will be. Increase in DTL, he is using the word which is nothing but creation. Reversal of DTA, reversal of DTA. First one is reversal of DT. I hope you have understood how to solve this. As simple as such. So would like to tell you the second one. This is also a kind of example. So you have to identify that. Just check out. As per accounting records, 2 lakh is the depreciation. As per income tax record, depreciation is 5 lakhs. Okay. Answer. How much is the difference? Multiplied by tax rate 50%, which comes to 1.5 lakhs. So now answer, Amma. For accounting records, expense is less. Creation of DTL similar to reversal of DTA. What is applicable? Creation or reversal? It will become creation. Why? Because there is no opening balance given. So you have to assume that it is relating only to the current year and it is a new one. So how much you have got? DTL is equal to 1,50,000. Now check out. Sir, you have to know the word unamortized preliminary expenses. Amortized in the sense it appears in P&L account. Unamortized, not there in P&L account. So not there in P&L account as per which record? Which implies that in accounting records you are having that expense. So accounting records expense is equal to 30,000. Tax records expense is equal to 0. Accounting records expense is more. So you have to create DTA. New or old? Is this difference new or old? New difference. This is relating to current year kada. No opening data is there. So accounting records more. So creation of DTA 30,000 into 50%, 15,000. Clear? If opening balance is there, you have to think whether new or older. If opening balance are not there, everything is new. But problem in this problem is all about DTL 1,50,000, DTA 15,000. Set off these two things. You will get 1,35,000, which will become net DTL. Understood everybody? That is what your final answer. Net DTL, which will become 1,35,000. Pakka everybody? Okay, so there ends with the major concept of DTA and DTL. I'm having 3 more concepts to cover in AS22. Number 1, timing difference, and number 2, permanent difference. Like this, you have to, till now we have done all the analyzation. Am I correct or wrong? This analyzation will be done only for timing difference but not for permanent difference. What is the timing difference, sir? Now we are discussing old difference or new difference. Am I correct or wrong? That old or new is nothing but timing difference. If it is a permanent difference, forever it is different. So there is no new, there is no old. So now the concept is all about, listen very, very carefully, everybody. Timing difference. Timing difference. Difference erased in one period and it will be reversed in future periods. Permanent difference. Difference erased in one period which will never get reversed in future periods. Erase and reverse. Timing difference. Erase and never reverse. Permanent difference. Clear everybody? So let us take some of the examples. Listen very, very carefully. Sir, what is this called? Preliminary expenses. As per accounting records, write off in the first year itself. As per tax records, write off for 1/5 every year. What is this difference? Timing or permanent? Timing difference. In the similar way, you are having section 43B disallowances. No. 40A anukunta kada? Yes, 40A3. If you have paid more than 10,000 to any person in the form of cash on one day, then it is disallowed. Am I correct or wrong? Say for example, stationery paid in cash only to one person to the extent of 20,000. This is an expense in accounting records, but this is not at all an expense in tax records. Which difference is that? Timing or permanent? This is permanent because in tax never it will be reversed. Understood everybody? Section 43B, actual payments. 43B, actual payments. Deduction is allowed only on payment basis. Did you remember? Interest incurred in the current year. Incurred in the current year, but paid in the next year. Which difference? Timing or permanent? Timing, because incurred in the current year, so accounting records current year expense. But paid in the next year, so tax records next year it is the expense. Clear everybody? Contribution to URPF, unrecognized provident fund. Permanent difference, because unrecognized provident fund you will not consider at all as per Income Tax Act. Donations to private trust. Permanent difference, because as per Income Tax Act it is not allowed. Amortization of goodwill. Permanent difference, because amortization is not at all considered in tax. Clear everybody? Depreciation. Timing difference, because it will be booked in both the books of accounts but in different styles it will be booked. So depreciation is obviously a permanent difference. Sorry, timing difference. Clear everybody? So these are some of the examples. And last final tagline, provisions. Provisions. To tell you, I'll ask you a question. Wait. Bad debts. Sorry. Provision for bad debts. Sir, listen. Provision for bad debts is allowed in accounting records, but it is not allowed in tax records. But actual bad debt is allowed in tax records, then actual bad debt is not allowed in accounting records and it has to be set off with provision. Sir, understood? Current year you have created provision. Next year you have got bad debt. That bad debt will be taken to next year P&L account, set off with provision. Set off with provision. So to tell you, provisions are allowed in accounting records. Actuals will be allowed in tax records. So all the provisions are generally which differences? Timing differences. Provisions will be allowed, but actuals will not be allowed in accounts kada. Sir, understood? Say provision for bad debt 1 lakh. Current year. Next year provision for bad debt is equal to 1 lakh. Next year bad debt is not taken to next year accounts P&L account. It has to be set off against the provision for bad debt. Next year it will become expense in tax. Current year it will become expense in accounts. Clear? Last and final, repairs and renewals, provision for repairs and renewals. Timing difference. Pakka? Rule. There is DTA and DTL only for timing differences but not for permanent differences. If there is donation for private trust in current year, no need to consider that. Clear? Something he will be giving like this. Donation to private trust. Accounting records 1 lakh, tax records 0. Then immediately you should not check the difference 1 lakh into tax person 50,000 DTA, all this is wrong. Reason being permanent difference. There is no DTA, there is no DTL. Only DT is applicable only for timing differences but not for permanent differences. Clear everybody? There is one more special case, but you just go through that special case. DTA in case of loss. I'll tell you only one statement, you analyze it later. In case of loss, you have to create DTA. Clear everybody? Sir, in case of loss, you have to create DTA because loss will be carried forward to future and future profits will decrease and hence future tax will decrease. A benefit which is carrying forward. Clear everybody? Sir, to tell you in a simplest word, is loss an asset or not? Miscellaneous asset. Yes or no? Yes, fictitious asset. Loss is an asset. Current year you have incurred with 2 lakhs loss. I will not get the benefit in the current year. But next year carry forward. If you got a profit of 4 lakhs, set off these 2 lakhs and pay the tax only on 2 lakhs. So last year loss is an asset. But that benefit you have carried forward to the next year. That is the reason on loss you will be creating DTA. Even I told the analyzation, but in koncham related problems meer cheskondi because I'm having other things to go with this standard. Ante idi anta important kaadu, so you just do this. But I told you the statement. In case of loss, you have to create DTA. Why? Because loss is like an asset benefit which is getting postponed. Pakka? Now, remember, I'll just ask you one question. Current year you got the difference 1 lakh. Current year you got the difference 1 lakh. Current tax rate is equal to 40%. Next year tax rate is equal to 50%. This difference 1 lakh will reverse in the next year. Next year tax rate you already know it in the current year itself. Reason being next year Finance Act you know. Correct or wrong? So how much amount you need to create as DT? Is it on 40% or 50%? Question understood? Difference you got 1 lakh. Current year tax rate 40%. You know the next year tax rate in the current year, that is 50%. This 1 lakh will reverse in the next year. So how much tax rate you have to consider? 40 or 50? Cheppali. It's only 50%. Rule. If you are having future tax rate available, consider only future tax rate but not the present tax rate. Clear? If you know the future tax rate, you have to consider only the future tax rate but not the present tax rate. Shall I proceed further? Next. Yes, listen carefully. Tax holiday period. Say for example, your tax holiday period, in the sense government will declare during this period no need to pay the tax. So you're totally having year 1, 2, 3, 4, 5. And from year 6 again you have to pay the tax. For this first 5 years, tax holiday period. What is that, Amma? Tax holiday period. I am giving you the direct differences. Say the differences comes to 10, 20. And from the next year reversals. In future also. Clear with the example? So what is tax holiday period? During the period, no need to pay the tax. How many years no need to pay the tax? 5 years. From 6th year again you have to pay the tax. How much difference erased in the first year? 10. Second year 20. From the third year it is getting reversed. Shall I start now? Listen. Sir, normally we know the tax rate to the extent of 40%. What is the tax rate? 40%. Shall I start now? Okay. Listen very carefully. Sir, year 2 how much is reversed? 2. What is the percentage? 0. Tax holiday 0%. Year 4 how much will reverse? How much is a percent? Year 5 what is the percent? Pakka. So now rule. Sir, 2 plus 2 plus 2 how much? 6 is reversing in the holiday period when the tax rate is 0%. Correct or wrong? So first year how much difference erased? 10. How much reversed? 6. Balance? On the 6 how much DT you need to create? 0% because future tax rate is 0. So no DT on the 6. Balance how much is there? 4 in first year, 20 in second year. This will reverse after the holiday period when the tax rate is 40%. So you have to create only on 4 and 20 but not on 6. Logic clear? Pakka? Rule enti ante those differences erased and reversed during the holiday period, no need to create tax, no need to create DT. Clear everybody? Timing differences erased during the period and reversed during the period. How much erased during the period? 30. How much is reversed during the period? 6. So can I tell something like this? 6 erased during the period, 6 reversed during the period. Yes or no? And hence on this 6 no DT. 24 erased during the period but will reverse after the tax holiday period on which DT is required. Clear everybody? So to tell you another example, I guess, let me check out. No, there's no example. Let me give you one example. Something like year 1 and year 2. Difference erased. Plus 100 plus 200. Clear everybody? From year 3 to year 10, total tax holiday period. From year 3 to year 10, minus 20 is getting reversed. Minus 20, my intention is all about reversal. Clear everybody? Tax rate is equal to 50%. Answer how much DT you need to create. Okay, let us check out. From year 3 to year 10, reversing. How much per year? 20 per annum ankondi. 20 is for year. So 2 years if you have taken off 8 ante kada 3 4 5 6 7 8 9 10 8 years multiplied by 20 how much? 160. So this 160 you have to reverse. First year how much is there? 100. How much is reversing? 160. So 100 still 60 is there. That will be reversing in the second year. So balance how much will be there? 120. So 120 140 200 minus 60 140 into 50%. Clear everybody? Even while checking reversal you have to follow FIFO basis. First erased will be reversed first. In the first example I have reversed this 6 from this 10 year 1. Balance 4 is there. Even in the second here you will be getting reversed of this 160 from 100, not from the second year portion. Pakka everybody? That is the concept of tax holiday period. So take care. Rule. Difference arising during holiday period and reversed during holiday period, no tax, no DT. Arised during holiday period, reversed after holiday period, you have to create DT. Pakka everybody? Last and final, MAT. I hope you know the concept of MAT first. Minimum alternate tax. As simple as such. Say for example, tax as per normal tax records, 1 lakh. Tax as per MAT records, something like 1.2 lakh. How much you have to pay? 1.2 lakh, whichever is higher. Tax as per normal records, 1.5 lakhs. Tax as per MAT records, 1.2 lakhs. How much you have to pay? 1.5 lakhs. Clear everybody? So that is MAT. MAT records is nothing but whichever is higher you have to pay that. Minimum alternative tax. Further more discussion you will be having in your income tax. But to me, tax expense in case of MAT. Tax expense in case of MAT. Already we know TE is equal to CT minus DTA or CT plus DTL. Am I correct or wrong? For this, add excess of tax paid. Excess of tax paid over normal provisions when compared to MAT. Excess of tax paid will be added to the tax expense. Excess of tax paid over normal provisions. Clear? So tax expense is equal to CT minus DTA or CT plus DTL plus excess of tax paid over normal provisions. Clear? Let's do an example. Check out this one. Accounting profit 6 lakhs. Tax rate 20%. As per accounting record, 6 lakhs into 20%. 1,20,000. Book profit as per MAT and MAT. 3,50,000 multiplied by MAT rate 7.5%. 26,250. Income Tax Act 60,000 into 20%. 12,000. Clear everybody? Okay. You have to pay whichever is higher. So how much you have to pay? 26,250. First let us do our concept. We know TE. Am I correct or wrong? TE is equal to CT. How much is CT? So put the 12,000 first. Next let us think whether it is DTA or DTL. Sir, check out profit 6 lakhs. Profit tax 60,000. Profit as per accounting records is more. Profit more in the sense expense less. So you have to create DTL. Am I correct or wrong? That is the difference between 1.2 and 12,000. Correct or wrong, sir? So 1.2 lakh minus 12,000. How much? 1,08,000. So CT plus DTL. That is 12,000 plus 1,08,000. Normally over. Now for this you just have to add excess of tax paid. How much you are paying now? 26,250 for a payment of rupees 12,000. Excess how much is there? That 14,250 will be added. So check out. Yeah. 12,000 plus 1,08,000 plus 14,250, which is what your final answer. Clear everybody? So take care. CT minus DTA or CT plus DTL plus excess of tax paid over normal provisions. Pakka? You already know these things to analyze. Plus excess of tax paid over normal provisions, you just need to deduct. Understood? That is the end of accounting standard number 22. And hope you have understood. So if there are people who are anybody to take choice with respect to accounting standard number 19 and AS 22, generally ఇవి రెండు తీసుకుంటా ఉంటారు. But my suggestion, AS 19, whatever you are able to prepare. Likewise, I told you sale and lease back, operating lease. That is concept is very easy, provided if you are having rules at one stretch that you can prepare. Initial conditions you can prepare. But that mean point, that depends on you. And finally, AS22, I don't think no provision is tough. Just with some common shortcuts, you can simply crack that. And anyways, that is the end of this standard. Just get ready. We are going to start accounting standard number 9. Yes, ipude. Because actually we are 10 minutes late. Break is from 5 to 5:15. If you want, you go and come back. I don't have objection. Go and come back. Actually, we are 10 minutes late. As per the planned thing, AS24 is late. AS9, by this time, we have to start that. Anyways, just within the next 2 minutes, we are going to start AS9. So, fine. The next standard, accounting standard number 9, revenue recognition. As simple as such, you are having 3 parts where you have to learn these 3 parts in revenue recognition. Number 1, sale of goods. Number 2, rendering of services. Number 3, use of enterprise resources by others. Okay. So that is all your revenue recognition. AS9, sale of goods, rendering of services, use of enterprise resources by others. These three things will have to be considered in accounting standard number 9. Once if we have considered these three parts, automatically the standard is over. But remember, there is a rule that first of all you have to recognize the revenue only when it is certain. If it is uncertain, we will not recognize the revenue. Only when if it is uncertain, only when it is certain, you have to recognize the revenue. If there is uncertainty, you have to postpone the revenue. Revenue will be recognized only when then dash is transferred. Ownership is transferred. Along with ownership, dash will be transferred. Risk and rewards will be transferred. Take care. Ownership will be transferred. Along with ownership, risk and rewards will be transferred. And collection of amount. Collection of amount should become certain. If it is uncertain, we will postpone the revenue recognition. Clear everybody? If it is uncertain, we will postpone. One very important thing. If subsequent uncertainty. Sir, what is the meaning of subsequent uncertainty? Initially at the time of recording, it is certain. And hence you thought of like receiving the amount and hence you have recorded the same. But subsequently it had become uncertain. Initially certain, later on uncertain. You should not reverse. You have to create a provision. Understood? These are the rules. What's the first one? Dash must be transferred. Ownership along with this risk and rewards. And now you have to record only when then dash is certain. Collection is certain. If collection is uncertain, recognize a postponer. Postpone. If subsequent uncertainty. What is subsequent uncertainty? At the time of recognition it is certain. Future it had become uncertain. At that time, reverse or don't reverse? Don't reverse. You have to create a provision. Understood? This is the first rule. Now, we will be having special cases. We will analyze each and every special case. Special case number 1. Delivery is delayed at buyer's request. Delivery is delayed at buyer's request. Buyer takes the title and he accepts the billing, which is commonly called as bill and hold sales. So buyer had gone to a shop. He had accepted the title. Ownership is transferred. Bill is printed but the goods were not yet delivered. The delivery is delayed at the buyer's request. Buyer himself is telling, sir, please stop the delivery. So you just please stop the delivery. I will intimate you. At that time you can deliver. Clear? In this case, when seller can recognize the revenue? Yes, point number 1, stock in hand. Stock in hand, identified, packed, ready for delivery. 4 conditions. Clear everybody? What is the first one? Stock in hand, identified, packed, ready for delivery. In the sense, seller should possess the stock. Yes, sir, I am having the stock. Were the goods identified? Yes, buyer had identified the good also. Were the goods packed? Yes, packed. Are you ready for delivery? Yes. If all the 4 conditions are satisfied, now buyer will intimate you, sir, deliver the good. Immediately you have to deliver. If all those 4 conditions are satisfied, you have to recognize it as revenue. If any one of the conditions are not yet satisfied, you are not supposed to recognize the revenue. Clear? Sir, is the buyer accepts the title or not? Yes. Is the ownership transferred or not? Yes. But delivery is delayed. Delivery is delayed at buyer's request. So what are the 4 conditions? Stock in hand, identified, packed, ready for delivery. Then seller can recognize the revenue. Next one, delivery is subjected to condition. First one, installation and inspection. As simple as such. You have purchased an AC. You have purchased an AC. The final work of the AC will be completed only when it is installed. Correct or wrong? Say for example, from Flipkart you have ordered one AC. AC was in your home now. But Flipkart company cannot recognize it as its revenue immediately. That has to be installed and it has to be inspected by the customer. If customer or the buyer told, yes, I am okay with that AC, then the service is totally completed, then automatically recognize the revenue. Clear everybody? Hey, delivery is subjected to installation. If at all you did not choose the installation, you have purchased only AC from the Flipkart. installation is not their responsibility, then the work is done. Clear? Huh? So you have purchased an AC and the AC was here. It was packed and ready. So now Flipkart work is over. You are just asking some other outside technician to affix the same AC. AC is not working. You cannot do anything. Understood? Huh? Delivery is subjected to installation. At the time of purchasing, if installation is also a package, this is what the procedure adopted. At the time of purchase of good, if installation is not a package, then after delivery of the good, the work is done. Clear? And next one, on approval basis. I mean sale on return on approval basis. As simple as such, three things are there. Number one, the goods must be approved. Approved might be either expressed or implied. Goods must be approved. Approved will be either expressed or implied. Expressed in the sense buyer is telling, sir, I am ready to purchase the good. Implied in the sense, say for example, he told 15 days period. If within 15 days period he did not return the goods, it implies that he has accepted. Or he has sold the goods to some other person. Without becoming an owner, you sold the same goods to some other person, which implies that you have accepted that sale. Clear everybody? Or you have directly used the good. Without telling him that I have purchased the good, you have directly used the good. Implied. Clear everybody? So, on approval in the sense, goods must be approved. Approved might be either expressed or implied. Expressing in the sense, he has to express physically, and implied in the sense, some sort of symbolic action. Symbolic approval. Something like you have sold the goods to other person, or you have used the goods, or the time period is over. Clear? Next one, guaranteed sales. Delivery is made giving the buyer an unlimited right to return. Something like, hope you know the concept of guarantee and warranty. You have purchased a phone with 1 year guarantee. So, do the shopkeeper or do the mobile phone owner needs to recognize it as revenue immediately, or will he wait? Will the shopkeeper wait till the completion of 1 year? Question ardhamainda? Purchased a mobile phone. 1 year warranty or 1 year guarantee? So, will the shopkeeper, mobile shopkeeper, has to wait for 1 year, or he has to recognize the revenue immediately? Recognize the revenue immediately, provided he needs to create some provision, because anything might have happened. So, either in guaranteed sales or warranty period, for that period they need to create provision, but they can recognize the sale immediately. Consignment sales. Two parties are there. Number one is consignor, number two is consignee. Both parties will be recognizing revenue only when it is sold to the third party. Who will sell? Only when consignee is sold to third party, consignee will be recognizing his commission as his income. Consignor will be recognizing the sale as his revenue. Clear everybody? Next, cash on delivery sales. Only when the goods must be delivered, only when the cash must be paid. Two things must happen. Goods must be delivered, cash must be paid. Next one. So take care, okay? This is quite opposite to your hire purchase. Sir, in hire purchase, what will happen? Listen. In hire purchase, what will happen? First, the good will be delivered. Correct or wrong? Then you have to pay installment on a monthly basis. At the end of the period, ownership will be transferred. But this is a style of good where you will start paying the installments. You will start paying the installments. When it had become one substantial deposit, then the good will be delivered to you. Clear? Huh? Something like to tell you all the gold bonds nowadays. I'm sorry, not gold bonds. Gold scheme nowadays. If you have gone to Khajana, or if you have gone to this Joya Lucas or Josa Lucas or Vaibhav, wherever. So there will be a scheme called, sir, every month you pay me 1,000, 1,000, 1,000. 12 months will be completed. Then it will become 12,000. Then you can take the gold worth of that price, which is nothing but payment is done in installments, and at the end of last installment, the good will be delivered. Automatically. When do seller needs to recognize the same, sir? As simple as such. Whenever the period is over, whenever the good is purchased, or whenever the good is delivered. Understood? But sometimes, listen, say for example, every month customer is paying 1 lakh. Like that he has to pay 12 months. totally it will become 12 lakhs, and then machinery will have to be sold to the buyer. I mean, it will be sold to the buyer. Clear everybody? So A is paying 1 lakh every month, but exactly at the end of 10th month, he is having hard need of that machinery. So Mr. A, that is buyer, is requesting the seller. So all these 10 months I have paid the amount very promptly. So remaining only 2 months are there. I will also pay that 2 months amounts very promptly, but please trust me, I am in need of that machinery in a very urgent way. So please try to deliver the same. Now, in a place of seller, what do he think? Still there are how many months? But not a big deal, because already 10 months deposits he had made it very promptly. So let the ownership not get transferred to him, or what not the things, that is their condition. That is the terms and conditions which were accepted between the buyer and the seller. But on a common note, if you think with hard common sense, 10 months completed, 10 lakhs amounts promptly received, it is his urgency, he is in need, so let us deliver the good. Why? Because the sale is consummate. In the sense, sale is absolute. Even after 2 months, I have to sell the good. Correct or wrong? But already major period, that is 10 months, 10 lakh. One substantial deposit is made with the seller. So automatically things will go good. Clear everybody? Sir, what is the general rule? You have to wait till the period completes, or till all the installment must be cleared, you have to wait. But exception, if he is in need, it is an understanding between the seller and buyer. Whenever the substantial deposit is made, they can start selling the goods. Clear everybody? Next one, special orders or shipments, which is nothing but your job costing. Hope you have remembered. First you will put an order, and after putting an order, then he will be manufacturing the goods and he will be selling the goods. In this case, when he has to recognize the revenue, sir, as simple as such. First one, did you remember? Delivery delayed at buyer's request. 4 conditions: stock in hand, identified, packed, ready for delivery. It is the same here. Say for example, you have ordered lens cut specs. Okay, first of all, it must be manufactured by them. After manufacturing by them, you have to identify, yes, these are the specs that I have ordered for you. After identification, those must be packed and it must be ready for delivery. If all the 4 conditions are satisfied, they can recognize it as revenue. Understood everybody? One more point is there here. If at all such good is supposed to sold along with installation and inspection, you can recognize it as revenue only after installation and inspection. Say for example, you have given an order for manufacturing a machinery. They have manufactured a machinery, identified, packed, ready for delivery. It was delivered at your premises, but in the terms and conditions, you are having one more condition, that the machinery must be installed. So only after the installation completes, he can recognize it as his revenue. Understood? Next one, sale or repurchase agreements, which is purely similar to the concept of financing. I sold to you, you sold to me. Sir, if I sold to you the same good, again if you are selling me the same good, what point is there in that which is called as sale? It is not called as sale. It is a concept of refinancing. Clear everybody? It will not be dealt by accounting standard number 9. To tell you an example, A sold to B, B sold to A. A sold, selling price, cost price originally to him is 1 lakh, selling price is equal to 1.2 lakh. What is the cost price to B? 1,20,000. Again he sold the same for 1,50,000. On the same day, I sold to you at 1,20,000, you sold to me at 1,50,000. So it is not appearing like sale. But if you have observed the logic here, what happened? Yes, it is nothing but a financial arrangement, because A is paying 1,20,000 and A is receiving 1.5 lakh. So extra 30,000 is received. Clear everybody? It is a kind of financial arrangement. It's a way of financing. So accounting standard number 9 will not be dealing with such kind of thing. And sale to intermediary parties. As you all people will be knowing this one, something like what is this called? Wholesaler will be selling to agent or distributor. he will be selling to retailer. Finally, he will be selling it to customer. And of course, manufacturer will be selling it to wholesaler. Getting my point, everybody? Now, very, very important thing is all about when these intermediary parties can recognize it as sale. Very simple. If the ownership is transferred immediately, recognize immediately. If the ownership is transferred subjected to the return of goods, then don't recognize immediately. Only when the agent sold to the third party, you need to recognize. Example. Hope you will be checking out with Rakhi stalls on Rakhis on the day of Rakhi Purnima. Or you will be going with some Diwali stalls at the time of Diwali. Say for example, Mr. A sold 1 crore stock to Mr. K. Now, there is a deal between these two people that Mr. K is telling, sir, if any goods are remaining, I will return to you. Clear? Then, Mr. A cannot recognize the entire 1 crore as his revenue. Only when K sold to the outsiders or the third parties, then he can recognize. Then both the parties can recognize it as revenue. Understood? Clear? Similar to consignment. You can tell like that. But say for example, Mr. A sold the goods to Mr. K to the extent of 1 crore and Mr. A clearly told the entire ownership is transferred to you. And hence, even though the goods were unsold, you cannot return it to me. In such a case, Mr. A can comfortably recognize it as revenue. So to tell you, sales to intermediary parties. If the ownership is immediately transferred, recognize immediately. If the sale is subject to return of unsold stock, recognize only when the intermediary sold to the third party. Understood? And the next one, subscriptions for publication. Subscriptions for publication is nothing but, sir, monthly magazines will be there. Correct or wrong? Likewise, you will be coming across with some of the things like Swati magazine or Discover magazine or even your Chartered Accountant journal or Sanatana Saradi magazines. Like this you are having. Generally, you know what happens for these monthly magazines? You will be paying yearly subscriptions. I will be paying 1200 for all the 12 months in the first year itself. Clear? So every month they will be sending one copy to me. In this case, when can they recognize it as revenue? Very, very simple. If at all the delivery is under straight line method, every month you will be delivered with one copy. Then 1200 divided by 12 months. He will be recognizing 100 per month as revenue at the end of each and every month. But if at all the sale is subjected or sale is vary, like 1 month delivering 5 copies, another month delivering 2 copies, then it will be done on that basis itself. Clear, everybody? So subscriptions for publications. So check out. A Limited received 2 lakh subscriptions for the scheme whereby the customers are required to pay rupees 6,000 for which they will be entitled to receive a magazine for 3 years. So automatically 2 lakh subscriptions to 6,000. Whereas here you have seen that it is purely on SLM basis. Because for 3 years how much you have to pay? 6,000. So 6,000 divided by 3 years, 2,000 per annum. Clear? But if at all the delivery, something you paid 10,000 already and you are telling you will be booking an order prior to the month. Next month I want 6 copies. After that month I want 10 copies. Like that you will be booking the order. In such a case it will vary. Understood, everybody? Sir, here subscriptions for publication. If at all the order or the delivery is uniform, follow straight line method. If the delivery is not uniform, then it will be on number of copies sold. Clear? Fine. Next one, installment sales. So installment sales purely opposite to hire purchase. In the top, I'll tell you, listen very, very carefully. Hire purchase. I'll be leaving you just within 2 to 3 minutes. Just listen. In hire purchase, what happens? First, sell the good. Then pay the installments. Then ownership is transferred. In installment sales, what happened? First, sell the goods. Also, ownership will be transferred. Then you have to pay the installments. In series of payments, I told you like gold scheme. In series of payments, what happens? First, payment in installments. And then good will be sold. And finally, ownership will be transferred. Clear? Hire purchase is not dealt here because it is AS19. This will be dealt here itself. Already we have discussed. And now coming to installment sales. Sale is done, and since the ownership is immediately transferred, and if at all the collection is certain, then you can recognize the revenue immediately. Understood everybody? So that is a concept of installment sale. First of all, deliver the good, sell the good, and get the amount in installments. First instance, since the ownership is transferred, you can recognize it immediately, provided when the collection is certain. Last and final, trade discounts and volume rebates. Trade discounts and volume rebates are not like revenue at all. They has to be deducted from sales and purchases. Clear everybody? Sir, hope you know trade discount. Volume rebate is nothing but if you purchase more than 1000 goods, you will be getting an offer of 0.5 discount. That is called as volume rebate, which is also called as quantity discount. If you purchase more than this number of goods, you will be getting such discount. In these two cases, it is not to be treated as revenue. It has to be deducted from the cost price. Understood everybody? This is part 1 of the standard. That is sale of goods. In the next session, we are going to continue with accounting standard number 9 with another 2 portions, that is rendering of service and use of enterprise resources by the others. And after that, we are going to discuss accounting standard number 9 and the leftover standard 24. We will discuss that, those two things. Okay. And then we will be left with still 3 more standards, 7, 26 and 29. We'll try max to cover all the 3 standards. If not, 2 standards will be perfectly revised and 1 more standard, very important things will be revised. Okay. So just get ready for the next session. You can take a break. Let's continue with accounting standard number 9. So let's continue with the concepts of rendering of services. For rendering of services, there are 2 methods. Number 1, completed service contract method. Number 2, proportionate completion method. What is completed service contract method and what is proportionate completed method? Sir, completed service contract method is nothing but only after the completion of performing the service, you can recognize the revenue. But proportionate completion method, in the sense you will be having more than one service to be rented. So partly, if at all they have completed any of the acts in that service, they can recognize the revenue. If not, they will not recognize the revenue. I'll give you an example. Say for example, you have gone across with, you have entered into a contract with manufacturing a bench. Yes, manufacturing a bench. Only one bench. So by the year ending, is asking like the time had come, or by the year ending, bench was 70% manufactured. And the total price that is to be paid for bench is 10,000. Can the seller recognize something like the total price is 10,000? Since 70% of the bench is completed, I'll recognize 10,000 into 70%, 7,000. Possible? Absolutely no. 70% of the bench, in the sense something will be completed, sitting will not be completed. Then automatically it is not possible to him to recognize it as revenue. So in these cases, he have to follow completed service contract method. Only when the total service is completed, he can recognize it as revenue. Otherwise, he is not supposed to recognize it as revenue. Clear everybody? But say for example, this time we have entered into a contract for manufacturing 100 benches, out of which at the year ending 70 benches completed. So totally 1 lakh multiplied by, since 70 benches completed, 1 lakh divided by 100 into 70 benches, he would like to recognize to the extent of 70,000. This time is it possible or not possible? Absolutely possible, which is nothing but proportionate completion method. To tell you, if in service there is only one act, they have to follow completed service contract method. If in service there are more than one acts, then they can follow proportionate completion method. Understood? That is the concept of what is it called? Different kinds of methods for recognizing the revenue under services, rendering of services. Now check out. We are having different situations. Let us come across with all those situations. First one is installation fees. Previously, I told you one example. You have ordered an AC from a Flipkart. That's it. Installation is not a package of that. You are calling the outsider for installing the same. Now outside had come and he is telling that the amount for installation is 2000. You told okay. When can he recognize that 2000 as his revenue? Only after the installation of AC and it is inspected by the customer. Because ultimately he has to satisfy, am I correct or wrong? So that 3000 or whatever the amount 2000 is there, you have to pay him and he will be recognizing it as revenue only when the service is performed. Clear everybody? So, sir, at the time of sale of goods, I told goods must be sold, ownership must be transferred, collection must be certain. If there is uncertain, postpone the collection. If it is subsequent uncertain, you should not reverse, you have to create a provision. Now all the things are same except service must be rendered. Except ownership must be transferred. Here you are having service must be rendered, collection must be certain. If there is uncertainty, postpone the revenue recognition. If there is subsequent uncertainty, don't reverse, you have to create a provision. Understood? So in that, first one is all about installation fees. So remember, if installation is provided as a package of sale of good, then it has to be treated as sale of good. If installation is like a separate package, then it will become rendering of service. And the next one, advertisement income. So advertisement income is all about, remember and listen very carefully, only when the advertisement appears before the public. They can recognize the revenue only when the advertisement appears before the public. For your kind information, say for example, you have booked for an advertisement in a newspaper slot for the month of April. Obviously, for the month of April, you have to book in the month of March, say for example. Okay, so in March, you have booked an advertisement that is to be appeared in the month of April. Now, this newspaper agency, when can they recognize it as revenue? Is it for the month of March or for the month of April? For the month of April, because newspaper will be published only on that date, it has to be recognized as revenue only on that day. Clear everybody? Listen very carefully. You have, this time you have booked an advertisement for a magazine. This time you have booked an advertisement for a magazine which will be published on April 15th. An advertisement income, whatever is there, you have received to the extent of 10,000. When can you recognize this 10,000? Is it in the month of March or April? You have received amount of rupees 10,000 in the month of March for an advertisement which is to be circulated to the public on April 15th. So when can you recognize it as revenue? April 15th, that's it. Remember very carefully, you booked it for April, but due to some delay, it has postponed till May 5th. Now, when they can recognize it in income? April or May? May. Whatever, for which month, all those things are thrash for us. Only one needy, when the advertisement appears before public. Clear everybody? If it is television, it has to be telecasted in the television. Clear everybody? Simply when the advertisement appears before public. Next, insurance agent commission. Very simple. So what kind of insurance policy is that? First you have to check out that. Is it like a renewal policy or is it like a new policy? If it is new policy, very simple. On the effective date of commencement. Likewise, whenever it is commenced, at that time he can recognize his commission as his revenue. Say for example, insurance premium to be paid is 10,000. On that premium, 30% is his commission to this insurance agent. So 3,000 he can recognize it as his income if it is a new policy, whenever that policy was approved by the insurance company. Clear? If it is a renewal policy, when the renewal date is approved. If it is new policy, he will be using a terminology called effective date of commencement. Effective date of commencement is nothing but whenever the policy is approved. Whenever the renewal is approved or whenever a new policy is approved, you have to consider that date as his income. Next, tuition fees. So tuition fees is nothing but a kind of school fees. You have to consider that to be recognized on the period of instructions. Likewise, say for example, we are receiving 10,000 to be paid for 10 months. 10,000 for all the 10 months. So on each and every month completion, you can recognize to the extent of 1,000. A kind of proportionate completion method. Understood everybody? And moving on to the next thing, admission fees. So you have to check out for what kind of things you are receiving admission fees. To tell you, say for example, zoo. Entrance fee you will be having for zoo, which is called as admission fee. For circus you are having entrance fee, which is a kind of admission fee. Or for exhibition you have to take a ticket, which is called as admission fee. Clear everybody? Now also you have to check out, is the admission fee for one service or for bundle of services? Likewise, if you have gone for Highland or something like that, entrance fee, say for example 200. If you would like to enjoy each and every element in Highland, say for example you would like to go for swimming pool, or you would like to go for car riding or something like that. Getting my point? For all the things on a collectively you have to pay 670 rupees. Say for example entrance fee comes to 200. It is a single service. There's no problem. You can immediately recognize it as revenue. But 670 rupees on a collective fees you have taken for all the services to be enjoyed in Highland. Then this has to be proportionately accounted for each and every type of service that they provide. Clear everybody? That is a concept of admission fee. So you have to check out for what kind of things you are receiving the fees. Also for your kind information, what is this called? 5 days course they will be conducting, or 5 days programs they will be conducting, for which you have to pay the fees. 5 days program they will be conducting, for which you have to pay the fees and entrance fees. Likewise, they are telling one day they will be going with some classical dance, one day magic show, okay, one day some other western dance show, something like that. For all the 3 days they are asking you to pay 3,000. If you are interested to pay that 3,000, then this 3,000 has to be apportioned for the 3 programs. Clear everybody? So admission fee, very very simple. If at all the admission fees is only for one event, then it will be recognized when the event is completed or when the event is performed. If at all your admission fee is having bundle of events, you have to recognize the same on a proportionate basis. Something like last and final example, like cricket match. You have bought a ticket for cricket match, so they can recognize it as revenue only when the cricket match is completed. Only when the cricket match is organized. Before organizing the cricket match, they cannot recognize it as revenue. Sir, all these remaining things are bacha. I mean to tell, you have gone for exhibition, 50 rupees entrance ticket. After taking the ticket, immediately you will go, right? So immediately they can recognize it as revenue. But 3,000 for artistic performances. One is classical dance, another is magic show, something like that. So whenever each and every event is taking place, you need to proportionately recognize it as your income. Understood everybody? That is about admission fees. Next is entrance fees and membership fees. Even this is also very very simple. Sir, point number 1, entrance fees is generally capitalized. Likewise, you are having non-profit organization or non-trading concerns. In that entrance fees, whatever is there, it is to be capitalized. But membership fee, coming to membership fee, which is nothing but subscription. What kind of services you are offering? Say for example, in some of the clubs, they will be collecting some membership fees only for the purpose of membership. Then it can be immediately recognized whenever the period completes. But if at all you are providing membership fee, which also includes some sort of gym subscription or tennis court subscription, something like that, then it has to be proportionately apportioned for. Hope you know the concept of clubs. So in club you will be having one swimming pool and you will be having one shuttle court, and also journals will be released by that club. If at all your membership fees includes exclusive membership, you can immediately recognize whenever the period completes. If your membership fee includes all the subscription fees, then it will be proportioned. Understood? Next, financial service commission. See, it is very very simple, but listen carefully. Financial service commission. What is financial service commission? Say for example, you have taken a loan, but for the purpose of taking a loan, you have approached an agent. Loan amount is 10 lakhs, out of which agent told that he is going to take 5%. So he had taken amount of 50,000. So this 50,000 can be recognized as the income by the agent only when the loan is approved. Clear? When the loan is approved, he can recognize as his income. But you are approaching a consultancy or you are approaching a consultant agent where you have given the rights of monitoring the loan. You have given the rights of monitoring the loan. Sir, what is the meaning of monitoring the loan? So initially you have got a loan from SBI where the rate of interest is 9.5%. Later on, similar kind of loan is offered by HDFC Bank at an interest rate of 9%. Later on, the same kind of loan is offered by HSBC Bank at a rate of 8%. So what is better? Repay this and take this loan. But you are here to do the business, not to check out which bank is offering the interest at what rates. So generally what you will be doing is all about, you will be approaching a consultant agent. After approaching a consultant agent, he will monitor your loan. Say for example, you are paying 10,000 to him for 5 years for just the purpose of monitoring the loan. Similar kind of loan will be offered from different banks at different rates of interest. What is cheaper or what is better? So he will be finding the same and he will be telling you the outcome finally. So for this purpose, you are paying him 10,000 for how many years? 5 years. So it is not a one-time service, it is a continuous service. So which has to be recognized proportionately. Clear? So financial service commission, two types. Number one, service is provided only once for all basis. Then you have to go for one-time recognition whenever the service is rendered. But if at all it is provided on a continuous basis, it has to be apportioned. Understood? That is all about the concept of rendering of services. Now you are having the third part of the standard. And the third part of the standard is all about use of enterprise resources by others. Listen, use of enterprise resources by others. The resources are being used by others. Those resources are belonging to enterprise. Those resources are belonging to enterprise, but those are used by others. First of all, you have to check out how the resources are used by others. Is it in the form of loan or is it in the form of ownership? Likewise, your business concern had invested 1 lakh in A Limited. Your business concern had invested in equity shares. What is the return that you will get? Dividend. Correct or wrong? Sir, business concern invested how much amount? 1 lakh in equity shares of A Limited. In turn, we will get some dividend. So point that here you need to understand very carefully is all about this 1 lakh belong to our business concern. These are our resources used by A Limited in the form of ownership. For this we are getting dividend. So dividend can be recognized by our business concern only when it is declared. Already in AS4 we have seen, as at the year ending there may be a conception or condition, but that is not considered. Only when there are hard proof or the written proof, only then you are going to consider it as dividend. Am I correct or wrong? So dividend, the must and should point is that declaration. Dividend will be recognized as income only after the declaration. Pakka? That is the concept of dividend. So dividend can be recognized by the business concern only after declaration. Remember, not proposing, because it will be proposed by board of directors and it has to be approved by the shareholders. Only after declaration it will become liability to the business concern, and only after declaration we can recognize it as our income. Pakka. Now moving on to the next thing. Our resources are used by the others in the form of a loan. We have given that 1 lakh to others in the form of a loan. Since we have given it in the form of a loan, we will receive interest on that. So interest has to be recognized proportionately. Interest has to be recognized proportionately. Say for example, you have given 1 lakh on September 1st. Your year ending is March 31st. So 1 lakh into rate of interest multiplied by 10 by 12. I'm sorry, not 12. 7 by 12. Since from September 1st, it lasts for 7 months. This 7 by 12 is nothing but proportionate. Understood? Sir, interest has to be recognized on an proportionate basis. Dividend has to be recognized on an only when it is declared. And last and final, royalty. So what is this royalty? Royalty is very, very simple. Listen very carefully. Royalty is nothing but for use of your assets, you will be getting some benefit, which is nothing but royalty. Generally, royalty will be given on copyrights like books. On publishing of books, you will be getting royalty, or for the extraction of mines and minerals, you will be getting royalty. Clear? So our resources are used by the other business concern, simply to tell you for our better understanding on assets. Clear everybody? On assets we have got some royalty. So that royalty has to be recognized as per agreement. It has to be recognized as per agreement. They will be writing in agreement for each and every unit of extraction, for each and every production of unit. Getting my point? Like that they will be writing in their agreement. For each and every unit of production you have to pay 2 rupees for that. For each and every unit of extraction you have to pay a royalty of 10 rupees. Clear? So like that they will be having an agreement. They have to recognize the same as per agreement. Understood? Pakka? So what are the use of enterprise resources by others? Might be either in the form of investment in equity or loan or assets. If it is used by them in the form of equity, then they will pay us dividend. If it is in the form of loan, interest. If it is in the form of assets, royalty. So interest has to be recognized on proportionate basis. Dividend has to be recognized on declaration basis, and royalty has to be recognized as per agreement. Of course, accrual basis. Clear? Now very, very important thing. Listen. Sir, for sale of goods and rendering of services, we have discussed that first of all, ownership must be transferred. You have to recognize only when the collection is certain. If the collection is uncertain, postpone the revenue recognition. If it is subsequent uncertainty, then you should not reverse. You have to create a provision. Same conditions for rendering the services also, except the first one, rendering of services. Collection must be certain. Uncertainty, then you have to postpone. If at all subsequent uncertainty, you should not reverse. You have to create a provision. But now listen very, very carefully. You have to recognize only when the collection is certain for interest, dividend, royalty. If there is uncertainty, you have to postpone the revenue recognition. You have to recognize dividend on declaration basis, interest on proportionate basis, royalty as per agreement. Royalty as per agreement or accrual basis. But biggest part is here. If at all there is subsequent uncertainty, here you will be reversing it for sure. So you might have heard provision on debtors, but did you ever hear provision on interest? Provision for royalty? No. Clear everybody? So for use of enterprise resources for others, then obviously you have to reverse that. You will not create a provision. Understood? Say for example, you are having some royalty receivable, which is having debit balance to the extent of 1 lakh. But subsequently it had become uncertain. So immediately it has to be cancelled by crediting the same to royalty receivable, and debit, since it is not, it has to be debited to P&L. Logic understood? Sir, clear? Sir, you are having royalty receivable to the extent of rupees 1 lakh. Since it is initially certain, you have recognized the royalty in your P&L account. But later on, it had become uncertain. Since it had become uncertain, you cannot create provision for that. You have to reverse the same. So since royalty receivable is having which balance? Debit balance. So it has to be reversed by crediting. So to royalty receivable. Since it is loss, it will be debited with P&L account. Understood? That is a concept of accounting standard number 9. So just check out. Let us quickly do some of the examples. So this is something like sale in manufacturing fine paper. Stages of production were given. Raw material, work in progress 1, work in progress 2, fine paper rolls, ready for sale, in the sense finished goods are ready, sale agreed and invoice raised, delivered and paid for. In which stage you need to recognize it as revenue? Sir, till this point we will not recognize revenue at all because it is a process of production. Sale agreed and invoice raised, delivered and paid for. Answer. Sale agreed and invoice raised, because even we know the concept of delivery delayed at buyer's request. You need not wait till delivery. If the sale is agreed and if the invoice is raised, automatically it implies that the ownership is transferred kada. So automatically you can recognize at that point itself. Also you can recognize revenue when there is stock in hand. Remembered, identified, packed, ready for delivery. Actual delivery is not needed, ready for delivery is highly enough. So sale agreed and invoice raised, in the sense ownership is transferred and you can comfortably recognize the revenue. Next. Check out different situations you are having. Sir, on 31st March, goods worth 2,40,000 sold to a company, but due to refurnishing of their showroom on the request of the buyer, goods were delivered on 10th April. So do you need to recognize it on 31st March or 10th April? 31st March, actual delivery is not needed. If it is ready for delivery, we can recognize. Next, on 25/1/2019, 2 lakh were sent on consignment basis, of which 20% were unsold at the year end. So you can recognize to the extent of, because we know the concept that consignment sales only when the consignee sold to the third party. Perfect. Next, 2,40,000 sold on approval basis on 1/12/2018. Period of approval is 3 months. So 1/12/2018 plus 3 months, in the sense it expires on 1/3/2019. Ante kada? Because December, January, March, 3 months. So on 1st April 2019, the period will get lapsed. Buyer sent 75% up to the year ending, but no approval was received till the year ending. How much you have to recognize? 2,40,000, because for 75% approval received, but for remaining 25% approval was not received, but the time period is over. Correct or wrong? Since lapse of time period, you can recognize it as revenue. Sir, check out. Cash sales 9,60,000, trade discount 5%. Do you need to record the trade discount as revenue? No. You have to deduct the same from your sales. So 9,60,000 minus 5%, because trade discount will be reducing your cost price or reducing your selling price. Understood everybody? That is a concept of your sale of goods. And yeah, check out this one. A company is selling the agricultural products to the dealers, and hence interest is payable at the rate 2% for the delayed payments. But recovery rate is only 10% due to various reasons. Understood? Take care. Some debtor is there. If there is late payment, we are about to collect 2% extra amount from the debtor. But our business concern is able to collect only 10% from the whole debtors. Clear everybody? To tell you, say for example, I am having 10 lakhs total debtors. If these 10 lakh total debtors delays the payment, then I will be collecting 2% extra payment, which will become 10 lakhs into 2%, 20,000. But my business concern is able to collect only 10% of the total extra revenue, that is 2,000. And remaining 8,000 I am unable to collect. Clear everybody? So now finally give me the answer. How much recognize that I can how much revenue I can recognize? So how much revenue that I can recognize? Only to which you are having certain, you have to recognize. As of now, how much you are having certain amount? 2,000. So you can recognize it as your revenue, and balance 20,000 minus 2,000, 18,000. You are not supposed to recognize it as revenue. Why? Because you are not having certainty for that. Understood everybody? Only if you are certain, you have to recognize. Since That 2000 is certain, you can recognize. Remaining 18,000 is uncertain, you cannot recognize. Understood? So that is the end of your accounting standard number 9. Just get ready. Within the next 2 to 3 minutes, we are going to start the next standard. That is accounting standard number 24. Is 24 discontinuing operations. Again, one of the easiest standards. Sir, in this standard, we have to learn the definition. Once if you have learned the definition, almost the standard is completed. Apart from that, nothing else is needed. So first of all, let us start. What is an operation? Whatever we have called segment as per AS 17, whatever we have called segment as per AS 17 is exactly operation as per AS 24. Like different names. As per AS 17, the same is called as segment. As per AS 24, the same is called as an operation. What kind of operations you are having? Business operations, geographical operations. That's it. Clear? So now check out. So what do you mean by a discontinuing operation? In our usable language, discontinuing operation is an operation which is stopped. In our usable language, discontinuing operation is an operation which is stopped. But as per accounting standard number 24, it is not the definition. As per accounting standard number 24, the definition is totally different. An operation which is discontinued, through a single or overall plan. What that single or overall plan should be, sir? Either for selling or for intention to sell. Clear, everybody? An operation which is discontinued either through a single or overall plan, either through sale or intention, either for sale or intention to sell. Say for example, there is a business concern. It is having many segments. Likewise, petroleum is one of the segment. They have decided to stop the production in petroleum segment. Clear, everybody? Now finally answer me. Is it called as a discontinuing operation or not? They've decided to stop producing petrol, or they've stopped operations from petroleum division. Can it be called as a discontinuing operation? No. Because why did you stop? Is your intention to sell, or are you really selling that? Only if yes, they are called as discontinuing operation. Otherwise, they will not be called as a discontinuing operation. Clear, everybody? So take care. Discontinuing operations is nothing but operations which are discontinued through a single or overall plan, either for sale or intention to sell. Now coming to the concepts of sale. It can be either through, take care, piecemeal or overall. Hope you know the concept of piecemeal. Individually selling of assets and individually settling the liabilities, or overall sale. At once itself you are about to sell the same. Likewise, you can call it as sale, or you can call it as demerger. Getting my point? Or you can be calling it as spin-off. What are these things? Say for example, just now I told you that we are having petroleum division. We stopped the production in petroleum division. Doesn't mean that it is a discontinuing operation. In your single or overall plan, it should be clearly stated that there is supposed to sell the division. Yes, sir. In such a case, it will become discontinuing operation. Understood, everybody? That sale, sir, I am selling this petroleum division at once. Yes, it can be called as a discontinuing operation. Or second style, from all my company, I am demerging this petroleum division and I am making it as a separate company. Yes, even then it is called as a discontinuing operation, because till now petroleum division is under our company. From tomorrow, since I am demerging the same, it is separating from my company. So as per my company, it is a discontinuing operation. Or spin-off. In the sense, I would like to transfer the ownership from shareholders or from the company to the shareholders. In whose hands ownership is there? Company. Who are the owners of the company? Shareholder. Owners or shareholders, but properties, liabilities, everything is in the name of company. Clear? Spin-off in the sense transferring of ownership from company to shareholders. That is called a spin-off. Whenever you are transferring the ownership from company to shareholders, it is quite simple that you are converting your company into a sole proprietary or a kind of partnership. Even then I will be calling it as discontinuing operation. Sir, at least for me sale is not needed. Intention to sell is also enough. Intention to sell. Initially we are not selling, but we are having hard intention to sell. Terminating through abandonment the production. You have stopped the operation by abandoning the production, which is called as termination through abandonment. Clear everybody? Stopped. What did you stop? Operation. How did you stop? By abandoning the production. By stopping the production, I have stopped my operation because I would like to sell the same. As of now not sold, but having an intention to sell. Understood everybody? Pakka? So take care. What is a discontinuing operation? An operation which is discontinued either through sale, single or overall plan, either for sale or intention to sell. Sale is of again two types, overall or piecemeal. Overall is again of three types, normal sale, demerger, spin off, and finally intention to sell. Intention to sell is nothing but terminating through abandonment. Understood everybody? Now sale in overall basis. Sale on overall basis, there must be a binding sale agreement. Will you accept or not? Sale on overall basis is nothing but I am selling my company or I am selling my division to some other company. Obviously there will be an agreement. At what price each and every asset will be transferred, at what price each and liability will be transferred, and what is purchase consideration. So all these things will be specified in an agreement which is called as binding sale agreement. Understood everybody? So binding sale agreement is mandatory in the concepts of sale on overall basis, but sale on piecemeal and sale on piecemeal basis, it is not that mandatory. Clear everybody? And also moving on to the next thing, termination through abandonment. Of course binding sale agreement is not at all needed there because we are not selling, we are just having an intention to sell. Understood everybody? Pakka? Now the next concept, initial disclosure event. Sir, when we will call it as initial disclosure event? Very very simple amma. It will become initial disclosure event. It will become initial disclosure event when, can anybody? Terms and conditions of binding sale agreement was finalized. Did you remember? Terms and conditions of binding sale agreement was finalized. Wait, I'll be showing you. Check out. Plan is finalized or agreed. To show you the terminology, plan was approved. Approval of plan or binding sale agreement was finalized, whichever is earlier. Clear everybody? Likewise, I told you that for sale on an overall basis, binding sale agreement is mandatory. So date of binding sale agreement or date of, very very important thing, very very important, formulation, announcement and approval of detailed formal plan, whichever is earlier. Take care. Date of binding sale agreement or date of formulation. First of all, it must be formulated and then it must be approved and finally it must be announced. All these three things should happen. Clear? Only when all these three things were happen, you will be considering that date. Out of these two dates, whichever is earlier. Clear? Now, sir, say for example, binding sale agreement. This is easy actually. Okay, check out. Binding sale agreement, say for example, 1st March 2011. Formulation on plan 1/2/2011. Approval of plan 1/4/2011. announcement of plan 1/5/2011. What is to be considered now? 1/2/2011. Any other answer? 1/3/2011. Okay. And the final answer is 1/3. I actually given this example because it is actually a bit confused. So listen carefully. One is date of binding sale agreement. That is this one. I already very clearly told you all these three things should complete. Formulation on 1/2, approval on 1/4, announced or 1/5. So 1/5 is your final date. So 1/3 or 1/5, whichever is earlier, that is on 1/3. Okay, everybody, that is the concept of initial disclosure event. Sir, what is the concept and why initial disclosure event? Whenever initial disclosure event is occurred, in our example 1/3/2011, from that financial year you have to start disclosing everything related to discontinuing operations. Concept understood? Huh? Initial disclosure event is found out because from that financial year you have to start disclosing with respect to discontinuing operation. Understood? Now listen carefully. You have taken a decision to sell and you have stopped the production in 2011-12 and 2012-13, and finally it was completed in 2013-14. Started sale here and finally that sale was totally completed in the year 2013-14. Clear? When it will be called as a discontinuing operation? In which year it will be called as a discontinuing operation? For all the 3 years, only for the last year. Question understood? Started sale at this point, but finally it was completed at this point. అమ్మడానికి అదేం మొబైల్ ఫోన్ వాటర్ బాటిల్ కాదు కదా, ఓ కంపెనీ. So automatically it will take some span of time, long span of time. Started at this point, ended at this point. For which year it is to be considered as discontinuing operation? For 11-12, 12-13, 13-14, all the 3 years. All the 3 years. Clear? So right from the point of starting of initial disclosure event till the ending point of sale, you will be calling it as discontinuing operation. Understood? Pakka? Now listen, last and final part. Listen very, very carefully. Last and final part. Concept is all about, you have closed an operation. You have closed an operation. Clear? You're not having sale intention to sell, but you have decided to close this operation and diverted all the assets and liabilities to another operation. I mean to tell, say for example, you are having Visakhapatnam operation and also you are having US operation. You have closed US operation and you have diverted all the assets and liabilities to Visakhapatnam operation. Clear? Now answer me. Can it be called as a discontinuing operation or not? That's it. Question is over. US operation is closed. Assets and liabilities of US operation were transferred to Visakhapatnam operation. Finally, is it a disc operation or not? No, it is not a discontinuing operation because there is no concept of sale or intention to sell. Understood, everybody? So there are some of the examples which are properly given in the standard itself. Check out. Gradual or evaluationary phasing out of a product line or class of service. Say for example, you are having product X and product Y. In the first year, the production is 1 lakh, 1 lakh. In the second year, 50,000, 1 lakh, 50,000. And in the third year, 0 and 2 lakhs. Hope you have observed. Did you observe? First year 1 lakh, 1 lakh. Second year 50,000, 1.5. Third year 0 and 2 lakhs. What happened? What did you observe from that example? ఇంకొంచెం క్లియర్గా అంటే అది అవుట్డేట్ అయినా కాకపోయినా ఇంకొంచెం క్లియర్గా. ఓకే, ప్రొడక్షన్ ఆఫ్ ఎక్స్ ఈస్ డైవర్టెడ్ టు ప్రొడక్షన్ ఆఫ్ వై. విల్ యూ యాక్సెప్ట్ ఆర్ నాట్? Production of X is slowly diverted to production of Y. So gradually phasing out or evaluationary phasing out from one product to another product line. Slowly we are shifting from one product to another product line. It is not to be considered as a discontinuing operations. Next one, discontinuing if relative abruptly and suddenly. Likewise, all of a sudden, x 1 lakh, y 1 lakh, but next year, x 0, y 2 lakhs. All of a sudden, I have changed my production line. Even then, no need to consider it as a discontinuing operation. Shifting of some production from one location to another location. As I told you, from Visakhapatnam to US or something like that, or US to Visakhapatnam. It is not to be considered as a discontinuing operation. Closing a facility to achieve productivity or cost savings. Listen very, very carefully. Say for example, process 1 to process 2 to process 3, finally finished good will come. Process 1 good, whatever is there, it can be manufactured or it can be purchased. Cost of manufacturing is 10. If you purchase, it will become only rupees 2. What will you do? Purchase. So immediately company has decided, let us close process 1. It is not having either sale or intention to sell. But since at the time of purchase, it is very cheaply available, they have decided to close the process 1. Can it be called as a discontinuing operation? No, because we have closed in order to achieve some efficiency, in order to achieve some cost savings, and hence even in this situation also we won't call it as a discontinuing operation. And listen carefully everybody. Company A is having two subsidiaries, B Limited and C Limited. Company A had decided to sell C Limited, to transfer C Limited assets and liabilities to B Limited. Clear everybody? Reason being, C Limited is also in same line of business, B Limited is also in same line of business. They have decided to close C Limited and transfer the whole business to B Limited. Okay. For the purpose of consolidated financial statements, it is not at all considered as a discontinuing operation. Very important. For the purpose of consolidated financial statements. Check out the last and final one. Selling a subsidiary whose activities are similar to those of parents or other subsidiaries in relation to CFS. I am selling one subsidiary to other person, or I am selling subsidiary to my another subsidiary. With respect to consolidated financial statements, it is not at all considered as a discontinuing operation. Understood everybody? This is the concept of accounting standard number 24. To tell you, just on a one note, take care, be careful. First of all, definition. Discontinuing operation is not something like discontinue the production. You have to discontinue the same either with single or overall plan. And that single or overall plan should have either sale or intention to sell. Intention to sell is nothing but terminating through abandonment. Whereas sale is nothing but either overall or piecemeal. And you are having a concept of binding sale agreement which is mandatory for overall basis. For piecemeal, binding sale agreement is not mandatory. Again, coming to overall basis, it can be either general sale or normal sale. It can be either demerger or it can be either spin off. Next concept is all about initial disclosure event. Initial disclosure event is nothing but date of binding sale agreement or date of formulating, approving and announcing the plan, discontinuing operation. Whichever is earlier is to be considered. Pakka everybody? In this course of action, what is the purpose of this initial disclosure event, sir? When in the year, in the financial year, when the initial disclosure event is occurred, from that year, the disclosure should start. And it should last till the end of the discontinuing operation. Understood everybody? And moving on to the next thing, the following are not needed to be considered as discontinuing operation. Number 1, gradually phasing out or evaluationary phasing out from one product to another product. And the next one, closing a particular facility abruptly or suddenly. Shifting from one location to another location, even it is also to be not considered as a discontinuing operation. We have closed a particular facility in order to achieve some cost savings or productivity efficiency. Even then, no need to consider it as a discontinuing operation. Last and final, selling of a subsidiary either to the outsider or to my another subsidiary with respect to consolidated financial statements is not a discontinuing operation. Pakka everybody? Just wait, within 2 to 3 minutes I'm going to leave you. After that we will be meeting by 6:30 and from 6:30 to 8 Our target is to complete 2 standards initially to the fullest extent. That is accounting standard number 26 and accounting standard number 29. And finally, I'll be keeping 7 at last. Or to the extent whatever are needed, I will be delivering the same with accounting standard number 7. But we'll try to cover max. But ఎంత వరకు కావాలో అంతవరకు అయితే నేను ఇది కవర్ చేసి మీకు ఇస్తాను. రిమైనింగ్ 2 things I'll cover to the fullest extent. Okay? Fine. So let's do a question. Yeah, check out this one. Dishwashing bar and cloth washing bar. 2 lakhs, 2 lakhs, 1 lakh, 3 lakh, 0, 4 lakh. Not a discontinuing operation. It is nothing but slowly shifting from one product line to another product line. Evaluationary phasing out of a product. Understood? Next. Yeah, check out this question. A company is manufacturing both passenger cars and commercial cars. They have a strategic plan to shift from passenger car segment over the 5 years. No specific plan to sell neither the division nor the asset. We are not having any concept of selling the asset or selling the division, but we are having a plan to shift from passenger cars to commercial cars. Like that, the company would like to reduce the passenger car division 20% annually. Understood? So now tell me, is it a discontinuing operation or not? Obviously no, because the evaluationary phasing out of a product. But take care, different questions were asked. If company passes a resolution to sell some of the assets of passenger car divisions and to transfer few other assets to new factory, can it call as a discontinued operation? No, because see, passenger car division might need some kind of assets, commercial car division might need some kind of assets. Whichever assets are not needed, it can sell those assets. And few assets are transferred to the new factory, and hence it is not a discontinuing operation. Take care. Point number 3. Would your answer differ if the company resolves to sell all the assets of passenger division in a phased but time-bound manner? What is phased but time-bound manner? Piecemeal distribution. Now it has decided to sell all the assets of passenger car division in a piecemeal manner. Answer, can it be a discontinuing operation now or not? Yes, it will be a discontinuing operation. Okay, everybody? So that is the end of accounting standard number 24. After break, that is sharp by 6:30, we are going to meet with another 2 standards, accounting standard number 26 and accounting standard number 29. Yes, would like to cover these 2 standards to the max extent, and AS7 will be giving you to the extent whatever is needed for the examination point of view. Clear, everybody? So let's meet after the break. Yeah. Next standard, one of the lengthier standards again, accounting standard number 26. Like, of course, it is a lengthier standards. AS 19 is not lengthy, but it is typical a bit. But AS 26 is a lengthier standard. Also, we have to deal with amortization here. Let's try to complete these 3 standards. So let me start with accounting standard number 26, which is nothing but intangible assets. Coming to intangible assets, remember first of all the definition of intangible asset. Intangible assets are identifiable non-monetary assets. Sir, what do you mean by identifiable? In the sense, identifiable in the sense, it should be separated from self-generated goodwill. Identifiable in the sense, it must be separated from self-generated goodwill. Because self-generated goodwill cannot be separable from any other things. Am I correct or wrong? To tell you something like, in the course of amalgamation, say for example, net assets is equal to 1 lakh and PC is equals to 1,20,000. How much are net assets? 1 lakh. PC how much? 1,20,000. Since your PC is greater than net assets, it is nothing but capital loss which has to be transferred to goodwill. Am I correct or wrong? So if you think with common sense, you will be getting that we are paying in excess of 20,000 when compared to the net assets. Am I correct or wrong? So now A Limited is selling the same business to B Limited. And A Limited is asking for B Limited. AUB Limited, how much you are paying? 1,20,000, sir. For how much net assets? 1 lakh, sir. So extra how much you are paying? 20,000, sir. So let's come to a deal. I will not sell my net assets to you. You just give me that remaining 20,000, enough. Understood? A Limited is asking B Limited. I'm selling my net assets of 1 lakh and you are about to give 1,20,000. I will not sell my net assets to you. So no need to pay me 1 lakh. Pay me the remaining 20,000. Does anybody will pay? Do anybody will pay that? Obviously no. This is heights of sarcasm. So you're telling something like you will not sell 1 lakh and you want that excess consideration 20,000. B Limited is about to give that excess consideration 20,000 only for the purpose of transferring of your business or transferring of your net assets. Now you are in such a way that I will not sell anything, pay me the excess consideration. Then even he will not pay that excess consideration. Reason being something like that excess might be because that A Limited is having some goodwill. So they are about to pay. But if exclusive goodwill sale is not getting possible in this situation. Am I correct or wrong? That goodwill is connected to the net assets or to the business of A Limited. Exclusive selling of goodwill is absolutely not possible in this situation, which is nothing but self-generated goodwill. So general rule, self-generated goodwill can never be separable from the business. So if you are able to separate any asset from the self-generated goodwill, then it is obviously called as identifiable. Logic clear? It must be identifiable. Identifiable in the sense it must be separated from self-generated goodwill. Sir, why only self-generated goodwill is given? Because self-generated goodwill cannot be separated from any of the net assets. If you are able to separate, then it is treated as identified or identifiable. And of course, it is a non-monetary asset. It's not monetary asset. It is measured in terms of money, and how much is that depends upon the value that the bargain. Like how much is the value depends upon the fair value of the asset. And next one, very, very important thing. Then what for purpose these intangible assets are used? Either for administration purpose or for the purpose of rentals or for the purpose of producing goods or rendering services. Clear everybody? 4 purposes: producing goods, rendering services, administration purpose, rentals. Yes, even intangible asset can be given for rentals. Return on that is nothing but a kind of royalty. Return on that is nothing but a kind of royalty. Clear everybody? Fine. So you can use intangible assets for any of these 4 purposes. Understood everybody? Now very, very important thing, listen very carefully. Sir, intangible asset always needs a support of physical substance. That is tangible asset. Without tangible asset, there is no intangible asset at all. For your kind information, patent right. At least it has to be kept on a document, right? Patent right, this is so and so patent right which is being transferred to you. What is the proof? The document itself is the proof, tangible asset. Mona Lisa painting will be done on a cardboard sheet. So it needs a support of tangible asset for sure. So listen very carefully. If at all intangible asset and tangible asset can be separated, and one second, it can be separated, then for tangible items, follow accounting standard number 10. For intangible items, follow accounting standard number 26. Sir, if you are unable to separate, check out the predominant element. And after checking the predominant element, if tangible item is the predominant element, follow AS10 for both the items. If the predominant element is intangible item, follow accounting standard number 26. Understood everybody? Pakka. So now check out, we'll be giving you an example. You have purchased a painting. Which is drawn on the cardboard sheet. And they told that the price is rupees 1 lakh. Can it be separated or not? I mean to tell, is the painting and tangible asset, cardboard sheet, can be separated, cannot be separated? If cannot be separated, you have to check out the predominant element. So what is the predominant element? Cardboard or painting? Cardboard, hardly 10 rupees you will get. So 1 lakh minus 10 rupees. Hope you've got my point, right? So take care. So 1 lakh you are paying for the painting but not for the cardboard sheet. And hence what is the predominant element here? Painting, which is nothing but intangible asset. Clear everybody? Chandramukhi painting on a piece of paper from 4,000 years. So you are paying for the painting but not for the paper. Clear? And next one, very important, you have purchased a computer. If you have purchased a computer, there will be a preloaded OS, operation system. There will be a preloaded OS, operational system, which is nothing but Windows 10. Say for example. Clear? So or now Windows 15 or 11 sorry, whatever. So I have got Windows 10, Windows 11, etc. and etc. Now listen very, very carefully. You are paying total amount of rupees 50,000 for purchasing a computer. Clear? Already there is a preloaded OS there. And you were provided with that key also. He will be sending the same to your mail ID. So and so is your Windows preloaded OS key and JPC. He will be sending the same. Anyways, my question is all about, can you separate computer and Windows 11? Answer, obviously no, you cannot separate that. Then what is the predominant element? Why you are paying the same for? Computer or Windows 11? Computer. I'll tell you the reason. If you would like to purchase Windows 11, it may cost around for 10,000 for you. Or it may cost for 5,000 for you. Clear? But that is being purchased by the manufacturer. It will be purchased by the manufacturer on a bulky basis. So they will be getting the same at a very cheaper cost. If it is costing 5,000 to you, they will be getting it for hardly for 1,000 rupees. Getting my point, everybody? Yes, it will happen. And hence, you are paying hardly for computer, Windows 11. Computer, you are paying for computer. And hence it is all about predominant element. What is predominant element? Computer. So what it has to be treated with? S10. Understood everybody? There is application software. There is a difference between operational system and application software. OS is the preloaded version. To tell you to start the computer, you need OS, operational system, like Windows 11, Windows XP, or Mac for Apple, or Windows Ubuntu, like this you are having. But application software is all about one particular software in that computer. Likewise, OneNote, it is one application software. Microsoft Edge, it is one application software. Photoshop is one application software. Clear everybody? So you have to purchase Photoshop or Zoom. Official links has to be purchased. So they are purchasing like that. Clear everybody? Fine. So can the Zoom be separated from a tangible version? Zoom is installed in a computer. Can computer and Zoom be separated? Yes or no? Listen. Here, Zoom software, you can install in any computer or you can install in any mobile phone, and just by entering the key, it will be getting activated. Understood everybody? It needs a support of some physical item, but only that physical item is not needed. See, Mona Lisa painting, only that cardboard is needed all the time. Chandramukhi painting, that piece of paper is needed for all the time. But here it is not like that. You can install your Zoom in any of the systems. And you can just by entering the key, it will get activated. So tell me, here for this intangible asset, do you need to support a physical substance or not? Yes, we need a physical substance. But here what is the main thing that you are purchasing? Zoom software key. And hence which item is that one? Tangible or intangible? That is obviously intangible. Clear everybody? So that is the concept of your tangible and intangible items. Check out. First of all, we have gone with the definition that intangible assets are identifiable non-monetary. What do you mean by identifiable? It must be separable from self-generated goodwill. Sir, why it must only be separable from self-generated goodwill? Because generally it cannot be separated. If any asset is separated from that particular asset, then it is called as identifiable. Clear? And next is all about non-monetary assets. Assets which are not expressed in monetary terms, assets which is not purely in the form of monetary, but which can be expressed in the form of non-monetary. Assets which cannot be in the form of cash, but which can be expressed in the forms of monetary terms. Intangible asset is not cash, but intangible asset can be measured in cash, which is nothing but non-monetary item. Sir, as per AS 11, non-monetary items definition is different. As per accounting standard number 26, non-monetary definition is different. It is as simple as such items which can be measured in monetary terms, but it is not cash, is nothing but non-monetary item. Clear, everybody? Now, intangible asset always needs the support of physical substance. So, if it can be separable for tangible items, AS 10, for intangible items, AS 26. If cannot be separable, check out for the predominant element. If the predominant element is tangible, AS 10. If the predominant element is intangible, AS 26. Understood? Now moving on to the next thing. Listen very carefully. Intangible assets. Initial recognition, subsequent recognition. What do you mean by initial recognition? For the first ever time when you have purchased the intangible asset, you have to recognize in your books of accounts. What do you mean by subsequent recognition? At the end of the year, you have to recognize once again that intangible asset, which is called a subsequent recognition. Coming to initial recognition, it depends. Either you have purchased for cash or credit, or did you purchase the same intangible through exchange of asset or through issue of shares. There is another concept called development, research and development. We will learn there. But as of now, these are the three things that is important. Clear, everybody? So initial recognition. Initial recognition can be either through acquired for cash or credit, or exchange of assets, or issue of shares. In each and every situation, you have to record at one price. What is the first situation? Cash or credit. So at what price cash or credit has to be recorded? It has to be recorded at cost price. What is cost price, sir? Purchase price plus direct expenses, or nothing but cost price. Understood, everybody? What is that amount? Purchase price plus direct expenses. Purchase price is nothing but quoted price. How much ever the seller tells you that 1 lakh, 2 lakhs is the cost of intangible asset, that will become your quoted price. And coming to direct expenses, those expenses which are incurred for acquisition of that intangible assets is nothing but direct expenses. Likewise, registration fees, brokerage, legal charges, what not the things will be there. Clear, everybody? So you are purchasing a patent. The quoted price for the patent is all about 30,000. But first of all, you have to get your patent registered, for which you have to pay 40,000. So what is the total cost price now? Quoted price 30,000, registration fees 40,000. What is the total cost of the patent? 70,000. Pakka, everybody? That is what your purchase price plus direct expenses is all about. Acquired for cash or credit. Understood, everybody? Now exchange of asset. Sir, coming to exchange of assets, there will be an inclusion of the term commercial substance. Even in AS 10 also you are having the same. But coming to AS 26, no need to check out whether there is a commercial substance or not. Reason being, for all the assets there will be commercial substance. Sir, one car is exchanged for another car. No commercial substance. Commercial substance in the sense some different assets are needed. Getting my point? Risk, rewards, money, whatnot, etc. should differ, significantly differ from old asset to new asset. Risk, rewards, timing, nature, cash flows. Risk and rewards, timing, nature, cash flows, and also usage should significantly differ from old asset to new asset. If you are having a car exchanged for another car, there is no commercial substance. Reason being, your old car or new car, the risk is same, reward is same, timing is same, nature is same. Don't tell me duffa things, sir. Our old car is 3-seater, new car is 4-seater. Thank you very much. So hope you have got my point. Such kind of things are not considered because hard risk and rewards has to be considered. So one car is exchanged for another car, there will be no commercial substance. One car is exchanged for aeroplane, there is a commercial. Don't think practical possibility. If there is, then obviously it is possible. Or car is exchanged for some machinery, yes, there is a commercial substance. Pakka everybody. But coming to intangible asset, all the time there is commercial substance. Fix hypo. Reason being, even one patent is given for another patent. This patent right is different, that patent right is different. Obviously there exists a commercial substance. Clear everybody? So now, you are giving one asset, you are taking one intangible asset. You are giving one asset, you are taking one intangible asset. Take care, I did not tell that one intangible asset is given for another intangible asset. You are getting an intangible asset, for that you are giving any asset. That's your choice. It might be either tangible or intangible. Clear? So first of all, it has to be recorded at fair value of asset given up. Fair value of asset given up. If this is not there, you have to record it at fair value of intangible asset acquired. Clear everybody? Sir, what is the first choice? Fair value of asset given up. If that is not there, fair value of intangible asset acquired. Sir, this is also not there, sir. Final option, book value of asset given up. Clear everybody? Check out an example. You are giving an asset. You are giving an asset where book value is equal to 1 lakh, fair value is equal to 2.5 lakh. You are getting an intangible asset where the fair value of intangible asset is 2 lakhs. Clear? Start telling me how to write a journal entry now. You are getting dash. You are giving dash to asset account 1 lakh, because since you are giving, it has to be closed, so you have to record it with book value. Now intangible asset has to be recognized at 2 lakh, 2.5 lakh, 1 lakh. 2.5. Reason being, hope you have remembered the rule. Fair value of asset given up. So asset given up fair value is 2.5 lakh. Clear everybody? Automatically you are having some profit, loss, profit. How much is the profit? 1.5 lakh. Understood? So if this is not there, it has to be recorded at 2 lakh. Then profit will become 1 lakh. So even if this is not there, straight away record it at 1 lakh. Understood everybody? So if you have confusion, you may get a confusion like this. Sir, if the fair value of intangible asset is 2 lakh, why we are recording it at 2,50,000? It is as simple as such. Say for example, MRP of a pencil is 10 rupees. But the shopkeeper is asking you 12 rupees. What is the cost price of you? 12 or 10? 12. If the MRP is 10 rupees, you are paying 9 rupees. What is the cost price for you? 9. Fair value is not necessary. MRP is not necessary. How much you are paying is necessary. Even though the intangible asset market value is 2 lakhs, you are giving an asset where it is costing 2.5 lakh in the market. So to get an intangible asset of 2 lakh, you are giving 2.5 lakh. So your cost is 2.5 lakh. Understood everybody? So no need to check out dash element. Commercial substance. All the time there is commercial substance. Sir, ఒకవేళ ఎప్పుడైనా పొరపాటున commercial substance లేకపోతే, you have to record it at book value of asset given up. Generally, there will be commercial substance. What are the 3 options? Fair value of asset given up. If fair value of asset given up is not there, fair value of intangible asset acquired. Even if it is not there, book value of asset given up. Understood? Say for example, commercial substance itself is not there. Then you have to record it directly at book value of asset given up. Pakka everybody? So that is exchange of asset. Finally, issue of shares. Very, very simple. Record the same at fair value of shares issued. Obviously, it is having fair value. So find the fair value and write the journal entry. What is the journal entry, sir? Say for example, you are issuing 10,000 equity shares where the face value is equal to 10 and fair value or the market value is equal to 15. Clear? So what is the journal entry you have to write? intangible asset account debtor 10,000 into fair value 15. 2. Equity share capital 10,000 into face value. Remaining 10,000 into 5 has to be transferred to securities premium. Understood everybody? Sir, manaki group 2 lo majority of the standards are like theoretical parts itself. Problematic or comparatively a bit less. I don't tell less, but even if it is a problematic standard, theory is involved. Likewise, 4 totally theory, 5 totally theory, 7 is problematic, but to solve that problematic you need theory. 9 a kind of problematic, but to solve that you need hard theory. In what situation sale of good has to be recorded, and in what situation what is this called, rendering of service will be recorded. 17 is theory except tests for segment. 18 is fully theory. 19 is problematic, but to solve that problematic again you need hard theory, otherwise you cannot solve it at all. And 20 purely problematic. Theory application is more, theory is less for 20. 22 same, application is more. And next 24 pure theory. And next is all about 26 problematic. Application points you will be having, application is more here. 29 again pure theory. This is what the style. So even though there are problematic standards, but there are hard theory to apply those standards. And also there are some pure theoretical standard like 4, 5, 18, 24. These are pure theory. There will be no problematic at all. Numbers చూసి problematic అనుకునేంత మూర్ఖత్వం ఇంకోటి ఉండదమ్మా. Because if it is accounts, in any of the standard there will be number for sure. Anyways, it's come back. అంటే నేను ఎందుకు చెప్తున్నానంటే, where there is possibility of telling the problematic, I am trying to give and covering all the examples. But wherever there is no concept of giving problematic example, I cannot give you. Related party transaction, I cannot ask you percentage of percentage is equal to how much percentage. That is, A is relates to B, B is related to C, then A is relates to C or not. That is our question, that's it. I cannot tell 60% of 80% of 2.5%. What is this nonsense? Anyways, so let us come back. Issue of shares. So issue of shares has to be recorded at fair value of shares issued. Finally, my dear children, initial recognition is completed. Clear everybody? So initial recognition, sir, listen. First we have learned the definition of intangible asset. After that we have learned like intangible asset needs a support of physical substance all the time, and what will be the predominant element. Then recognition, initial recognition, subsequent recognition. Initial recognition, cash or credit, exchange of asset. If commercial substance there, commercial substance not there, to the maximum extent all the time you will be having commercial substance. Clear everybody? Sir, I'm telling a bit faster because we are having two more standards to cover. So please try to follow. And moving on to the next thing, issue of shares. So it has to be recorded fair values. If fair value is not there, fair value of intangible asset acquired. Even if it is not there, book value. Clear? So there ends with part 1. Now part 2, subsequent recognition. Coming to subsequent recognition, take more care. Sir, it has to be recorded at book value. What is book value, sir? After providing amortization from cost price. Understood everybody? Cost price or opening book value minus amortization will be nothing but closing book value. Understood everybody? So subsequent recognition is nothing but you have to provide amortization and then you have to find the final book value or the closing book value. Shall I proceed further? Now, expenditures. Initial expenditure, subsequent expenditure. Sir, what is initial expenditure? Whatever you incur for acquiring the intangible asset, that is called as initial expenditure. Whatever you incur after the acquisition of intangible asset, we will call it as subsequent expenditure. Initial expenditure is always to be capitalized. Subsequent expenditure, you have to check out whether is the expenditure generating future economic benefits or not. If it generates future economic benefits, it has to be capitalized. If it is not generating future economic benefits, it is for the purpose of maintaining your intangible asset, and hence it has to be charged. Clear, everybody? Sir, patent registration fees paid 40,000 rupees for the acquisition of patent. Capitalize a charge because it is initial expenditure. Renewal fees of a patent 5,000 paid. Renewal fees charge because renewal fees is to maintain. Understood, everybody? So that is a concept of your expenditure. Initial expenditure has to be capitalized. Subsequent expenditure, if it generates future economic benefits, capitalized. If it is not generating future economic benefits, charged. Pakka? Okay. Now moving on to the next thing. Listen very, very carefully. Some sort of intangible assets will be there. Some sort of intangible assets will be there, like self-generated. Some of the examples for self-generated is nothing but customer list, mastheads, publishing titles, like that you are having. Customer list. Say for example, there is a business concern where they are having the list of the customers. Obviously, customers are assets to the business. If there are no customers, there is no business. Clear, everybody? Sir, for your kind information, if you are అంటే నార్మల్గా మాట్లాడుకుంటే మన ఇంటి దగ్గర ఉన్న పచారీ షాప్కే నువ్వు వారం రోజులు వెళ్ళకపోతే ఏమమ్మా రాలేదని అడుగుతారు. ఆమె కరెక్ట్ ఆర్ రాంగ్? ఏది ఇంటి దగ్గర నువ్వు ఊరకి సరుకులు తెచ్చుకోవడం, రూపాయి 2 రూపాయలు వెళ్ళి సరుకులు తెచ్చుకోవడానికి 5 రూపాయలు లేస్ ప్యాకెట్కి. అలాంటిది ఫర్ ఎ హార్డ్ బిజినెస్ కన్సర్న్స్ కస్టమర్ లిస్ట్, ఈజ్ ఇట్ అ వెరీ ఇంపార్టెంట్ అసెట్ ఆర్ నాట్? Yes, it is a very important asset. For your kind information, schools will be selling the lists of the 10th class students to the intermediate colleges, which is nothing but a kind of customer list. It is an asset. They are getting money on that. Of course, without paying, no school will give. Also, if you know, if that school is having intermediate college also, they will not give that. Am I correct or wrong? So that is a kind of customer list. But you are having customer list in your hand. Can you measure it in monetary terms? Absolutely no. Intangible asset is identifiable and it must be measured in monetary terms. Non-monetary asset, but it must be measured in some monetary terms. Here it is not possible and hence it cannot be recorded. So Tata Consultancy Services is having hard brand name. Everybody knows that. But how much is the value of that brand? How much is the value of that brand? That cannot be measured in terms of money. Getting my point, everybody? Employees are very, very important to their business concern. Without employees, there is no business again. Sir, మీరు అన్నీ ఎలా చెబుతారు? అన్నీ అంతే మరి. Without raw material, there is no business. Without sales, there is no business. Without customer, there is no business. Without employee, there is no business. Anyways, without employee, there is no business. Okay, fine. So there will be some key managerial personnel who are having hard mindset. Likewise, they will be taking the expansion programs. They will be taking the decisions very wisely. Getting my point? How much will that person will be valued for? How much is the value of that person? Cannot be measured. Hope you have got the point. There are some self-generated intangible assets to a business concern which cannot be measured in monetary terms and they are not supposed to record the same. Everybody? Likewise, given you some of the examples. Customer list. Publishing title. Publishing title is nothing but something like wherever you're watching movies, director, so and so name. Yes, it is nothing but a kind of publishing title. So for that also there will be no, it cannot be measured in monetary terms. And also masthead. Masthead is nothing but if you are seeing the prescription, the doctor will, if you're seeing the prescription, the doctor symbol or doctor name will be there at the top. Likewise, on the receipt, school name, college's name will be on the top, which are nothing but mastheads. Even those cannot be measured in monetary terms. And hence all these things, even though they are assets to the business concern, they cannot record the same in their books of accounts. Pakka, everybody? Now listen, very, very important. Goodwill or brand. Is AS 14 applicable? Accounting standard number 26 applicable? That is our next concept. For each and every situation, one of the things will be applicable. Anyways, let's check out. Sir, if it is amalgamation in the nature of purchase and assets and liabilities are valued at fair values, and if PC is greater than net assets. Amalgamation is in the nature of purchase, assets and liabilities are carried at fair value, and PC is greater than net assets. If all these three conditions are satisfied, then you will get some goodwill, which has to be dealt as per accounting standard number 14, and it has to be amortized in 5 years only. Clear, everybody? But now your business concern is having such a brand name and such a goodwill where this is not at all considered, and you're able to bargain separately. If your business concern is having such a brand name and such a goodwill where this concept is not at all considered, and you're able to bargain separately. So in market we are having so and so price, so we don't accept for this purchase consideration, our goodwill must be this much. If it is very clearly mentioned, then obviously for that accounting standard number 26 is applicable. To tell you in a simple note, for your brand or goodwill, if there is market value, then accounting standard number 26 applicable, and it has to be amortized for 10 years. If your goodwill is not having a brand value or the market value or the fair value, and it is amalgamation in the nature of purchase, and your PC is greater than net assets, assets and liabilities are transferred at agreed values or the fair values. In this situation, accounting standard number 14 is applicable, and it has to be amortized for 5 years. Clear, everybody? This is another concept. Now the next concept, research and development. As I told you, many concepts will be there. The next concept, research and development. After that we are having amortization, almost last. Of course retirement will be there, disposal will be there, but those two things are very, very simple, can be completed hardly in 1 minute. Anyways, let's come to the concept of research and development. Very, very simple. You are developing your own process, or you are developing your own system, or you are doing some research before starting a product. How all these things will be treated? Clear, everybody? Doing some research before starting a product, or before expanding your business concern to some other place, you have done the research. So you will be spending some cost for this research and development. Am I correct or wrong? So how far it will be considered? Point number 1. If at all research and development phase can be separated, research phase has to be charged to P&L account. Development phase, there will be 5 or 6 conditions. Hardly to tell you, there will be 6 conditions. If all these 6 conditions are satisfied, it has to be capitalized. Otherwise, it has to be charged. Clear, everybody? Research and development, if able to separate, research has to be charged. Development, conditions satisfy, capitalize. Conditions does not satisfy, charge. Now the next one, research and development. If you are unable to separate the research and development phases, then automatically it will be treated as if it is research phase, and it has to be charged. Clear? If research and development cannot be separated, it has to be treated as research phase, and it has to be charged. Now, what are the 6 conditions? Or commonly I'll be telling it as 5 conditions, because one condition seems to be repetitive. So what are those 5 or 6 conditions, sir? Condition number 1, there should be a technical feasibility for completing the product. Likewise, COVID medicine. So to develop COVID medicine, will there be a technical feasibility or not? Of course, yes. Technically, it is possible to find any medicine. Next one, technical feasibility unte saripodu. There should be some intention to complete. You have to complete the development of the medicine. Is there that intention to your business concern or not? Yes, sir. కానీ అవి రెండు ఉంటే సరిపోదు. You should have adequate financial resources. Without having adequate financial resources, you cannot complete that. Clear? Last but not least, you have to generate future economic benefits. After finding the medicine, if you are not in a position to generate some future economic benefits on that, and why it is needed? So you have to generate future economic benefits. Last but not least, it must be measured reliably. So commonly I'll tell these 5 conditions, but there is one more condition. It is resembling the future economic benefit, which is like It can be used either for administration purpose or rentals, or it can be used either for producing the goods and rendering services. Clear? But this is nothing but generating future economic benefits. And name chepta unta. So that's the reason I told you generally 5 conditions, but regularly speaking there are 6 conditions. Clear everybody? Sir, there should be technical feasibility and common sense. Technically possibility should be there. We should have an intention to complete. We should have some adequate resources. After doing this much work, future economic benefits are very much important. And finally, it must be measured reliably. If all these conditions are satisfied, it has to be capitalized. Otherwise, it has to be charged. Pakka. Very, very important thing. Once charged, can never be capitalized back. Once charged, can never be capitalized. Once if it is charged in P&L account, it is forever charged. It can never be capitalized. Clear everybody? So reversal is quite not possible. But once capitalized, wherever it is needed, it can be charged. But once charged, can never be capitalized. Understood everybody? So that is a concept of your research and development. And the next concept is all about retirement and disposal. Retirement and disposal is nothing but you are just selling your intangible asset. Retirement. Asset is retired from active use. Asset is retired from active use. It is not generating future economic benefits. And hence you have to value it at book value or fair value, whichever is lower. Clear everybody? Sir, retirement in the sense not yet sold. About to sell. No future economic benefits. Life is over. Economic life is over and hence it is not generating future economic benefits. Not yet sold. Since the asset is retired from active use, you are about to sell. In such a case, you have to value it at book value or fair value, whichever is lower. Coming to disposal in the sense you have sold that. Whenever you are selling, you will be getting profit or loss. That profit or loss has to be charged to P&L account. Understood everybody? Okay. Now moving on to the next thing, amortization. Very, very simple. Rebuttable presumption. Sir, what do you mean by rebuttable presumption? Assumptions which cannot be withdrawn. As per accounting standard number 26, there are 2 assumptions which can never be withdrawn. Number 1, follow straight line method. Number 2, follow 10 years for amortizing. Follow straight line method. Follow 10 years for amortizing. Exception. You can follow any other method other than straight line method, which is the pattern of generation of future economic benefits. You can follow, provided proof is required. You can follow any other number of years, provided proof is required for the same. Rebuttable presumptions as per AS 26, assumptions which cannot be withdrawn. Follow straight line method, follow 10 years for amortizing. If you want, you can follow different method. Like in the pattern of generation of future economic benefits. The pattern of generation of future economic benefits. And also you can use different life period, provided proof is required for these 2 things. And whatever this amortization is there, it has to be generally charged to P&L account. Clear everybody? Listen very carefully. If intangible asset is used for producing a good, then it has to be added to the cost of production. If intangible asset is used for producing a good, it has to be added to the cost of production. If intangible asset is used for producing a tangible asset or construction of tangible asset, it has to be added to the cost of tangible asset. If intangible asset is used to produce another intangible asset, it has to be added to the cost of another intangible asset. If it is used for administration and rental purpose, it has to be charged to P&L account. Clear everybody? Administration or rental purpose, charged to P&L account. Used for producing inventory, added to cost of production. Used for tangible asset, added to cost of tangible asset. If it is used for intangible asset, added to the cost of intangible asset. That is the end of accounting standard number 26. but I'm having one last concept to tell: impairment of loss. With this, it will be closed. Check out impairment of loss. Impairment of loss is nothing but, so did you remember the common condition that I told you in AS 19? If book value is, if book value is greater than fair value, bring down book value to fair value. Similar concept. Check out. Having some cost price 1 lakh minus amortization 20,000. So you have got a book value like 80,000. Now you compare this book value with recoverable amount. What is it called as a recoverable amount? What is recoverable amount, sir? How much amount you can recover from an asset? It is called as recoverable amount. Generally, what will be there for recoverable amount? Number 1, net selling price or value in use, whichever is higher. Net selling price minus selling expense. What is value in use, sir? While using that intangible asset, you will be generating with some cash flows. Am I correct or wrong? Present value of cash flows is nothing but value in use. Present value of cash flows is nothing but value in use. So whichever is higher will be recoverable amount. Clear? Sir, you have to compare dash and dash. Book value with recoverable amount. Book value is equal to dash minus dash. Cost price minus amortization. Compare these two things. Recoverable amount is equal to dash or dash, whichever is dash. Net selling price or value in use, whichever is higher. If book value is greater than recoverable amount, bring down book value to recoverable amount. If book value is greater than recoverable amount, bring down book value to recoverable amount. Whatever the difference is there, it has to be charged to P&L account. Understood, everybody? That is the concept of your impairment of loss. This amount that is to be charged to P&L account is nothing but impairment of loss. Pakka? Sure. Fine. So yes, I have to take another 5 or 10 minutes for AS 26. Because after completion of this high-end topic, without doing the problems, it is not that easy. So let us do some of the examples. Shall I start? So what is the first one? You have to find the cost price of intangible asset. Sir, you can do the computations later, but you just tell me whether is it a direct expense or not. Shall I start now? Sir, you have purchased a software from UK for this price, which is nothing but purchase price. But take care, there is a trade discount of 2.5%. So what trade discount has to be done? Deducted. Government grants, if any are there, those are to be deducted. Trade discount, if any is there, it is to be deducted. Hope you have remembered the concept of qualifying asset. An asset which takes substantial period of time. If any borrowing cost is there, if our intangible asset is satisfying the definition of qualifying asset, it has to be added. Clear? So trade discount has to be deducted. Import duty is a direct expense. It has to be added. Additional import duty has to be added. Now check out. Entry tax. Recoverable later from income tax department. What is to be done? Ignore. Reason being, even though if you add, future it will be recovered from the income tax department. So you can deduct. Clear, everybody? So plus the same, minus the same, and hence it is not needed. Installation fees has to be added. Professional fees has to be added. Clear, everybody? Sir, I told you purchase price plus direct expense. Am I correct or wrong? All these are nothing but direct expenses. So to tell you some of the specific direct expenses, minus trade discount, minus government grant, add borrowing cost. This is as per accounting standard number 12. This borrowing cost is as per AS 16. Clear, everybody? And if any non-refundable taxes and duties are there, these will be added. If any refundable taxes and duties are there, it has to be deducted. Clear, everybody? Non-refundable taxes will be added. Refundable taxes will be deducted. But here entry fees no need to consider. Reason being, it is not included. If it is included, again you have to deduct. Clear? Sir, entry fees is not included here. If you have added, again you have to deduct. So no need to consider the same. You can comfortably ignore. Sir, once charged expense, can it be capitalized? No, once charged can never be capitalized. Check out this one, okay? This is important for you. Impairment of loss application. This is a company going for a new production process. For the year ending 31st March 2019, the total expenditure incurred on the process is 80 lakhs. The process met the recognition criteria on 1st November 2018. Expenditure till this date is 42 lakhs. Take care. Our company for the whole year spent 80 lakhs. Up to 1st November. Up to 1st November, 42 lakhs. Up to this date, recognition criteria not met. Recognition criteria in the sense, what is recognition criteria? All the conditions relating to development. Here it is developing a new process kada. So it is relating to development. So all the 6 conditions relating to development were not met up to 1st November. Up to that, the expense is 42 lakhs. After that, how much will be the expense? 80 minus 42 lakhs, 38 lakhs. Met on 1st November. So answer, 42 lakhs has to be charged. 38 lakhs has to be capitalized. Check out the first question. Expenditure charged for the current year, 42 lakhs. Carrying amount of intangible assets as at this year ending, 38 lakhs. Pakka everybody? Now check out the next one. In the next year, we have met 90 lakhs. So automatically, since the recognition criteria is met, I will be adding the same. Correct or wrong? Opening 38 lakhs. Add current year 90 lakhs. How much is the total it had become? 128 lakhs. But what happened? Check out. As at the second year ending, recoverable amount is only 82 lakhs. What is your book value? But what is your recoverable amount? 82 lakhs. Since book value is greater than recoverable amount, you have to bring down the book value to recoverable amount of 82 lakhs. How much is the difference? This 46 lakhs has to be charged to P&L account and closing balance will become 82 lakhs. Understood? So now check out. Expenditure charged to P&L account at the second year ending. That is 46 lakhs. And finally, what is the closing balance as at the year ending? 82 lakhs. Understood everybody? That is the end of accounting standard number 26. Just within 2 minutes, we are going to start AS 29. Just get ready. If you are having any doubts, you can please ask. Sir, expenditure relating to maintenance of intangible asset has to be charged or capitalized? Charged. Relating to acquisition has to be capitalized. Don't forget this one also. Okay. Take care. Amortization related problems you can comfortably solve. I told you like the pattern of generation of future economic benefits kada. If no method is there, follow straight line method for 10 years. If pattern of generation of future economic benefits ante, in the question he will be giving cash flows. Write off your amount of intangible asset in proportion to cash flows. I mean to tell, say your intangible asset is 10 lakhs. You are having 3 years given. For 3 years or for 5 years, cash flows were also given. 1 lakh cash flow generated from this intangible asset, 12 lakhs cash flows generated from this intangible asset in second year. From this intangible asset in year 3, we have generated 15 lakhs, 60 lakhs and 2 lakhs. Clear? By using this intangible asset, cash flows generating pattern will be given in the question. Then you have to amortize this 10 lakhs for all the 5 years in proportion to 1 lakh is to 12 lakh is to 15 lakh is to 60 lakh is to 2 lakh. Whatever is that. Logic clear? I mean to tell, other than this straight line method, inkokati enti undochu sir. It is nothing but in proportion to the future cash flows. Clear? That's it. So just get ready. We are going to start accounting standard number 29. So shall I start? Is 29 provisions contingent liabilities and contingent assets. Sir, for this standard, you should need to learn hardly the definitions, pure theory. First of all, you should be in such a position to have some clarity about the definitions. If you're having good clarity with the definitions, things will solve. So just check out first, what is a provision? Provision is a liability which can be measured with substantial degree of estimation but not with substantial accuracy. That is called as provision. So take care, what is a provision? Sir, provision is a liability. Of course it is a liability. But a normal liability can be measured with substantial accuracy. How much to creditor I have to pay? How much to bank overdraft I have to pay? How much to the outstanding expense I have to pay? 200% perfectness will be there. But provision is such a kind of liability which cannot be measured with substantial accuracy, but can be measured with substantial degree of estimation. Like on an estimation 10% may gone, on an expense, on an average 15% may gone. Clear everybody? Sir, understood? Next, what is a liability? Liability is a present obligation arising from the past events. It will it will make us the business concern for outflowing the future economic benefits, and finally it must be measured reliably. Liability is a present obligation. Sir, what do you mean by this present obligation, sir? But before learning the present obligation, you have to learn the obligation. So it is all about provision is a liability. What is a liability? Present obligation. First of all, what is an obligation? Whenever you have learnt about obligation, you have to learn about possible obligation, present obligation. These are the cycle of the definitions. So first of all, let us start with an obligation. Obligation is duty or responsibility to settle or repay an element of financial statements either through legal enforceability or statutes or provisions of law, or to maintain good relations. Obligation is a duty or responsibility. Business concern should feel duty-fiable. Business concern should feel it as responsible to repay an element of the financial statements. How, sir? Either legal enforceability is there, or provisions of law or statute is telling you to repay, or just to maintain good relation. Amma, creditor is there. Creditor. Which law will tell that you have to repay to creditor? No law will tell. Will there be any agreement between a normal creditor? Absolutely no. Then why you will repay to the creditor, sir? To maintain the good relation. Clear everybody? So that is what obligation. Duty or responsibility to settle or repay an element of financial statements through legal enforceability, statutes or provisions of law, or to maintain good relation. Coming to the next one, possible obligation. Sir, basing on the evidence available as on the balance sheet date, that obligation is equally likely to occur or less likely to occur. What is this nonsense, sir? As at the balance sheet date, you are supposed to pay, but the payment is either equally likely or less likely. To tell you an example, Mr. K had filed a case on our business concern. Legal counsel of our business concern are telling that, sir, there are very less chances for repaying because the case is strong and it is on our end. మన వైపే కేసు మొత్తం ఉంది, పే చేయడానికి చాలా తక్కువ ఛాన్సెస్ ఉన్నాయి, లేకపోతే ఈక్వల్ ఛాన్సెస్ ఉన్నాయి సార్. సో వాట్ ఈస్ దట్ ఆబ్లిగేషన్ కాల్డ్ as possible obligation. If legal counsel told that as at the end of balance sheet date we are having high chances to repay, then it will become a present obligation. Sir, every liability, now tell me, is it a possible obligation or present obligation? Liability. Present obligation, because for a liability you cannot tell less likely chances to pay to my creditor, less likely chances to pay my bank loan. Then they will take every security like in the form of asset from your business concern. Finally you will not left with anything. Clear? So liability is always which obligation? Present obligation. More chances for repaying or high chances for repaying. Understood? So as at the balance sheet date, basing on the evidence available, such obligation is considered probable. That is more likely than not to occur. Liability రావడానికే ఎక్కువ ఛాన్స్ ఉంది, liability రాకపోవడానికన్నా. So we will meet with the liability and we have to clear the liability. Pakka everybody, that is a concept of present obligation. So check out liability is a present obligation where it will make a business concern to outflow for the future economic benefits and ultimately it must be measured reliably. Pakka. Tell me, sir. Sir, what is a provision? Provision is a liability. Substantial accuracy and not substantial accuracy. Not substantial accuracy, but substantial degree of estimation. And coming to the next one, liability is which obligation? Present obligation. Present obligation in the sense? Present obligation in the sense as on the balance sheet date, more chances of occurring. Possible obligation in the sense? Less chances of occurring or equally likely of occurring. First of all, what is an obligation? Duty or responsibility to repay or settle a particular element of the financial statements either through legal enforceability, statutes or provisions of law, or just to maintain good relations. Pakka everybody? Fine. So moving on to the next one. I'll ask you the question, answer. Provision for bad debts. Will it be under AS 29 or not? Answer. No. Why no? It is not a liability. It is reduction of an asset. Decrease of debtors is provision for bad debt. Okay, everybody? Provision for depreciation? No. Why? Because it is decrease in asset, but not a liability. Understood? Now, a legal counsel is telling that we are having a strong case where we have to pay the amount to the extent of 7 lakhs. For this 7 lakhs, we are creating a provision. Answer. Will it be a liability as per AS 29 or not? Yes, 200%, because you are creating a provision for repaying now. Outflow of future economic benefits. Pakka everybody? Now listen very, very carefully. Sir, do you need to create a provision for present obligation, possible obligation, future obligation? For all the three things. Answer. Present, possible, future. Present obligation, because provision is a liability. Liability is a present obligation. So you have to create provision for only present obligation. Pakka everybody? Listen, I am giving you an example and answer. We have purchased an asset. Business concern is estimating that after 5 years, we have to put repairs for this asset to the extent of 1 lakh, and hence it is creating provision for repairs and renewals to the extent of 1 lakh in year 1. Understood everybody? Understood with the example. Purchased an asset, estimating that after 5 years, we have to keep some repairs to the asset to the extent of 1 lakh. And business concern would like to create provision for repairs and renewal to the extent of 1 lakh in year 1. Answer. Possible or not possible as per AS 29? Question ardhamainda? Not understood? Sir, question ardhamainda antunna? Very simple. I have purchased an asset. After 5 years, I have to repair that. Sir, o laptop konnaru, sir, o AC konnaru, కొన్నాళ్ళ తర్వాత రిపేర్ రాదా? ఆ రిపేర్ కోసం బిజినెస్ కన్సర్న్ ఇయర్ 1 లో ప్రొవిజన్ క్రియేట్ చేస్తుందంట. క్వశ్చన్ అర్థమైందా? ఆన్సర్ తెలియట్లేదా? So after 5 years, business concern is estimating that it will have to spend rupees 1 lakh on the repairs of that machinery, and hence in year 1 itself it had created provision for repairs and renewals 1 lakh. Is it a provision as per AS 29 or not? No. Why? It's a future obligation. It is not a present obligation. Pakka everybody? Hey, now listen very, very carefully to another example. You have purchased an asset. As per law, you have to keep the asset repaired for every 5 years, and the estimated price is 1 lakh, for which you are creating provision for repairs and renewals now. Answer, is it a present obligation or not? 200% yes. Because law is asking you to create a provision. Law is asking you to repair the asset for every 5 years for sure. Say for example, if you take aeroplane or ship, as per legal enforceability or as per law, they have to be repaired or they have to be overhauled for every set number of years. And hence, you have to create a provision for sure. Even though this is a future obligation, it is not, obligation arises by the time when you purchase the asset. Clear? Sir, it seems to be future obligation, but it is not a future obligation. Now itself you got an obligation to get the asset repaired after 5 years as per law. Sir, నేనేదో ఊరకే అసెట్ కొని 5 years తర్వాత రిపేర్స్ చేయాల్సి వస్తుందేమో అని ఒక ప్రొవిజన్ క్రియేట్ చేస్తే అది ప్రెజెంట్ ఆబ్లిగేషన్ అవ్వదు. 5 years తర్వాత రిపేర్స్ వస్తే చేయిస్తావు, లేకపోతే నువ్వు చేయిస్తావా? సో ఇట్ ఈస్ నాట్ present obligation, but as per law is there, for sure you have to get the asset repaired, and hence it is a present obligation. Pakka? Now listen very carefully. In the current year, our machine is not working properly. So inspector of the machine had inspected the machine and he told that, sir, you have to get the asset repaired, for which you have to pay 1 lakh, get ready for that. By the year end, this was not yet repaired, and hence business concerned had created a provision for repairs and renewals to the extent of 1 lakh. Possible or not possible? Answer, present obligation or future obligation? Obviously present obligation. Asset is under repaired, so it has to be, asset is not working properly and it has to get repaired, and hence obviously you have to create a provision. Pakka everybody? So respond, understood? That is the concept of your present obligations and future obligations. Okay, next part is all about contingent. One more thing I have to deal with. Sometimes provisions can be reimbursed. Say for example, some Mr. K had filed a suit on your business concern that you have sold an adulterated product. What is it called? Kalti aipoyina oka product, which is called as an adulterated product. So our business concern sold an adulterated product to Mr. K, and hence Mr. K had filed a case on our business concern to the tune of rupees 1 lakh. Legal counsel of our business concern are telling, sir, we are not the manufacturers, we are wholesalers, we have purchased it from manufacturer. In turn, let us file a suit on the manufacturer. Understood? For a compensation of rupees 1 lakh. Understood? How much I have to pay? How much I will receive? That is a concept. Clear everybody? So in your P&L account, you can create a provision. Clear everybody? Two kinds of provision is there. Number one, provision for payments. Another thing is like reimbursement for the provision. Understood? So listen very, very carefully. All or some part of the provision can be reimbursed by the third party. Recognize reimbursement only if it is virtually certain. Virtually certain in the sense 100% chances of getting the same. And very, very important, this provision and reimburse cannot be offset in balance sheet, but if you want, you can do the same in P&L account. To tell you, one more thing. Say for example, this one, this provision is 80,000. How much is the payment? 1 lakh. How much max I can collect? So if you want in P&L account to provision for damages 1 lakh by reimbursement 80,000. Clear? Or you can offset the same. To provision for damages 1 lakh minus reimbursement 80,000, net figure is 20,000. But coming to balance sheet, you cannot offset. Provision will have to be shown separately as a liability. Reimbursement has to be shown separately as an asset. Because from reimbursement, there will be inflow of future economic benefit, which is satisfying the definition of asset. Provision, there is outflow of future economic benefits where you have to pay that 1 lakh, which is satisfying the definition of liability. and hence you cannot offset while presenting it in balance sheet. But while going with P&L account, you can do the same. Because even though it is treated as income and it is treated as expense, you can tell that my net income is 20,000. Understood? Now last and final example with related to this concept. They are estimating that the payment is rupees 1 lakh and amount of collection is 1.5 lakh. Clear? Remember, reimbursement can never be more than provision. If reimbursement is more than provision, it is violation of prudence concept. Anticipating future gains, which is not to be done. Pakka everybody? So that is the concept of your provision and reimbursement. Moving on to the next one, contingent liability and contingent asset. So coming to contingent liability, liability which may or may not occur in future. Its existence will be confirmed by occurrence or non-occurrence of one or more events, future uncertain events. Same contingent asset is also the same, a possible asset or a present asset which will be confirmed upon occurrence or non-occurrence of one or more uncertain future events. To tell you, remember very carefully, contingent liability is a possible obligation. Contingent liability is a possible obligation, less likely of chances or equally likely of chances. Pakka? Contingent asset, even though there are more chances for occurring the asset, you should not recognize that. Violation of prudence concept again. Anticipate all possible future losses but not gains. Pakka? Now check out very carefully everybody. To tell you, if it is a possible obligation, it is obviously a contingent liability. If it is a present obligation, it will become liability. Clear everybody? Provided if it is measured with substantial accuracy. If it is a present obligation, it may become a provision when substantial accuracy is not there. If it is a present obligation, it cannot be measured reliably at all. Again, it is contingent liability. Understood? A possible obligation is always a contingent liability. Present obligation is substantial accuracy, normal liability. Present obligation, no substantial accuracy but degree of estimation, provision. Present obligation but cannot be measured reliably, contingent liability. Pakka everybody? Sure. So that is the end of your accounting standard number 29. And contingent asset is very simple. Likewise, possible asset which may or may not occur. To tell you a final example for these both things, I'll be closing accounting standard number 29 and will tell you some rules and regulations of AS7. Just bare portion I'll revise because konchamaina revise cheste meeku koncham better ga untundi ante. Coming to AS29, yeah, last and final example. We have gone with filing a case in the court of law that Mr. K had occupied my building. Clear everybody? Now, for this, I have appointed lawyers to whom I have to pay 1 lakh where the building value is 50 lakhs. Now listen very carefully. Legal counsel or the lawyers told, sir, you don't worry. Your building will be with you for sure. If we won the case, you pay the amount. If we have lost the case, no need to pay a single penny. That is the agreement between business concern and lawyer. Clear? If we win the case, pay the amount of 1 lakh. If we lose the case, no need to pay. Now what is the position? 200% we have to lose the case, sir. You're not going to win the case. We will lose the case. Clear? If we lose the case, is there any need to pay this amount? So no need to create any provision for this also. If we lose the case, will this building become ours? So even though, it is a contingent asset, it is a contingent liability. Even though 200% chances of losing the case, there will be at least 0.0001% because that is not in my hands. That is in the hands of court. Your legal counsel is telling 200% you will lose the case. But always, since it is outside party, you cannot tell that it is 200%. Maximum chances of losing the case. Minimum chances of winning the case. Clear? Now they told maximum chances for winning the case. If you have won the case, you have to pay 1 lakh, for which you have to create provision, because maximum chances for winning the case. And also this contingent asset may convert into asset to the maximum extent, but I cannot recognize it as an asset. Logic clear? Contingent asset, once it is contingent, it is always contingent. I cannot recognize in my books of accounts. Reason being, as per the concept of prudence. But coming to liability, it is not like that. If there is more chances of payment, you can create a provision. If there is less chances, you can just ignore. Last and final, if at all the contingent liability or the provision is having remote chances in the sense very less chances, in such a case you can just ignore that. No need to show even a contingent liability. Clear? If the contingent liability is having remote chances of occurring, then provision kaad kada, no need to show at least contingent liability, you can just ignore. Pakka? That is the end of your accounting standard number 29. Due to the time limitation, I am unable to cover the problematic related aspects, and I would like to start accounting standard number 7 immediately. Even coming to accounting standard number 7, I cannot deal with all the problematics, or even I cannot deal with all the provisions, etc. and etc. But to the maximum extent, I would like to give you a theoretical coverage. So take care. Coming to accounting standard number 7. So accounting standard number 7 will be applicable only to contractor but not to contractee. So to the contractee, which standard is applicable, sir? It depends on his business. If the contractee is a trader, then AS2 is applicable. If the contractee is making the contractor to construct a fixed asset, then AS10 is applicable. If the contractee is treating it as an investment, AS13 is applicable. Say for example, there is a party called contractee and he would like to make the contractor for construction of a building. Now this building, for contractor, accounting standard number 7 is applicable. But for this contractee, if it treats this as fixed assets, AS10 is applicable. If it treats this as investment property, then accounting standard number 13 is applicable. If it treats this something like inventory, then accounting standard number 2 is applicable. Clear, everybody? One more thing, if at all the contractor is constructing the contract or constructing the building on his own name for selling of the same, then AS7 is not applicable. What do you mean by this? Say for example, contractor had entered into a venture with one outsider. Clear, everybody? Outsider had given a land, contractor is constructing the building. After that, these buildings will be sold on his own account. For this thing, accounting standard number 7 is not at all applicable, because contractor is doing the business in his own account. Even for these kind of things also, accounting standard number 7 is not at all applicable. Now, coming to the next one, there are two types of contract. Number one is fixed price contract. Number two is cost plus contract. Fixed price contract in the sense how much our amount is there, that will be fixed. But cost plus contract will be cost plus some reimbursement. That reimbursement can be either in rupees or in relative terms. Say for example, we have incurred, contract. Likewise, fixed price contract, contractor and contractee, or speaking something like for the after the construction of the building or for the construction of a building, contractee has to pay 10 crores. That's it. It is fixed price. Then what is cost plus contract, sir? For cost plus some reimbursement amount. Sir, I have incurred a cost to the tune of rupees 10 lakhs, sir. Okay. Plus 10% is your reimbursement. My profit. So 10 lakhs plus 10% on a whole, you have to give 11 lakhs. Or they have incurred, they might have written their agreement something like this. Sir, I will be incurring 10 lakhs. On that, you pay me 5 lakhs, sir. If I incurred 15 lakhs, pay me 5 lakhs, sir. If I incur 20 lakhs, pay me 5 lakhs, sir. This is nothing but absolute term. Cost plus reimbursement in absolute term. Now, 10 lakhs plus 10%, 20 lakhs plus 10%, 15 lakhs plus 10%. This is called as relative terms. Understood, everybody? So, fixed price and cost plus. Now, very, very important thing, construction contracts also include service contracts. Service contracts will also be involved. Something like, what is that called? Interior designing. You might have heard this. Interior designing can also be a part of construction contract, or 3D designing techniques. Even 3D designing can also be treated as a construction contract, provided if it is directly related to the original contract. Likewise, you are entering into a contract with the contractor that you have to construct the building. But before construction of the building, show each and everything in 3D designing techniques. So for 3D designing techniques, contractor will be charging some additional amount. Clear, everybody? For that case, no need to treat it as a separate contract. You can treat it as an original contract itself. Understood? So general construction contracts also include service contracts. Now moving on to the next thing, contract revenue. So contract revenue has to be recognized on percentage of completion method. There are two methods, strictly speaking. Number one, completed service contract method. Likewise, what we have learnt under accounting standard number 9. Okay. Or percentage of completion method. Take care, my dear children. Completed service contract method is not at all permitted as per accounting standard number 7. A7 itself is telling there are two methods for recognizing the contract revenue. Number one, after the completion of your entire contract, you recognize it as your revenue. Also, A7 told that this method is not applicable by AS7. As per accounting standard number 7, there is only one method, that is proportionate completion method. In proportionate completion method, you have to find the percentage of completion. Coming to percentage of completion, there are three methods: physical proportion method and survey method. Physical proportion method is nothing but you will be just observing the building. Say for example, you have a contract for construction of 5 floors. You have constructed 3 floors till now. So what is the percentage of completion, sir? 3 floors by floor, 5 floors multiplied by 100. Something like 60%. Clear, everybody? This is nothing but physical proportion method. Now coming to survey method. Survey is also same, but it will not be conducted either by contractee or contractor. One outsider will come. One inspector will come. He will inspect the whole building and he will be telling that, sir, to the extent as per my survey, this person had completed only 52% of the work. Even though 3 floors are completed physically, within the 3rd floor itself, there are many other things to complete, sir. So my survey report is only 52%. Clear, everybody? But most possible method is based on cost incurred, which is nothing but cost incurred till the date divided by total estimated cost multiplied by 100. Clear, everybody? Remember, in the question he told that 52% is completed, and also giving the data cost incurred divided by total estimated cost multiplied by 100. And if you have computed this, you got 60%. Now what to be considered? Question ardhamainda? In the question given 52% is completed and also given additional data, given enough data for this, if you compute, you got 60%. Now what you have to consider? 52 or 60? 52. Clear? Because this 52 directly given in the question, in the sense already percentage of completion was attained. Once again, you don't compute what is the percentage of completion. Understood? So this is one of the concepts. And yeah, if there is uncertainty in collection of contract revenue, very simple. If exists, you have to postpone till the contract revenue is received. If subsequent uncertainty is there, don't reverse, but you have to create a provision, as we have learnt in accounting standard number 9. Very important. Listen carefully. So total contract, listen very carefully. Total contract value 10 crores. And the contract years is something like 5 years. What is the contract period? 5 years. What is the contract value? 10 crores. Just 1 month completed by starting the contract. And after the completion of 1 month, that is at the end of 31/3/2011. So we are telling that the percentage of completion is something like 5%. Okay. So can I recognize 10 crores into 5% as my contract revenue or not? Did you get the question? What is the contract price? Contract period? On how much is the percentage of completion? 5%. Hey, normally how will you recognize your contract account? Contract account. contract revenue. Total contract revenue multiplied by percentage of completion. Here you will be getting contract cost. Automatically you will be having either contract profit or contract loss. Am I correct or wrong? So my question is all about same things. Till now percentage of completion is all about 5%. 1 month completed. Work 1 month completed. Now answer me. Can I recognize 10 crores into 5% as my contract revenue or not? The answer is no. Reason being, during the early stages of the contract, you cannot get the proper percentage of completion and hence it is better to avoid. What is the total period? 1 month completed. Hardly to tell you, for that you are telling 5% completed. So that contractee will have some temptation. Already 5% completed, within 5 years it will get completed. I mean to tell, hardly more than that it will not happen. Hardly 5%, 2% of the work done. So you cannot recognize, contractor I got already 2% work done, 10 crores into 2% I got this amount. Clear everybody? So during the early stages of the contract, better not to recognize contract revenue because there will be always uncertainty. Clear everybody? And moving on to the contract cost. Contract cost is very, very simple. Whatever cost you have incurred, you have to recognize that. You are having 3 kinds of cost: specific cost, allocable cost, other cost. Specific cost in the sense cost attributed to the particular contract. Allocable cost in the sense cost incurred for group of contract and it has to be allocated to different contracts. I told you something like 3D designing. Now it is not as a part of contract, and contractor is almost having 10 contracts. This contractor is having a deal with another person who is making 3D designing. For all the 10 contracts, he had given the work to the 3D architect and he is charging 10,000 rupees for all the 10 contracts. So automatically it is like an allocable cost. For each and every contract, it will become 1,000, something like that. Or contractor had bought one asset, had brought one asset on a rental basis. He is using that asset for 5 contracts. And rent paid is about 1 lakh. So 1 lakh used for 5 contracts. For each and every contract, it will become 1 lakh divided by 5, which is nothing but allocable cost. Apart from these 2 things, if any other costs are there, yes, even those are to be considered as contract cost only if agreed as per their terms and conditions. Understood? Something like, sir, contract is having an office. He is switching on the fan. He is switching on the AC. Can he charge this amount on the contractee? Why not? Clear? But now you are having agreement with the contractee that, sir, generally I'll open my office only for half day. But after accepting your contract, I have to work more. So I will incur some additional administration expenses. I need to hire an employee also. And hence, let us come to a deal that you have to reimburse this cost also to me. Clear? If this is agreed, yes, it can be included in contract cost. So general administration cost, research and development cost will generally be not included in other contract cost, but if there is agreement, even it also can be included. Clear everybody? And yeah, this is a very important concept. Future expected loss. Future expected loss is nothing but if contract cost is more than contract revenue, then automatically you will be incurring some loss. This loss has to be recognized in contract account irrespective of commencement of work of contract, percentage of completion, profit from the other contract. You cannot tell that, sir, from this contract I got 1 lakh, from another contract I got a loss of 50,000 and hence I'll set off these 2 things. No, it is not possible. You have already entered into a contract. You have kept a signature. But later on immediately you found that this contract is not at all profitable to you. You are going to incur a loss of 1 crore. Clear? So you cannot deny, sir, the work was not started. Just the signature is over and hence I will not recognize the same. No, it is not possible. Whether or not the work was started, if there is a loss, once if it is a loss, it is a loss. So you have to charge it immediately. And also irrespective of percentage of completion. Sir, I'm estimating that the total loss is 1 lakh. My percentage of completion is only 20%. Can I recognize only 20,000 as my loss or entire 1 lakh? Entire 1 lakh. This concept is not at all there. Understood everybody? Irrespective of percentage of completion, you have to recognize each and every or the total loss. And the next concept is all about combining and segmenting. If you have entered into such a contract of constructing more than one asset, then you can combine if the assets are negotiated as a single package and all the contracts are having single project with the overall profit margin, and these are performed either sequentially or concurrently. There is a contractee, just 5 minutes, I'm going to leave you. There is a contractee and there is a contractor. Contractee actually would like to construct a shopping complex or something like a very big shopping mall, where inside the shopping mall he would like to have some recreational facilities and the remaining is shopping mall. Clear everybody? Something like what is it called? If you take DMart here, so one side you will be having trends. It's a very big complex. At one side you will be having trends, one side you will be having DMart, and outside you will be having some shops. KFC is there. So all these things are there just in one shopping complex. So in that shopping complex, contractor would like to have those many cabinets. So he had entered into a contractor. He had entered into a contract with the contractor that he need to construct all the different things. Clear? For all these things, contractee is negotiating with the contractor as if it is a single package. Clear? Sir, you do whatever you want, but contractor is telling, do whatever you want, but you have to construct all these things. For the entire thing, I'll pay you 1 crore. Or for the entire thing, I'll pay you 20 crores. Something like that. They are negotiating as if it is a single contract. As if they are having a single profit margin. And work has to be performed either concurrently or sequentially. Either one after the other or all at one time itself. If all these conditions are satisfied, we will call it as combining. Exactly opposite. Even though you have to construct these many things, contractor and contractor are negotiating separately for each and everything. Contractor is telling, sir, I'm very sorry, sir, I cannot negotiate on a common basis. The reason being, shopping mall has to be constructed in a different style. For hotel, it has to be constructed in a different style. For recreation park, it has to be constructed in a different style. So I cannot negotiate everything in a common basis, sir. Let us negotiate separately. Then that concept is called as segmenting. Understood everybody? That is a concept of combining and segmenting. If there is combining, it has to be treated as if it is a single contract. If it is segmenting, it is to be treated as a separate contracts. And that's it. The session is totally completed. మధ్యలో అంటే కొన్ని చోట్ల ఎక్కువ బోర్ కొట్టి ఉండొచ్చు, but I hope you have enjoyed the session. More than enjoying, hope you have understood with the things. సో హోప్ మీరు ఏదైతే అనుకున్నారో మీకు అది వచ్చింది అని అనుకుంటున్నా, అండ్ మీరు ఏదైతే రివిజన్ అవుతుంది అని మాకు అనుకున్నారో అది మీకు ప్రాపర్గా వచ్చింది అని అనుకుంటున్నా. అండ్ ఆల్సో హోప్ దట్ మే గాడ్ బ్లెస్ యూ, అండ్ ఫర్ ష్యూర్ యూ హ్యావ్ టు క్లియర్ in this attempt at any cost. And all the best for each and everyone. Wholeheartedly wishing you advance congratulations. So take care and don't feel tense for the examination. All the best for your examinations. And inkevana next marathon classes ki attend avutunte, all the best for even that marathon classes also. So anyways, thank you. Class completed. Bye ma.